This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 5 videos on the trader's equation and probability. Perfect trades cannot exist. However, good trades exist and they're common. Traders need to be able to structure trades where they have a mathematical advantage and edge. I'm going to talk about the mathematical basis of trades, and that's the trader's equation. Traders always need an edge when they're structuring a trade. That's a mathematical advantage. That means that if they take enough of a particular type of trade, they will have a profit over time. For example, we have a buy climax and a lower high. It looks like a reversal. Traders might short below the low of that bar. At this point, it's not a high probability trade. Traders might place a stop either above this bar or above the top of the buy climax. The risk is not big relative to the reward. A lot of beginners like low-risk trades. That's their greatest concern. They don't want to lose money. Their account size is small, they worked hard to build their account, and they know if they lose their account, their dream of becoming a professional trader might disappear. In general, beginners like low-risk trades. However, when the risk is small, so is the probability of profit. As long as the risk and profit and reward make sense, the trade is still a very profitable trade. But you need to balance out the risk, reward, and probability. That means you have to structure a trade that has a good balance. Some traders prefer higher probability trades, and that means they wait for strong breakouts. For example, waiting to sell once you have a pair of consecutive big bear trend bars and selling that close or selling this small double top bear flag below that low is a higher probability trade, but the stop is up here. The stop is further away, so the risk is greater. Also, you're entering later in the trade. There's less profit remaining. The risk-reward of entering here is not as good as the risk-reward of entering here. However, the probability that you'll make money is greater here than it is here. That's the trade-off. Some traders prefer small risk. In other words, they want a very good risk-reward equation, and they enter here where they have smaller risk. Other trades prefer to win frequently, and they go for high probability trades. However, that means that the risk-reward ratio is worse. It usually means that the stop is further away. Over the short run, a day or 2 or 3, trading is a zero-sum game. Over the long run, years, it's not. But as a trader, you're trading either for a day, a week, or a month. You're trying to take money from very smart people, and it's difficult to do. However, that challenge is part of the fun. And if you structure your trades properly and manage them properly, you'll have a very good chance of consistently making money. An edge, a mathematical advantage, is usually fleeting and small. Even the best traders do not have a very high probability of making a big profit all of the time. Any advantage that they have is small. However, if they're consistent and they're capable of consistently trading properly, that small mathematical advantage can result in very big profits over time. High-frequency trading firms, HFT, use algorithms for only days to weeks at a time before switching to a different type of algorithm. Here we have a very tight trading range. Traders look to buy low, sell high, and scalp. Everybody wants a perfect trade. However, a perfect trade cannot exist because before long, everyone would discover it and no one would be willing to take the other side of the trade, and the trade would stop working. Here's a trading range. High-frequency trading firms would detect that the market's starting to enter a trading range, and they would start looking to buy low and scalp, and sell high and scalp, because that is what is most profitable when the market is behaving like this. On the other hand, trading ranges eventually break out, as this one did here. We have a strong bear breakout and a strong follow-through bar. The market is probably going to fall for some kind of a measured move, and traders selling here have a high probability of making money. The traders who bought low, for example, traders who had limit orders to buy here, now are going to lose money. The algorithms and the style of trading that was profitable when the market was doing that are no longer profitable once the market begins to trend. In this case, the bears will not be able to sell high because the market is not high, it's only going down. And bulls buying low are going to have a hard time making money if the channel down is tight. Instead of buying low, selling high, and scalping, traders should only sell, and they should swing trade. Bear breakout, consecutive bear bars, both closing below the low of the trading range. High probability the market will fall for some kind of a measured move, maybe based on the height of the range, maybe based upon the height of the breakout, the open of this bar to the close of that bar, measured move down. And then there will be other measured moves as the channel unfolds. This is a spike and then a pullback, and that pullback is the start of a channel. The market became a spike and channel bear trend. And it's very tight, and when it's tight, it's impossible for the bulls to make money, and therefore traders should not buy. And when the channel is tight, it's impossible for the bulls to make money, and therefore traders should not buy. Traders looking to sell high cannot sell high because the market is only pulling back for a bar or two and never gets high. Traders have to sell for other reasons like below bars, sell bull closes, or sell breakouts to new lows. Instead of buying low, selling high, you cannot buy at all. Instead of selling high, you have to sell low. Breakouts of bear flags, attempts to reverse up. In any case, you'll be selling near the bottom of the market, betting that it will go lower, and that is the correct strategy. A perfect trade has a high probability of a big reward with very little risk. That cannot exist because there would be nobody to take the other side of the trade. If you have a very high probability of a big reward with very little risk, no institution is going to take the other side, because if your trade is perfectly good for you, it's perfectly bad for him. He has a low probability of making only a small reward with a very big risk. You cannot get all three variables, probability, reward, and risk, on your side. You can usually get one, often you can get two, but you can never get all three. Usually the trade-off is between high probability versus risk reward. Some traders want high risk reward that has a lower probability of making money. Other traders want high probability, but that usually comes with a worse risk reward profile, usually bigger risk, a stop further away. Again, perfect trades cannot exist because someone has to take the other side of the trade, and no firm is going to take a trade with very little probability of making money, and they only stand to gain a small reward, and the risk is big. Any trade that approaches perfection will be traded very quickly, and the opportunity will not last long. Trading range setups are never all that clear, so the probability is not all that high, but the risk is small. Strong bear breakout, the probability is high that the market is going down further. However, the risk is usually bigger. The stop is further away. Breakout, high probability, worse risk reward. Trading range, low probability, but better risk reward. Bear channel, it's a breakout on a higher time frame chart. The probability is still good, but it's not quite as good as selling during the breakout. Again, the stop when you're in a trend is usually further away than it would be within a trading range. So the risk is greater when you're trading in a trend, but the probability of making money is greater as well. The market is in a cycle. It's in a trading range, and then it breaks out and enters a trend. The trend eventually becomes a trading range again, and then it decides whether to reverse into an opposite trend or to resume the trend, break below the trading range. Traders should not expect any strategy to last for too long because the market will constantly alternate between a trading range and a trend. The trend can be up or down, and when you have a trading range, the breakout can be down or up. Once too many computers begin to detect what the market is doing, the market usually does something else. For example, if it's in a trading range, it eventually breaks out, and if everybody starts trend trading, eventually no one will take the other side of the trade, and the market starts to go sideways. Breakouts are brief. On any chart, on any time frame, only about 5 to 10% of the bars on the chart are in strong breakouts. For example, here, strong breakout, another strong breakout here. Lots of breakouts here, but they all failed. But in general, 5 to 10% of the bars on a chart are in a successful breakout. So the opportunity to make money during a breakout is brief. And once you're in a channel, it eventually will start flattening out and evolve into a trading range, waiting for the next breakout, up or down. Entering a trade during a strong breakout is as close as you get to a perfect trade. However, the opportunity does not last long. Traders who are selling as this is falling, if they're sensing that the market is falling fast and likely to break out successfully, they have a brief opportunity to sell here or here where the stop is not very far away, the risk is not great, and the probability of profit is high, and the potential for reward is big, but that is only a very brief opportunity. Once everyone sees the opportunity, you get some profit taking, and the market then gets a pullback, and the strong breakout gets replaced by some uncertainty and eventually a channel. Institutions detect the quick momentum down, and they're selling quickly, and that is creating the breakout. As I said, it's a brief opportunity for a trade that is as close as you can get to perfection. It does not last long. As the breakout grows, the risk increases, and all of a sudden it becomes less perfect. There's also a reasonable chance that a breakout will fail. In general, if you have a strong breakout like this, there's a 40% chance that it will fail and reverse back up. 60% chance it'll go down at least for a measured move. That's when the breakout is strong like this. We have a breakout, another breakout bar, both closing below the trading range, and then no bull bar for the follow through. We have dojis here, so weak reversal attempt. This is a 60% trade, 60% chance it's going to fall for at least a measured move. Anytime a trade approaches perfection, everyone sees it and everyone starts trading in that direction. Early in this breakout, everyone is selling, knowing that probability is high of making money and the stop is not far away. And the bar is big because everyone sees this as potentially a perfect trade. There is a risk factor, and part of it is time. The stop might not be far away, but you have the risk of making mistakes in your decision, assessing whether or not the breakout will be successful. And a lot of traders are uncomfortable making those quick decisions and placing those trades. And therefore they'll wait to see a couple strong closes and then sell a close down here. Knowing that it's less perfect, stop is now further away, but you still have a high probability of a profit. When a trade is close to perfect, you get a huge trend bar because everybody is quickly taking the trade. And as the bar becomes big, the stop gets further away, and that increases the risk. And if you enter down here, not only is the stop further away, but there's less reward remaining in the trade. So the risk-reward ratio is becoming worse. No matter how good you are, your edge, your mathematical advantage is always going to be small. The key to making money consistently is learning how to become consistently good. No one's going to give you money. Trading is always going to be hard, but that's part of the fun, the challenge. Traders always wonder if they have to be perfect. They do not have to be perfect. All they have to do is trade well consistently. Learn how to structure trades where there's a mathematical advantage, use appropriate stops and exits, and manage the trades correctly. Whenever a trader takes a trade, he's always thinking, am I going to make money if I take this trade? At least subconsciously, traders are only going to take a trade if they believe the probability of making money times the size of the reward is significantly greater than the chance of losing money times the risk. And that is the trader's equation. I'm going to talk about the trader's equation now. Traders only take a trade if they believe that the probability of making money times the potential reward is significantly greater than the probability of losing money times the risk. You know what the reward is. That's your profit target. That's the money you're hoping to make. And you know the risk as well. You know where your stop is, so you know how much money you're risking. What you never know is the probability. However, it's safe to assume that the probability is always going to be between 40 and 60%. It's closer to 60% during strong breakouts, and then in trading ranges and weaker trends, the probability is less. In a trading range, for example, it sometimes is only 40% unless you use a wide stop and scale in. This is the trader's equation. If it's positive, then it makes mathematical sense to take the trade. You can even lose 60% of the time and still make money if the risk-reward ratio is good enough to offset that low probability. Here's the E-mini, a 5-minute chart, and I want to talk about 10 theoretical trades. Assume you take 10 trades and your profit target is 4 points and you use a stop that's 2 points away. So your reward is twice as big as your risk. 4 is twice as big as 2. And let's say you only win 40% of the trades. So of the 10 trades, you only win 4 times, and 6 times you do not win. Those 6 times might be small losses, they might be small wins, some of them will hit the stop, but none will be more than 2 points because you have a 2-point stop. For example, let's say you sell below this bear inside bar, and you sell here. You place a limit order to take profits at 4 points, and you get filled here. You have a stop 2 points above. You're risking 2 points, and you made your 4 points at the bottom of this red box. Let's say you see the reversal. You think of it as a wedge, and then a pretty good reversal. You think it's going higher, and you buy in a stop above this pullback bar here, and you get filled there. Again, you place a stop 2 points down. You place a limit order to take profits 4 points up, and you get filled right there. This is another profitable trade. You made 4 points, you risked 2 points, your stop was not hit. And let's say you sold here, took profits here. Sold here, take 4 points profit here, here, here. On the way up, you bought above this inside bar, took profits here. You bought above here, took profits here. Many profitable 4-point trades. On the other hand, if you bought here, hoping for a reversal up, it did not quite make 4 points. You sold on the reversal down, thinking it's a minor reversal and the bear trend would probably try to resume. You made less than 4 points. And let's say you see this as a potential double bottom and you bought above this bull bar. You put your stop either below the low of the signal bar or maybe the low of the bear trend, or you just rely on your 2-point stop. And let's say you get stopped out here for a 2-point loss. And then here as well, you got a high 2 bull flag, you buy, and then you get a bear reversal bar. You either exit below that bar or you rely on your 2-point stop. You lost 2 points here, you lost 2 points here, you lost 2 points there. We have a strong trend down, strong trend up. It's easier to make money. Reasonable swing trades should win 40% or more of the time. And because of the strong trend, we have 10 trades, 7 of them were winners and only 3 of them were losers. On the other hand, let's say instead of 70% win, let's say only 4 were winners. So you had 4 trades, each making 4 points. Your total profit on the winning trades is 16 points. And let's say you had 6 losers that hit your stop. You would lose 12 points. Your net profit would be 16 minus 12, 4 points. Greater than 0, you have a positive trader's equation. You have 40% winners times 4 points. That is greater than 60% losers times 2 points. That's a positive trader's equation. So the strategy that you are employing here makes sense mathematically. And over time, you have a very good chance of consistently making money. The math is actually better than what I just described, because if you're swing trading, you're not going to be taking profits at 4 points. You'll hold on to the trade until it no longer makes sense to hold on to it. For example, until there's an opposite signal or until the end of the day. Your winners, then, many of them, will be much more than 4 points. Also, 60% of the time, you're not making 4 points. That does not mean you're losing 2 points on each of those 6 losing trades out of 10. Some of the trades will be 2-point losers, some will be 1-point losers, some will be 1-point winners, some will be 2-point winners. Those 60% of trades when you're not making your profit target balance each other out. Some are small winners, some are small losers. You're not going to have 60% of the time hitting your 2-point stop. I want to give an example using the euro versus the dollar forex market. Here's a 5-minute chart, and I want to talk about 5 possible trades. Assume you're using a profit target of 40 pips and a protective stop of 20 pips. And let's say you only win 40% of the time. 40% of 5 trades, that means you're winning 2 trades out of the 5. We have a strong bear trend, and let's say you sold here and you placed a limit order to buy back with a 40 pip profit, and you had to stop 20 pips up. Here, the market quickly went down to your target, and you'd exit with a 40 pip profit at the bottom of this red box. We have a very strong reversal up after 3 pushes down, 1, 2, 3. Probably we'll try to get a second leg up. Let's say you place a buy stop order above the high of this bull bar, and you placed a stop 20 pips down. The market turned back down, but it did not quite reach a 20 pip stop. It resumed up for a second leg, and you would have been filled with your limit order 40 pips above your entry. Another profitable trade. You buy here, stop just down here. This did not reach it, and you exit up here with 40 pips profit. The bears made 40 pips here. The bulls made 20 pips here. And again, the bulls made 20 pips here. A high 2 bull flag, 2 legs down, a test of the top of this range. And it went up 40 pips before the stop was hit. On the other hand, let's say you sold below this reversal bar. The bulls tried to create a bull trend and the market reversed back down. However, the market reversed up from a new low. You had a profit target down here to take profits at 40 pips. You had a stop up there 20 pips above. You sold here. It did not hit your stop. However, this reversal is a good enough reason to exit. You'd exit above the high of this bull bar, which is maybe a pip or two profit from this short. And then again here, let's say you bought above this bar, a wedge, 1, 2, 3, decent bull bar, and you put your stop below the low of the day, below here. You were quickly stopped out. It's less than a 20 pip loss, but you still were stopped out. Reasonable swing trades should win 40 or more % of the time. Here we have a strong trend down and a strong trend up. You probably have better than a 40% chance of winning with your swing trades. We have 3 trades that reached a swing target of twice as big as the risk. They made 40 pips while risking 20 pips, and you had 2 trades where you did not make your 40 pips. Here you might have made a pip or 2, and here you may have lost about 15 pips or so. 2 losing trades, 3 winning trades. Let's assume instead that you only had 2 winning trades. You had 2 winners times 40 pips, would be 80 pips total profit. You had 3 losers. Let's say your losers all hit the protective stop and you lost 20 pips on each. 3 losers times 20 pips, your total loss is 60 pips. Your net profit is 80 minus 60, 20 pips. That means that the probability of winning, here it turned out to be 40%, times the reward, is greater than the probability of losing, here 60%, times the risk. That is a positive trader's equation, and that means this type of strategy is mathematically profitable. You have an edge. And if you employ this strategy over time, you have a good chance of consistently being profitable. The math is actually better than that because some of the winners are more than 40 pips. If you're swing trading, you won't necessarily take profits here. You may swing part of it until the trend is no longer in effect, until the end of the session, until there's a clear opposite signal. So some of the winners would actually be more than 40 pips. 60% of the time, you do not make a swing profit. You do not make 40 pips. But that does not mean your stop gets hit during those 60% of the trades. Some of them are small losers, some of them are 20 pip losses, your stop gets hit, and some of them are small winners. And the 60% of the time when you do not make your 40 pip profit, those times tend to balance each other out. Some small winners, some small losers. I began by talking about perfect trades and a mathematical advantage. Perfect trades cannot exist. However, if you structure your trades properly, you can have a mathematical advantage, an edge. And then I moved on to talk about the trader's equation. If the probability of making money times your potential reward is significantly greater than the probability of losing money times your risk, you have a positive trader's equation, and the trade that you just structured has a mathematical advantage. You have a good chance of making money. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 5 videos on the trader's equation and probability. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 5 videos on the trader's equation and probability. Traders often hear about risk-reward ratios, 2 variables when you take a trade, risk and reward. There's an equally important variable that you never hear about, and that's probability. You have to consider all 3 variables whenever you're taking a trade: probability, risk, and reward. If you want, you can think of them as simply two variables, probability and then the risk-reward ratio. If a trader sees this breakout with this big tail and then a second attempt to go up and another reversal down here, he might sell below the low of this bar and put a stop either above the high of this bar or up here. The result was a big bear trend. Whether he had to stop here or here, the reward was small compared to the risk. He ended up taking a trade that had a very good risk-reward ratio. However, selling right here, the probability that you're going to get a swing down is small. More likely, you're going to go sideways. Low probability, very big risk-reward ratio. If a trader prefers higher probability, he'll wait for the bear breakout and a follow-through bar, this bar closing below the low of the past 30 bars. The probability is high that the market's going to fall for at least a measured move from the open of this bear breakout to the close of the bear breakout, which is down here. 60% chance or more that we're falling down here. Yet if you sell here, you're getting a high probability trade, but your stop is still here or here. So the risk is much greater than for a trader who sold here. This trader had great risk reward and lower probability. This trader has worse risk. His stop is further away, but a higher probability of making money. You could also sell below this double top bear flag, a low 1, low 2, double top this high and this high. That is also a high probability trade for making money. But again, the stop is up here, and that's the trade-off. You either get a high probability of making money, it's always accompanied with bad risk reward, or you have a trade with excellent risk reward that's always accompanied by bad probability. For every trade, there's always one institution buying and another institution selling, and there has to be a reason for both of them to take the trade. In general, it's a trade-off. One trader gets better probability and worse risk reward. The other institution gets worse probability but better risk reward. Both are acceptable if you manage the trade correctly. Should you buy or sell? You choose the variable that's more important to you. Some traders always try to take high probability trades because they like to win a lot. However, that always means smaller risk reward. In general, the risk is greater, the reward is less. Other traders really focus on big reward. They like to get very big winners. However, when they do that, it's always accompanied by lower probability. When traders start out, they work really hard to save enough money to trade. The one variable that they consider far beyond any other is risk. They don't want to lose money. They're afraid that if they lose money, they'll lose their account and they'll lose their dream. It'll be the death of their dream. So it's the equivalent of dying. And when traders begin trading, they tend to focus only on risk. And they often totally ignore probability, which is unfortunate because you need to pay attention to all three variables if you're going to trade profitably. Beginners are always looking for the lowest risk trades, and they lose money. And it's because they don't understand that a low risk trade means low probability. That means you're going to lose most of the time. And then if you add to it poor management because of inexperience, your losses are going to be bigger and you're going to lose even a higher percentage of the time. It doesn't matter whether you take a trade with a great risk reward and lower probability or a trade with a higher probability and worse risk reward if you manage the trade properly. Both are reasonable ways to trade. Both have positive traders' equations. Some traders don't worry too much about picking exact tops and bottoms. A lot of them will wait for a pullback or a breakout because then the probability of making money is higher. They'll sell the breakout or they'll sell the bear flag, the pullback from that breakout. These traders are comfortable having a stop far away, either here or here, because they know the probability is high that they'll make money. That bigger risk is the price they pay to get the high probability of a profit. Experienced traders will sometimes take lower risk, lower probability trades. Other times they'll take higher probability, bigger risk trades, whichever one they feel like gives them the better edge. For example, if a trader has to leave soon and they cannot stay to watch the trade all day, They need a high probability trade. They need a quick profit, a small profit. A small profit means a small reward. It's a scalp. That means if they're going to take the trade, they're expecting to win a high percentage of the time. The best way to improve a risk-reward ratio is to swing trade. Go for a very big reward. For example, sell and you stay short until the market either reverses or until the end of the session. Let's say a trader sells below this low and uses a very tight stop just above the high of that bar. So they get short right here below that bar. If he's a scalper, he might get out with 1 times his initial risk. His initial risk is above the high of the sell signal bar. He entered here, and this is 1 times his risk. A swing trader, on the other hand, will stay with the trade until the trade is no longer valid. Here, 3 pushes down, 1, 2, 3, a parabolic wedge. We have a bull bar closing on its high. Maybe we'll get a minor reversal. This is a reasonable place to exit, but look at the size of the reward, entering here and exiting here, risking to here or here. So excellent risk-reward ratio, but low probability, 40% chance he's going to get the swing down, 60% chance he's not going to get the swing down. Either the market will go up and hit a stop, or it'll simply go sideways. The huge reward relative to risk more than offsets the low probability of a very big profit. It's reasonable to sell there. There's another way to improve the trader's equation, and that's by scaling in, adding to a position, even if it's a losing position. Beginners should not do that. Scaling into a trade increases the probability of making money. But you pay for that with a worse risk-reward ratio. You're increasing your risk, and you're usually reducing your reward as well. For example, we have a bear trend, but we have 3 pushes down, 1, 2, 3. It's a parabolic wedge, consecutive sell climaxes, and there's a bull bar, consecutive bull bars. This is not a high probability sell. However, the reversal up is probably only going to be minor and will probably test back down. When you have a very tight bear channel, the first reversal up is minor, and you're usually going to test back down. The bears sell here, hoping it'll continue down, but confident that the first reversal up will not go far. They can sell more and then get out around their original entry price, break even on their first short, and then with a profit on their second short. Sell more maybe below here, a low 2 or a low 3, low 1, low 2, maybe this is a low 2 and this is a low 3. It's still below the top of the sell climax, it's still below the top of the bear leg. Chances are the market's going to test down to this area. Maybe a stop at the top of that most recent bear leg. He gets out when the market comes down to his original entry price at the low of that bar. He sold just a little bit below that bar. He might get out at the low of that bar and take a tiny loss, or he'll get out just below the low of that bar and get out break even on his first entry, and he gets out with a profit on his second entry. He increased the probability of making money by adding to his position, but he's also increasing his risk. Instead of risking from here to here, he's additionally now risking from here to there as well. So he increased his risk to get the higher probability of making money. Again, only experienced traders should do this kind of a thing. We have a bear trend, a bull breakout, and a higher low, and now we have a double bottom. If you want, you can call it a double bottom, higher low, major trend reversal. You can call it a double bottom bull flag. So bull breakout, a pullback, and then now a double bottom in possibly a bull trend. In any case, we have a bull buy signal bar. Traders will buy above that buy signal bar, and some of them will put a stop just below the double bottom. Very small risk, and that immediately tells you the probability is low. If you take this buy, you're probably going to lose money. It's probably going to fall below the low of that bar. Whenever the risk is small, chances are you're going to lose. Stop just below the double bottom. You're buying in the middle of a tight trading range. Most attempts to break out of a tight trading range fail. Attempts to the downside or attempts to the upside. A trader, on the other hand, might prefer a high probability trade. And here we have a very big bull breakout bar and a second consecutive big bull breakout bar. There's a 60% chance after a strong breakout like this that the market's going to rally for at least a measured move up based upon the open of the breakout to the close of the last bar of the breakout. 60% chance we're going up here. High probability, but the stop is still down here. This trader put his stop here. The trader who bought that close, his stop is here as well. He has a much higher probability of making money, but he also has a much greater risk than the trader who took the initial buy. A triangle, 3 pushes down, 1, 2, 3, 4, and a bull bar. It's still a high probability that the traders will make money if they take the buy above that bull bar. The probability here is not as high as the probability here, slightly lower probability, but still close to 60% that you'll make a profit buying above that bull bar. Buying the breakout, very high probability. Buying the pullback, slightly higher probability. Buying the pullback here, slightly lower probability. Buying here, again, lower probability the higher up you go. We have a bull trend and a bear breakout and a tight trading range. In the tight trading range, we have a double top, lower high, and a bear bar closing on its low. This is a reasonable short. You sell below that bear bar for a double top, lower high, major trend reversal. Stop above that high. Very small risk, and that tells you immediately you're probably going to lose money. 60% of the time, you're going to lose money. 40% of the time, you're going to get a swing. But the swing is so big that it more than offsets the loss. It's reasonable to take that low probability short. Other traders prefer high probability trades. They'll wait for the bear breakout. We have consecutive big bear bars closing below the low of the past 50 bars. High probability that we're going to fall for at least a measured move down. From the open of the bear breakout to the close of this bar, we're going to fall for a measured move down 60% of the time. We're getting a pullback, so increased uncertainty, but it's still a fairly high probability short, either below this bar or that bar. Again, whether you take the short here or here, the stop is still here. So the risk is greater for these high probability shorts compared to this short, but the probability of making money is greater as well. I've met many traders over the years who win 90% of the time. Without asking them, I automatically know that they are scalping. If you're winning 90% of the time, you have to have a bad risk-reward ratio, and that usually means a very small profit. In other words, you're scalping. You cannot get a great variable, 90% probability, without giving something up, usually risk-reward. And that means you're always giving up risk-reward. Usually it means you're taking a small risk and a small profit. I have a high probability of winning, you have a good risk-reward. That means you lose a little and I make a little, but I have a high probability of success. These are all examples of scalps. You buy here, you scalp out. You've got a small bull flag, you buy above the bull bar, you bet against the reversal down, you buy that low, you buy the reversal up. These are all high probability trades if you're taking small profits. Therefore, they're all scalps. Selling here, 3 pushes up, 1, 2, 3, small wedge, bear bar, probably going to turn into a trading range, high probability, small risk. And then these are all scalps. Sell the close, sell the close, sell the low 1, sell the low 2, sell the breakout, sell the double top bear flag, sell the breakout below here, sell the close, sell the low 1 short, all the way down. Lots of scalps. High probability of success if you're taking a small reward. In other words, if you're scalping. Whenever you take any trade, you automatically know the risk and reward. For example, if you're buying, you should automatically, as soon as you enter, put in both a stop to sell if the market goes against you and another order to take profits at a reasonable target. That distance to the profit-taking order is your reward, and the distance to your stop is the risk. You always know the risk and reward with every trade. However, you don't always know probability. In fact, you never know probability. The risk is the number of ticks or pips to your protective stop. The reward is the number of ticks or pips to your profit-taking limited order. The probability is very, very important, but it's never clear, and most traders ignore it, which is too bad because you need to pay attention to it if you want to structure profitable trades. A reversal down, a pair of strong bear bars closing on their lows, you sell the close, a high probability short. Your stop is either above this sell climax or above the top of the bear leg, so you know how much you're risking. With a high probability trade, you know the probability is you'll make at least a reward equal to your risk. You sell that close, stop here or here, and measured move down is here, and the reward is here. A reasonable place to take at least partial profits. A high probability trade, the reward is only equal to risk, so your risk-reward ratio is 1. That's a low risk-reward ratio, but it's mathematically okay because the probability of making money is high. Strong bull breakout, I always look to the left. I want to make sure that the market is above prior highs, that it might be a bull trend. And if I get a strong reversal down, I look to the left as well. Big buy climax, it could fall below that low and still be in a bull trend. If it falls below the bottom of the bull trend, then it's no longer in a bull trend. It's then either in a trading range or bear trend. Whenever you have a strong breakout like this, high probability that you're making money. But you do not yet know if it's a bull leg in a trading range or a bull leg in a bull trend. Not great follow through, might get a deep pullback, but as long as the pullback stays above the bottom of the bull trend, it's still possibly a bull trend. With this big of a reversal, big up, big down, it generates big confusion. Probably the market's now in a trading range. However, as long as it stays above this low, it's not in a bear trend. It's either in a trading range or a bull trend. Strong reversal down and strong follow through. At this instant, the market's always in short. However, it's still above this low. It could simply be a deep pullback in a bull trend or a bear leg in a trading range. Some bears will sell that close. In general, I do not, because it's still around the low of the buy climax and it's still above this low. So that is not a high probability sell, even though you have consecutive bear bars. Look to the left. We're still possibly in a trading range or possibly in a broad bull channel with higher lows and maybe even higher highs. It's always in short, but unless you get strongly below the bottom of this buy climax, it might be simply a bear trap, trapping traders into selling low in a bull channel or a trading range. You cannot tell in this chart, but this low actually fell a tiny bit below the bottom of this buy climax. And that's common. If you have a buy climax and a reversal down, usually the market tries to fall at least a little bit below the bottom of the buy climax. And then it decides whether to form a double bottom with that buy climax and resume up, or break below it and fall for a measured move based upon the height of that buy climax. For the bulls, it's still a bull trend, and it's a double bottom with a buy climax low. It's also a higher low. It's above this low, and it's above that low. Yet, whenever I see a reversal down this far in a bull trend, chances are it's not going to be a strong bull trend. More likely, it's going to be big up, big down, big confusion, and confusion usually means trading range. Bulls will buy the reversal up. You buy low, sell high, and you take quick profits. It's reasonable to buy this low. It's a double bottom with that low, and it's still above the bottom of the bull trend, so it's still a higher low in a possible bull channel. More likely, you're buying low in what will become a trading range. Bull trend and a pullback. As long as the pullback stays above a 50% retracement of the buy climax, the probability favors higher prices. But the risk is greater because your stop is down here or down here. If the market falls below the midpoint, the probability for the bulls is less, but so is the risk because you're closer to the stop. So buying down here, you have less probability of a bull trend, but you also have less risk. Buying up here, the probability is good, better than 50-50, that you'll make money, but the risk is far away, and the reward might not be all that great as well. We have a weak rally, we're probably not going to go much higher. Buying up here, stop down here, not much reward, bad risk-reward ratio, but high probability. So traders buying up here, good probability, but bad risk-reward. Once it dips a little bit below the midpoint, probability drops to about 50% that the market is still in a bull trend. But the risk is less, so if you buy here, you're closer to the stop here or here. You're getting better risk reward, but lower probability. If you're buying in the bottom third, the probability is less that the market's still in a bull trend. Maybe it's only a 40% chance that we're going up to a new high, but the risk is less as well because the stop is here. Whether you buy up here, here, or here, the stop is still here. As the market falls, you're getting closer to the stop. If you're entering down here, if you're buying down here, you have less risk, but after this much of a reversal down, retracing all of the bull trend, you have less probability of the market making a new high. This is the most important price for the bears. It's the bottom of the bull trend. The bears want to get below this low, because if it gets below this low, the market's no longer in a bull trend. It's then either in a trading range or a bear trend. As long as it stays above this low, it's either in a bull trend or a trading range. When you're getting a sell-off like this down to the bottom of the buy climax, you just don't know if it's simply a test of the bottom of the buy climax. As I said, when you get a reversal down after a buy climax, the market usually gets at least a little bit below the bottom of the buy climax. And then you don't know if there are a lot of dollars buying down here, looking for a trend resumption up. Is the market going to form a higher low and be in a broad bull channel? Or is this an actual reversal that will break below the bottom of the bull trend and become a bear trend? Strong reversal up, 5 consecutive bull bars, 8 bars without a bear body. We're back to always in long. That makes a bear trend unlikely. Now we're probably either in a bull trend or a trading range. Anytime I see a strong breakout, I always look to the left. Is the breakout above all of the bars or just above some of the bars? If it's still below this high, this rally could simply be a second leg up in a broad bear channel. First leg pullback, second leg, or a second leg up in a trading range. Even though the market is always in long, maybe by the close of this bar, that does not mean bull trend. It could simply be a bull leg in a bear channel or a bull leg in a trading range. Breakout, follow through. You can call it a head and shoulders bottom, left shoulder head, right shoulder. Bear trend, higher low, major trend reversal. A breakout and follow through above the neckline. We're always in long. We might go up for a measured move. It might, in fact, be the start of a bull trend. But unless it gets above the top of the most recent lower high, it's still in a bear trend. And this could be simply a bull leg within a broad bear channel or a bull leg in a trading range. Traders will buy the close, confident that the probability is high that we're going at least enough up to make a profit. However, unless we get above this high, this rally is simply a double top lower high, or you can call it simply a lower high and possibly a broad bear channel, and traders will look to sell the reversal down. 2 legs up, 1 pullback 2. This could be a second leg trap, trapping traders into thinking it's a bull trend, but if you look to the left, we have not gone above the most recent major lower high, and therefore this could simply be a trap, tricking traders into buying too high in either a bear channel or in a trading range. You can sell the reversal down there, or higher probability, sell this reversal down here, double top bear flag. Strong bull swing, but still possibly a pullback from this strong leg down. Unless we get above that high, a major lower high, no matter how strong this rally is, it still could be simply a pullback from this sell-off. Here's a 50% pullback. As long as the market stays below the 50% pullback, then the probability is at least 50% chance that we're going lower. Below the 50% pullback, the probability favors the bears. The bears selling here have greater risk. They have higher probability. That's always accompanied with greater risk. The bulls need to break above this lower high. Otherwise, we could still be in a bear trend. Again, if it gets above the lower high, it's no longer a bear trend because a bear trend needs lower highs. Down here, the risk is great for the bears. Their stop is way up here, and the probability is high. If you're selling down here, the reward might simply be a measured move down based upon the height of this trading range. We have a double top bear flag, and the risk is greater than that. The distance to this high, if you're selling down here, is greater than a measured move down. So the reward is less than the risk. So it's a bad risk-reward ratio, but a high probability of making money for the bears if they're selling down here and stop up here. If you start selling above the 50% pullback, the risk is getting less because the stop is getting closer, and the probability is getting less as well, the probability for the bears. And if you're selling in the top third of the bear leg, there's a greater chance that we're going to break above the protective stop, a greater chance that this is a trading range instead of a bear trend. It's 60% chance of the bulls getting above that high, and only a 40% chance of the bears getting to a new low. But the risk for the bears is less because they're very close to the stop, and the reward is greater. It's very far away. Bears selling up here have a much better risk-reward ratio, but a much smaller probability of making money. Down here, bears have worse risk-reward, but higher probability. In the bottom half of the bear trend, the probability favors the bears. 60% chance we're going to a new low. And the probability gets less the higher up the market goes, and the risk-reward ratio gets better for the bears. The risk is less and the reward is greater. In the top third, the risk-reward clearly favors the bears. The chance of a new low is less, but the reward is very big relative to the risk. When you have a strong rally like this, but it's below the top of the bear trend, you don't know how many dollars waiting to sell. How many dollars view this as simply a buy vacuum test of resistance? Is this simply a second leg trap, leg one, pullback, leg two, with a lot of bears looking to sell in the upper third? You don't know until you see the reversal down. The probability favors the bulls, but the risk-reward is better for the bears. There are always bears willing to sell. Once you see the reversal down, the probability is getting better for the bears, but if you sell down here, the risk is greater. In this video, I talked about risk, reward, and probability, and I tried to emphasize the importance of probability. A trader cannot simply think about a risk-reward ratio. A great risk-reward ratio is meaningless if the probability of making money is very small. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 5 videos on the trader's equation and probability. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 5 videos on the trader's equation and probability. I would like to begin by talking a little bit about the Z-score, which is a mathematical way to measure how profitable a strategy is. And then I want to talk a little bit about probability of the 3 variables that a trader needs to understand when structuring a trade: risk, reward, and probability. Probability is the most important. A Z-score, it's a measure of how good your system is. It's used by quantitative analysts, quants, when they design systems. As a trader, you do not need to know anything about your Z-score, but if you want some better mathematical understanding of how good your method of trading is, the Z-score is one measure that you can use. It's basically the number of standard deviations from a mean. This is the formula, and most of you are not going to be interested in the mathematics of it. N, the total number of trades in the series that you're examining. R, the total number of winning or losing streaks in the series. For example, if you have 2 consecutive winners, that's a winning streak. If you have 7 consecutive losers, that's a losing streak. It doesn't matter how many are in the streak, it's just the number of streaks. And then W, the total number of winning trades, and L, the total number of losing trades. A Z-score measures just how reliable your system is. Can you trust your system going forward. If you have a high Z-score, then you have a much better chance of making money going forward. If you have a low Z-score, you have a much higher risk of losing your money and losing your account. I want to show you this chart, and I want to show you a good way to trade it and a bad way to trade it. For example, let's say you begin by scalping for a reward that is 1 times your risk on second entry reversals. For example, you buy a high 2 bull flag or you sell a low 2 bear flag. Here are some sample entries. Here's the first entry, there's the second entry, so you sell on the second entry. Here's the first entry, here's the second entry, so you buy on the second entry. Again, first, second, a high 2 bull flag, high 1, high 2, a second entry buy, a pullback, high 1, high 2. This is the high 2 here, so you get long there. And then again, high 1, high 2. On the way down, we have a double top, second entry short, a low 2 bear flag, second entry, a low 1 on this bar, a low 2 on that bar, all the way down. Here we have a high 1, high 2 for the reversal up. Now this system has a very high Z-score because it has a high winning percentage. 11 of the 12 trades on this chart are winners, and all the winners are about the same size. Both of those things indicate that you have a very consistent way of trading, and therefore a much better chance of making a profit going forward. The past results are a good predictor of what you'll expect to see in the future. In other words, what you're doing is good. You can miss some trades, but you're confident that you still can make money. Every now and then you'll hear traders talk about a blown account or ruin, risk of ruin. How much risk do you have of blowing your account? A blown account simply means that your account no longer has enough equity to meet margin requirements. Your broker will not let you trade unless you put more money in your account. It can mean that you lost all the money in your account, and it can mean that you lost so much money that you lost more money than is in the account, and you have to send your broker even more money. However, the minimum that you need for your account to be ruined or blown is for the equity to have fallen so low that your broker will no longer let you trade unless you put more money in your account. When you have a high Z-score, the risk of blowing up your account is small, and therefore you can risk more per trade. A best Z-score would be about 5, which is extremely rare, but outstanding scalpers can get a score that high. A really good Z-score is 2 to 3. In general, if you have a very good system, a very good Z-score, you can risk about 2% of your account on every trade that you take. The lower your Z-score, the smaller percentage of your account you should risk on a trade. Here's another system using the same chart. Instead of buying second entry reversals or high 2 bull flags and selling low 2 bear flags, let's say instead you bought at the high of the prior 10 bars and you reversed to short below the low of the past 10 bars. Broke to the low of the past 10 bars, you sold. And then you reversed to long at the high of the next 10 bars. And you lost money, obviously. And we have a new low, so you sell here. Another loss. A new high over the past 10 bars, you buy. You have a small win because this is where you exit, below the low of the past 10 bars. And then look at this. You have a very big win, and it probably offset most or all of the prior losses. And therefore, the strategy is a profitable strategy. However, it's a bad approach to trading because it has a very low Z-score. It has a very low winning percentage. You only had one significant win, and almost all of the profit, in fact, pretty much all of the profit came from a single trade. And that's dangerous. Let's say this is a 5-minute chart, and you had to go to a doctor's appointment right here. Then you would have taken 1, 2, 3, 4 trades so far today, and you would have missed this trade. Let's say it's a daily chart, and let's say you're taking all these trades and you're losing, and you're hoping for this big win. And let's say you went on vacation right here for 2 weeks, and then you missed the big win. That's a big, big problem if you have a system where most of your profit comes from a single win. There's a much higher risk of blowing your account. Any system that needs one big win to make the system profitable is a bad system. There are many brokerage firms that allow you to design and test systems. A very important part when you analyze the results of your system is to pay attention to whether or not most of the profit comes from a single trade or 2 or 3 trades. If you need 1 or 2 big trades for the system to be profitable, it's a bad system and you should not trade it. Even though when you look at the results, it'll say that you made money in the system. You may even have made a lot of money in the system. But if it all comes from a single trade, your risk of ruin is very high. And you probably will eventually lose your account if you continue to trade this system, because you will miss too many of the big trades that you need to offset all of the prior losses. If you miss this one big trade in this series of trades, your system loses money. Another problem with a system where all the profit comes from a single trade is it's hard to wait through bar after bar after bar and loss after loss after loss, hoping for the one big trade. It's hard to take the next trade. You'll look back and say, gosh, I've been losing a lot. Maybe I better slow down in my trading. And you'll end up missing the one great trade that you need to reverse all of the losses and to make the system profitable. A low Z-score means that the chance of blowing up your account is great and your system is bad. You have a low winning percentage. In other words, most trades are losers. You have a few big winners, but more big losing trades, and you're too dependent upon 1 or 2 outstanding trades to offset all of the losses and make the system profitable. Not only do you have to take the trade, you have to manage it correctly, and that's hard to do as well. The result is, if you analyze the standard deviation of your trading results, the standard deviation is very big. You have some very small trades, some very big trades, and that is a very dangerous system. It's unreliable. If you do try trading a system like this, you should trade very, very small. Most traders should never trade a system where you need 1 or 2 big trades to offset a lot of losses, because you're going to lose money. The odds are just overwhelming that you're going to lose. Any system that a beginner trades, he should trade small, because that will reduce the chances of him losing his account. In general, if a beginner can trade small enough to risk 1% of his account on each trade, that is a good starting point. For example, if you have a $10,000 account, try to risk $100 or so on each trade, and not more or not much more. When you're starting out, you're always going to lose, but if you can trade small enough, the cost of learning is not so bad. Even if you have a great system starting out, which you probably will not have, you're still going to lose because you probably will not manage the trades correctly. I mentioned that if you have a $10,000 account and you want to risk about 1% per trade, you would be risking about $100, which is a stop of about 2 points in the E-mini. Even if you have a $10,000 account and your broker might allow you to trade 3 or 4 E-mini contracts, that would generate too much risk, and therefore you should be trading only 1 contract. In general, traders should trade the I don't care size. They should trade so small that they don't care if they lose. All they care about is, am I doing the right thing? Am I trading correctly? Am I managing my trade correctly? Are my setups and entries and exits all logical? And that allows you to practice doing the right thing without worrying about money. You cannot get rich trading the I don't care size. However, you can learn how to trade very well with minimum cost. Even when you become a consistently profitable trader, it's better to be trading the I don't care size, because you want to be doing this for a career. I've been doing this for 30 years, and you have to be happy and you have to be comfortable, and it's not fun to be worried all the time. If you have a $10,000 account and you're a Forex trader, and you want to risk no more than $100 in the euro versus the dollar, then you can use a 100 pip stop and you can trade 10,000 units. That would keep you under the $100 risk. Instead, you could use a 20 pip stop and trade 50,000 units. Or even better, begin trading only 10,000 units so that your risk is only $20 per trade. That's one of the great advantages of the Forex market. Most brokers will allow you to trade very small sizes, which reduces your risk per trade. And your cost of learning is therefore much less. And it's easier to trade a size where you really don't care, or you care so little that you're able to do what you need to do and develop a track record, a style of trading that you trust. And once you're at that point where you can consistently make money, even if it's a small amount of money, then you can begin to increase your position size. Of these two choices, trading with a 100 pip stop or a 20 pip stop, both are good. They're both good I don't care sizes, and they allow you to practice doing the right thing without worrying about money. I've talked many times about the three variables that traders have to consider: risk, reward, and probability. You can look at it as two variables. You can say risk-reward ratio, one variable, and probability, the other variable. Probability is the most important because it's the one that is the hardest to know with any certainty. You always know what your risk is. It's the distance to your stop. You also always know what your reward is. It's the distance to your minimum profit target. Probability is much more difficult. Probability, I think, is the main reason why it's so hard for beginners to make money. That lack of certainty confuses traders, and it scares traders, and they end up making a lot of mistakes. For example, a trader watches a breakout, and they watch an additional breakout, and now they see a bull bar closing on its high, and they think, wow, I've seen enough proof that the market's going up. Maybe I'll finally buy here. That's a common beginner mistake. We're starting to get dojis and bear bars. We have a big tail on the top of this bar. This is a tight trading range, and the big bull bar is forcing you to buy at the top of a tight trading range after 3 legs up on a bull. One, and then 2, 3. Strong breakout, you expect at least one more leg up. However, this big tail and then these 2 bear bars, it increases the chances that we're not going to get much more than 1 leg up. Beginners thought this was a high probability buy, when in fact it was a low probability buy, and the bull trend was probably transitioning into a trading range. Experts were selling here, and they would have sold here as well, expecting that the market is no longer in a bull trend. It's in the early stages of a trading range. The trading range bottom could have been here, but it could be all the way down here at the bottom of the bull trend, which it turned out to be. We got a reversal, spike, pullback channel. Beginners tend to buy too late. Sometimes they buy too early. For example, they might buy here, thinking a double bottom, sell climax and double bottom with this or with that. They buy too early. They buy too late. Both are causes of losses. Another problem with probability is beginners often miss really great trades because they're afraid to risk too much. Here we have a series of bear bars, maybe 10 bars down without a bull body. We have a big bear breakout and a second bear bar closing near its low. This is a high probability short if you sell the close of this bar, that you're going to make some money. You could have gotten out here and made a little bit, or you could have held all the way down here and gotten out down here. This is a high probability trade, but a lot of traders starting out will not take it because they know their stop is up here and they're afraid of risking that much money from selling here all the way up here. Even when they have a high probability trade, they're afraid to take the trade because of risk. When a beginner finally does sell, let's say he sells below this low 1 bear flag, he'll end up exiting too early for a loss or break even. He sells here and he sees a decent bull reversal bar here, a double bottom, maybe a big double bottom, and he buys. And he exits on the reversal up. If you're selling this late in a bear trend, you have to be swing trading, which means you need to use a swing stop, at least above the sell climax, probably above the top of the bear trend, and you have to be willing to hold through pullbacks. This is almost certainly going to be a minor reversal. You have a tight bear channel lasting 10 or 15 bars. The first reversal up, bears will sell it. And bulls who have been buying all the way down and losing are going to use any bounce to exit. So you'll have bulls selling and bears selling, and you'll probably get at least a second leg down. The bears finally got their pullback. A low 2 short, low 1, low 2. You can call it a failed breakout above the double top. First high, second high. Breakout that reversed down, and therefore it's a type of a wedge bear flag. But the beginner still does not sell. He's concerned that we're getting too many bull bars. He ignores the reality that the bull bars are small. There is no series of 2 or 3 big bull bars. Look at the size of these bull bars. They're big, but not compared to that, this, and that, and not compared to the size of the sell-off. This is almost certainly a bull leg in either a trading range or it's a bear flag leading to another leg down. But the beginners won't take the short because they're afraid it's a reversal. It's not. Computers don't trade on emotion, and you can only make money if you follow their logic. When I say they don't trade on emotion, there are some algorithms that look for certain words in Twitter or news feeds, which is a measurement of emotion, but in general, the vast majority of trades taking place are not based upon any emotion. I think this is a very important point. On any chart, any time frame, any market, 90% or more of the bars on any chart are either in a trading range or a broad channel. That means that you can buy or sell at any point and make money if you manage your trade correctly. It usually means using a wide stop and scaling in, but it's possible. 10% of the bars on any chart are either in a strong breakout, like here, or in a relatively tight channel, like there. And a tight channel is a breakout on a higher time frame chart. When that's the case, you should only sell. So 10% of the bars in any chart are in a strong breakout like this, or in a tight channel, and you should only be selling. Certainly a strong breakout, 10% of the bars on the chart are in a strong breakout, you can only sell. Here, theoretically, you might be able to make money. Obviously, the market did not reverse up high enough for buyers to make money. And again, if the market's in a fairly tight channel like that, it's a breakout on a higher time frame chart, and I think traders should only sell. When did it begin a strong breakout? Once you have 3 or 4 consecutive bear bars closing on their lows after some kind of credible reversal, you should assume the market's always in short. Beginners usually lose until they can get free of emotions. It's very difficult to win until you're comfortable with constant uncertainty. And 90% of the bars on the chart, you are going to be certain. 10% of the bars on the chart, you look at it and say, oh yeah, 60, 70, 80% were going lower. But the rest of the time, 90% of the bars on the chart, you're never more certain than 60%, which means the traders taking the opposite side of a trade are never less certain than 40%. That means that 10% of the bars on the chart, the probability of the direction is 60% or higher. 90% of the bars on the chart, the probability of the direction up or down is going to be between 40 and 60%. Every now and then, if you're watching traders on television, they'll talk about what's the direction of the next 100 points, the next 100 pips, the next 100 ticks, or the next 10 pips, the next 50 pips. In other words, is the market going to go up 100 ticks before it goes down 100 ticks? Should I buy for a 100 tick move up and risk 100 ticks to the downside? Or should I sell for a 100 tick move down and risk to 100 ticks to the upside? I refer to that as the probability of an equidistant opposite move. Equidistant because it's X units one way before X units the other way. 100 pips up, 100 pips down. 1% up, 1% down. $1 up, $1 down. For example, at this moment, you don't see all this stuff yet, but at this moment, is it more likely that the market's going to go above that bar? You know the distance. If you sell here, your stop is above that bar. The distance to that line is the same distance here. So at this moment, if you had to buy and put a stop that distance below, looking for a test of that high, or sell, putting a stop up there and hoping for a reward equal to the size of your risk, what would you do? Would you take the buy or take your sell? Well, we're always in short. Once we've had this third consecutive bear bar, always in short. Always in short means it's probably going down. And therefore, the probability is greater that you're going to reach a measured move down from the high to your entry than it is that it'll get to your target. The stop for the bears is up here. Their reward is here. If someone buys here, they're looking for a new high. Their reward is here. And a reasonable stop would be an equidistant move down, so their stop is here. This is the risk for the bears and the reward for the bulls. This is the reward for the bears and the risk for the bulls. I think on the close of this bar, the market reversed always in short. In other words, the probability of making money shifted in favor of the bears. And at this point, if you were forced to buy or sell, you have a much better chance of making money if you chose to sell and putting a stop up there. Once it's always in short, it's easier to make money selling. For example, here we're always in long, it's easier to make money buying. At this instant, would you make more money putting a stop down here, going for a profit equal to the height from your entry price to the stop, Or would you make more money selling here, putting a stop that distance above, expecting the market to fall below the bottom of the breakout? It's more likely that we're going up. Here, the market's always in long. Here, the market's always in short. It's probably going to go here before it hits that stop. I talked about equidistant targets. Now, what about the probability of different size opposite moves? For example, moving X units one way before moving Y units the other way. For example, a computer might estimate the probability of the market going up 0.1% before it goes down 0.13%. Computers obviously want to maximize their profit. When the probability of an equidistant move favors the bears, the system designers are going to try to determine what the best profit target is. It might be better than simply 1 times risk. A bear selling here, here's his risk. This is the same distance, so this is 1 times risk. However, that is not necessarily the best target. The market may fall quite a bit more, especially once you start to see another breakout and another follow-through bar. Computers can make these calculations quickly, objectively, unemotionally, and it's too complex for traders to do. I would not worry about the perfect math. Good math is good enough. As long as you do something that makes sense, it does not have to be perfect. And when you're trading, you cannot focus too much on the math, trying to get every little penny that you can out of the market. It's better to just do something that makes sense and then concentrate on managing the trade properly. Keep asking yourself, is my premise still valid? Is my trade still good? If it's not, then you get out. If it is, you continue to hold your position, and you think about moving your stop, tightening your stop, and adjusting your profit target, making it bigger, making it smaller, depending on what you're seeing. Some algorithms are designed to take more profit when the probability is high, instead of just trying to take profit at 1 times risk. It does not matter what you do, as long as what you do results in a positive trader's equation. In general, 1 times risk is the minimum that you want on any trade, but it's rarely the best. Usually you can get more. This would be a better zone for taking profits, and it could be 2 times risk, it could be 3 times risk. I said before that probability and risk reward is a trade-off. If you're waiting to enter when the probability is high, the risk-reward ratio is going to be worse. On the other hand, if you want trades that have very big profit potential, the probability is going to be less. A high probability trade always comes with a bad risk-reward ratio, because there always has to be a reason for someone to take the other side of the trade. For example, if you're buying and you have a very high probability of winning on your particular trade, the institution taking the other side has a very low probability of winning. There has to be a reason for him to take the trade, and it's going to be he has a very strong risk-reward ratio, and you have to have a very bad risk-reward ratio. Sometimes you can structure a trade with a probability of 80% or more. However, that always means your risk is going to be small compared to your reward, and that you're scalping. Most traders cannot make a living doing that, but I've known many extremely good scalpers over the years who do extremely well doing that. It's just very difficult for most traders to do it. And remember, it's not simply that you can do it, you have to be happy doing it. And there are very few people who can both be profitable and happy as scalpers. We have a strong bear breakout, good-sized bear bars closing on their lows. It's a sell climax, probably a pullback soon. However, when a breakout is this strong, almost certainly you're going to get at least a small second leg down. This could be the second leg down. This whole thing probably was the second leg down. Let's say you sell the reversal up, expecting that it's a minor reversal and a bad buy. It is. Look how many bear bars. And the only bull bar we have, it has a very tiny bull body. This has a very high probability of failing and becoming a bear flag. If a trader sells above this bull bar, betting that the bull reversal is going to fail, his stop at a minimum is at the top of the sell climax, just above the top of the sell climax. He could also put a stop up here if he wants. Both are okay, but this is an acceptable location for a stop. And let's say he exited right here on the test of this low, on this big bear close. The math on that is actually decent. Your actual risk was small. Your reward is at least twice as big as your risk. And you ended up with a small profit, a scalp. The initial risk was about 3 times the size of the reward. He sold at this high, got filled here, and this is where he took his profits. The initial risk was 3 times the size of his reward. If a trader takes this trade consistently, he has to win 80% of the time just to break even. Do you think it's an 80% bet selling the high of this bar? So if you see this trade set up 10 more times, you take it and expect to win 80% of the time? You probably will manage the trade incorrectly. You'll probably diagnose the setup incorrectly, selling trades that are actually going to be good reversals and not minor reversals. It's too easy to lose money. You have to win a very high percentage of the time, which means you have to do a lot of things right. You have to analyze whether or not the trade is acceptable. You have to decide if the premise is still reasonable. You sell this high and then fill it on this bar, and once the bar closes, you look at that and say, I don't know, I was hoping for a big bear bar on this bar when I entered, and I did not get it. Should I continue to hold? Just too many decisions to make, and it's very hard to do all of them well. To be a profitable scalper, you have to do all of them well, because you need a very high winning percentage to make a consistent living, a good living as a scalper. And therefore, traders should not be doing this. I'm looking at charts all day long, and at every tick, every pip, if it's a Forex chart, I see obvious support or resistance or both. If I'm looking at any point on the chart, let's say this point on the chart, I can see where support and resistance is. Resistance is going to be where I'm going to put my stop, somewhere above, and support is going to be an area where I'll look to take profits. High probability of making money if I sell here and I manage my trade correctly. High probability that I can make as much money as I have to risk. In general, if you see a strong breakout like that, you know you're probably going to make money. A 60% chance you're going to make a reward equal to the size of the breakout. Either the high or open of this bar to your entry price here, 60% chance in general, it's going to fall at least that same distance. So let's say you put your stop right above here. And let's say it's 15 ticks if it's a E-mini chart or a stock chart. Or if it's a Forex market, let's say it's 22 pips. Measured move down is here. And if it's the E-mini or a stock, you would get your 15 ticks before your stop was hit. If it was the Forex market, it would have fallen 22 pips and you would have received 22 pips profit while risking 22 pips initially. 60% chance when you took that trade that the market would reach a target equal to your risk, reward equal to your risk. Whenever I'm looking at a chart and I'm trying to assess probability, the only time I'm confident of the probability is during a strong breakout when the context is good. When I see this strong breakout in a bear trend like this, I'm very confident that we're going to go lower, probably a measured move down based on the close of this bar to the open of this bar. And when I say very confident, that means I believe the probability is at least 60% that it's going to fall to a measured move down before it gets to the stop above. Anytime I say, oh yeah, it's probably going down, I have to be 60% certain or more. If I'm less than 60%, I usually will not say, oh, it's likely to happen, or it's probably going to happen. I might say, oh, it's maybe a little bit more likely than not, but it's not all that clear. However, if I look at something and I say, yeah, I'm pretty confident that it's going down, I assume the probability is 60% or greater. If you plug the data into the trader's equation, a reward equal to risk and a probability of 60%, that gives you a positive trader's equation. And that means that if you take any trade and you look at it and you say, oh, it's probably going down, you can go for a reward equal to your initial risk. And it's a mathematically good way to trade. High probability, you don't need a fantastic risk-reward ratio. All you need is a reward equal to your risk to have a positive trader's equation. When the market's in a strong bear trend like this, you can sell for any reason. You can sell bear closes all the way down. You can sell bull closes betting that the first reversals up will fail. You can sell strong bull bars in a series of bars as long as you think the reversal up is still only a bull leg in a trading range or a bear flag, which this is. And you can sell below bars. You can sell below this bar and get filled here, below this bar, get filled here. Use the correct stop, either here or here. You can sell with limit orders, a 50% pullback from this breakout. From this high to that low, 50% pullback. You can sell with a limit order right there. You can sell with a limit order above this bar. You can sell with a limit order above this bar. Here's a small double bottom. And you can bet that the breakout above the double bottom will not get very far. So you can place a limit order to sell at this high and you get filled right there. It doesn't matter what reason you use to sell. You next have to analyze where is a logical place for the stop. The top of the sell climax, the top of this bear breakout is a good place. You could also put a stop up there. And you know how far your entry price is. If I sold here or if I sold here, I can figure out how many ticks or how many pips I'm risking, and then I should set my target, my profit-taking target, at that same number of ticks or pips, knowing that I'm looking at this and I'm saying, yeah, it's probably going down. That tells me that I'm at least 60% certain that it's going to go down for a move equal to my risk, and therefore I have a good location for taking profits. We're in a bear trend. We have a wedge bear flag here, low 1, low 2, low 3, and now we have either a low 1 or you can call it a double top bear flag with this high and that high. Most double tops are not at the same level. And let's say you wanted to sell below a bear bar, so you sell right here. Where should you put your stop? In general, above the top of the most recent major lower high. Is this a major lower high? No, a major lower high has a strong breakout and usually a new low. This is, I think, a major lower high. This is clearly a major high. This is a reasonable place for a stop, but most traders selling down here probably would want a tighter stop, for example, above the top of this most recent bear breakout. High probability that the market's going to go down, and your stop is here. Let's say your stop is 13 ticks above the entry price, if it's a stock or the E-mini. On the other hand, let's say it's the Forex market and it's 18 pips above. It doesn't matter. Whatever that distance is, you're looking at a high probability trade, and therefore you can go for a profit target that is equal to your risk. Here's a measured move down from the stop to the entry price. This is the measured move down. If it was a stock, I said this could be 13 ticks, then your target is 13 ticks. If it's a Forex market and this was 18 pips above your entry price, then your target is 18 pips below. You look at this and you know the market's in a bear trend, 60% certain it's going to go down at least as far as your risk. Therefore, selling below this bear bar, getting filled here, putting a stop here, a reasonable stop, has a 60% chance of reaching this profit target. I talked about a Z-score, which is a mathematical way to measure how good your system is. In general, if you're testing a system and almost all of the profit comes from 1 or 2 trades, that is a bad system. You want a high winning percentage and you want rewards that are fairly consistent. You don't want all of your profit to come from 1 or 2 trades because the risk of blowing your account, ruining your account, being unable to trade without putting more money in the account then becomes high. All traders are always choosing between a trade with high probability or a trade with strong risk reward. You simply decide which is more important to you. Of the variables, probability, risk, and reward, risk and reward are always known. You know where your stop is. You know where you want to take profits. Probability is not always known. However, 10% of the bars on the chart, the probability is 60% or higher. For example, a strong breakout. 90% of the bars on the chart, the probability for a bull or for a bear is going to be between 40 and 60%. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 5 videos on the trader's equation and probability. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the 4th of 5 videos on the trader's equation and probability. I want to start by talking about the importance of a 50% pullback. Also, the math for a trade can improve after there is a breakout. We have a bull trend, decent breakout, and then a pullback. Because there's a strong bull trend, if there's a 50% pullback, there's the low of the bull trend, there's the high of the bull trend, here's a 50% pullback. There's a 60% chance of at least testing the high before hitting a stop if a person were to buy that 50% pullback. A bull trend means it's more likely that the market will continue higher. Obviously, if it reverses all the way to just above the bottom of the bull trend, the probability that it will get back to the top is small. But as long as it's pulling back to about 50%, there's a 60% chance that it will get here to the top of the bull trend before it gets here to the bottom of the bull trend or just a little bit below and hit a protective stop. Many bulls will place a limit order to buy a 50% pullback. Most would not get filled here. It usually has to fall below the limit order to get filled, and they would get filled on this bear bar. Other bulls prefer to buy on a reversal up from a 50% pullback. Here we have about an 8-bar bear microchannel. A lot of bulls would wait for a second entry buy, and here they have a bull body. They would buy on the reversal up above that bull body. A micro double bottom, a second entry, here's the first entry there. These buys have a 60% chance of leading to a rally up to here before a sell-off down to here, because what preceded this sell-off was a bull trend. Buying here, it's halfway to the target and halfway to the stop. It's a little bit further to the stop because the stop is just below the bottom of the bull trend. The reward up to the high is equal to the risk down to the stop, maybe a little bit more to the stop. Strong momentum up, so the probability is that the market's going to go up here before it'll come down here. And because of that, bulls buy at a 50% pullback. The reward is equal to the risk, but the probability is 60% or higher. That is the basis for traders buying 50% pullbacks from strong trends. The bulls got a breakout and there's a double top. It broke below the neckline of the double top in a very strong sell-off. 5 consecutive bear bars, this one being very big, closing far below the low of the past 50 or 60 bars. The odds are traders will sell a 50% pullback. Bears who are short, for any reason, selling down here, selling a 50% pullback. It doesn't matter. Their stop is above the top of the bear trend, up here. The minimum target for the bears, whether they sell the close, sell the 50% pullback, or sell below the reversal bar, down and get filled here, is down here, a new low in the bear trend. The risk to the stop is about the same as the reward to the target, the new low. Yet, because the sell-off was so strong, there's probably a 60% chance that the market is going to fall here before it's going to go there. Risk is equal to reward, but probability is maybe 60%. Therefore, selling a 50% pullback in a strong bear trend is a very good thing to do, a very good trader's equation. Often when you get a 50% pullback, the momentum up is so strong that you think that the market is reversing into a bull trend. However, as long as it does not get much above that 50% pullback, chances are this is a bull trap, trapping inexperienced bulls into buying too high when the market is still in a bear trend and this is simply a pullback, 2 legs up, 1 pullback 2. Look at the bad follow-through after the strong bull bar and the tail on the top of the bull bar. This is simply a test of this breakout point and a test of the 50% pullback. Chances are the market's going lower even though there's a strong bull bar. Bears who short here, the distance to their target, their reward, is the same as the distance to their stop, their risk. But the probability of making their reward is maybe 60%. Even though the risk is equal to the reward, the probability makes this a very favorable trade, a very positive trader's equation. We have a strong sell-off, maybe about a 10 or 15 bar bear microchannel, no bull bars in about 10 or 15 bars. Traders will sell a 50% pullback. Some will place a limit order at 50%. This is 50%. They'll sell with the limit order. Others will sell on a reversal down. When you have a strong bear trend and a pullback to about 50%, there's a 60% chance the market is going to test the bear low before there's a rally up to the top of the bear trend. In this particular case, the stop is 1 tick above the top of the bear leg, and that's 4.75 points above, and the reward is 4.5 points below. This is a positive trader's equation. Reward equal to risk. Actually, the risk is one tick bigger because the stop is one tick above the top of the bear leg, and the probability is 60%. Stop above the top of the bear leg. Some traders will simply place a limit order to sell a 50% pullback and put a stop above the top of the bear leg. Others will sell a reversal down or a second entry short or a third or fourth entry short, looking for a test of the bear low. Since the probability is 60% that the market will get here before it gets here, since it's a bear trend, there's a 60% chance of making 10 ticks before losing 10 ticks, 20 ticks or 30 ticks before losing 20 or 30 ticks, and a move down to the bear low before moving the same distance up to the bear high. The trader's equation is positive. In general, when you have a high probability trade, the risk-reward ratio is bad. In other words, the risk-reward ratio is maybe 1 to 1. That means that the reward is usually not bigger than the risk or not much bigger than the risk. It usually means either a big risk or a small reward or both, or reward equal to risk, not much bigger than risk. Even if you sell this for a scalp, you have a positive trader's equation. Let's say you're looking to scalp for 1 or 2 points and use a stop of 1 or 2 points. Chances are, if you enter at a 50% pullback, any number of ticks down, let's say 7 ticks down, you'll get there before it goes 7 ticks up. 15 ticks down before it goes 15 ticks up. In general, it's better to take this as a swing trade, looking for a test of this low and putting your stop up here. That is the most reasonable stop, the top of the bear trend. This is the euro versus the dollar, a 5-minute chart. And there's a strong reversal, strong bull breakout, 3 consecutive bull bars. A lot of traders will place a limit order to buy at a 50% pullback or on a reversal up. Because the trend is strong, if you buy a 50% pullback, there's a 60% chance that the market will get to the top of the bull trend and test the bull high before it falls below the bottom of the bull trend and hits a stop just below that low. In this particular case, it's 32 pips to this high and 32 pips to that low. The stop is 1 pip below. There's a 60% chance, approximately, of reaching that high and making 32 pips before it hits a stop below this low, 33 pips below. Even though the reward is equal to the risk and is not twice the risk, the 60% probability of success makes the trader's equation positive, and therefore, mathematically, it's a good trade. The stop is just below the bottom of the bull leg. Bulls will either buy with a limit order at a 50% pullback or on the reversal up. Very often when you get a 50% pullback in a reasonably strong bull trend, the sell-off is so strong it looks like the bull trend is failing and it's reversing. However, the odds are that if you take the 50% buy, you're going to make money, even if the reversal down is strong. Reasonably strong bull reversal, 60% probability that you make 32 pips before your stop is hit 33 pips below. In fact, you could make much more than 32 pips. In this particular case, the trader would have made much more before losing 32 pips. Therefore, the reward is much better than simply 1 to 1. Swing bulls will buy this 50% pullback, put a stop down here, and they'll just hold until their premise is no longer valid. Maybe they'll get out here, maybe they'll get out here. And if they do, their reward is much bigger than their risk. That's an even stronger trader's equation. Here we have a bull leg. It's 52 pips tall, and we have a pullback that's 28 pips down from the high. Strong enough bull breakout probably will test that high. Buying with a limit order at a 50% pullback, a trader has a 60% chance of testing the high, making 26 pips, before the market goes down and hits the stop, 1 pip below the low, 27 pips. Therefore, a bull buying here has a 60% chance of making 26 pips before losing 27 pips. That is a positive trader's equation, and therefore, mathematically, it makes sense to take the trade. Stop is below the bottom of the bull leg. Some traders place the limit order to buy at 50%. Other traders buy a reversal up. Here we have a high 2 buy, high 1, and then a second entry, high 2. Whenever you have a 60% probability, you have a high probability trade. That means that you have bad risk-reward. Bad risk-reward means that you have a reward that's small relative to the risk, or a big risk. In general, anytime the reward is less than 2 times the risk, I call it a bad risk-reward ratio. But I often take trades where the risk-reward ratio is 1 to 1. The reward equals the risk, if the probability is 60% or higher. Even a scalp has a positive trader's equation. For example, if you buy this and place a stop 10 pips down, looking to take a 10 pips profit, chances are 60% that you'll make money. What about buying this and putting a stop 13 pips down, looking to make 13 pips? We're in a bull trend. Chances are you'll make a reward equal to your risk, as long as your risk is no more than this stop below the bottom of the bull leg. It doesn't matter if it's 5 pips, 10 pips, 15 pips for the risk, and 5, 10, or 15 pips for the reward. 60% chance you'll make your reward before your stop is hit. Many traders like to enter early because the risk is less and the reward is greater. Other traders prefer to enter after a strong breakout, when the probability is higher. The math can actually be better after a strong breakout. Here we have a trading range, and the bulls are trying to get trend resumption. Bull trend, trading range, bull breakout. 3 bull bars here, a bull bar here, closing above the top of the past 50-bar trading range. The context is good for trend resumption up. The market's in breakout mode. We have 3 bull bars here, and now we have a pretty good sized bull bar. 60% probability, maybe even more, that a trader buying that close will make a reward equal to or greater than the risk. He would put a stop either below that low or below this low, and 60% chance he'll make his profit before his stop gets hit. So let's say a trader buys the close of that bull breakout bar. He can put his stop 1 tick below the bottom of the bull breakout bar. The market usually will not fall below the bull bar if it's going higher. Sometimes it'll pull back below that bull bar and continue up. Most of the time, if it's going higher, it will not fall below the low of that breakout bar. In this particular case, if you buy that close and you put your stop below, your stop is 8 ticks below your entry. Since you're risking 8 ticks to below the bottom of the bull bar, your minimum reward should be 8 ticks above. And the breakout is strong enough so that there's a 60% chance if you buy that close, you'll hit this profit target before you hit that stop. Therefore, the trader's equation is good. Let's say you chose not to exit and instead looked at this as a swing trade. This is where you would have exited. This was your 8 ticks profit target. But let's say instead you held long. As the size of the breakout grows, so does the size of the target. For example, let's say you bought the close of this bar. Now your stop is still here, but your target is a measured move base from that close to this low, and your target is now here. Some bulls keep buying closes. The stop is still down here. But since this is a reasonable breakout entry, chances are 60% the market will go for a measured move up before it hits the stop below the bottom of the bull breakout. If you buy that close, your stop is still here, but now you have a 60% chance of making a 14 tick profit. Your stop is now 14 ticks below that close. So 60% chance if you buy this close, you're going to get there and make 14 ticks before it hits your stop down here. The bulls who bought this close and held, and now the market is here, they have a 60% chance of making 14 ticks above this close, which is 20 ticks above their original close, while risking only 8 ticks. They bought that close, their stop is still 8 ticks below their entry price, but now that we have this close, the market has a 60% chance of getting here. So these bulls have a 60% chance of making 20 ticks before an 8 tick stop is hit. So excellent trader's equation at this point. The math is getting better as the breakout continues. We have another bar in the breakout. Some bulls will buy that close, stop down here. The breakout is strong. 60% chance the market will go a measured move up from this close to that stop before it gets to that stop. The stop for these bulls is 23 ticks below the low of the bull breakout, and therefore they have a 60% chance of the market going 23 ticks higher before it goes 23 ticks down. Very good trader's equation for buying that close. They buy that close, and their new target is 23 ticks above, 60% chance it'll get here before it hits their stop down here. What about the bulls who bought this close? Well, their stop is still 8 ticks below their entry, but now their target is 38 ticks above their entry. So they have a 60% chance at this point that they'll make 38 ticks while risking only 8 ticks. They bought this close, and as the breakout continues, their reward gets much, much better, but their risk stays the same. And the probability stays the same. Once we're at this close, 60% chance measured move up. Once we're at this close, 60% chance measured move up. The risk stays the same, the probability stays at 60%, but the reward grows. As the breakout continues, the math gets better and better for the bulls who bought that first close. The bulls who bought here, their minimum target is here, equidistant to their stop, 23 ticks. They could get out right here and have a positive trader's equation. Reward equal to risk, probability when you buy here, 60% that you'll get to your target before the market hits your stop. You can see the tail above the pink line, and that means there was some profit taking from the bulls who bought that close. The bulls who bought this close never had more than an 8-tick risk. Their risk was always to just below the bottom of the bull breakout. No matter how big the breakout went, that's where their stop was. Once you have a major high or low, a reasonably strong breakout to a new high, they might raise their stop, but certainly their initial risk was only 8 ticks, yet their reward was way up here. Once we had this close, they had a 60% chance of making 38 pips. And you can see some traders took profits here. That's what caused that tail. This is a 60-minute chart of the dollar versus the Canadian dollar. We're in a bear trend, a very tight bear channel, very few bull bars, and they're all small. Now we're getting a bear breakout, a big bear bar, closed below the low of the past 50 or 60 bars. Probability is we're going to go lower, at least to a reward as big as the risk. Strong breakout, good context. That means high probability, 60% or more, that traders selling this close will make a reward equal to their risk. Even a scalper going for a small reward has a 60% probability of making a reward equal to his risk. For example, if he's scalping for 12 ticks while risking 11 ticks, 15 ticks while risking 15 ticks. 60% chance he'll reach his target before his stop is hit. That's the minimum goal. Most traders should still swing trade and try to get a reward at least 2 times their risk. A trader could sell this close, maybe put a stop just above the top of the bear leg, or stop above the top of the bear breakout. If this is going to be a successful swing down, it should not get to the top of this bear bar. If you sell that close and your stop is here, just above the high of the bar, you're risking 19 pips. Because the breakout is strong and the context is good, 60% chance it'll fall 19 pips from your entry before it rallies 19 pips to your stop. Sell that close, stop up here, 60% chance we're going to fall to this level, a target equal to the risk. Tight channel, a breakout on a higher time frame chart. Some traders instead will sell this close. Their stop is still above the top of the bear breakout. Their risk is greater, but there's still a 60% chance the market will fall for a measured move. Therefore, their profit is greater as well. A sell the close bear trend, so bears keep selling closes. They don't sell every close. Some will sell this close, others sell this close, others sell this close. No matter which close you sell, 60% chance the market will fall for a measured move from your entry to the stop. The stop is still 1 pip above the top of that bear breakout, even if you sell here. But the bears who sold here are now risking 34 pips. They have a 60% chance that the market will fall 34 pips before it hits that stop. Here's the minimum target. The bears who sold here, they're still only risking to this line, which is 19 pips. These bears are risking 19 pips. Since there's a 60% chance at this point that we're going to fall here, the bears who sold here now have a 60% chance of making 49 pips while risking only 19 pips. As the breakout continues, the math for these bears gets better and better and better. Their risk stays the same, but their reward continues to grow as the breakout grows. These bears should not be too quick to take profits because their target keeps getting further and further away. The reward continues to grow as the breakout grows. It's still a sell-to-close bear trend, a bear microchannel, no pullbacks since over here. Reasonably strong breakout. Some bears will sell that close, and their stop is above the top of the bear sell climax, which is 1 pip above this bear bar. Their stop is 59 pips above their entry. They sell here, stop here. They're looking for a measured move down, 59 pips below, and because the breakout is strong and the context is good, they have a 60% chance of the market falling 59 pips down to here before it rallies 59 pips up there. The bears who sold here, their stop is still only 19 pips. But once the market is here, there's a 60% chance of it falling here. These bears now are risking 19 pips and have a 60% chance of making 99 pips. As the breakout continues to grow, their probability stays 60% that they'll make a measured move based upon the current close to the stop, and their risk is still here. So their risk stays the same, the probability stays the same, but as the breakout grows, their reward gets bigger, and therefore selling here and holding as the breakout continues, you improve your trader's equation. The math gets better. Strong reversal up at the measured move target based upon the last close of the sell-to-close bear trend. That tells you that a lot of traders took partial profits, maybe full profits, at a measured move down from that close to where the stop is. You can see when the market got there, there was a lot of buying. And a lot of that buying is bears taking profits, and some of it is from bulls knowing the bears will take profits, so the bulls buy for a scalp. The bears who took the first short and held never had more than 19 pips risk. Their stop was above the high of that initial big bear breakout. When they initially sold, they had a 60% chance of making 19 pips before a stop was hit. At this point, they had a 60% chance of making 99 pips before their stop was hit. I began by talking about the importance of a 50% pullback in a strong trend. If you're in a strong trend and you have a 50% pullback, chances are 60% or higher, the trend will resume and test the extreme of the trend. For example, in a bull trend, it'll test the high before it hits the stop below the low. If you're entering in a strong breakout and you hold as the breakout continues to grow, your math actually improves. Your probability stays at 60% of a measured move profit. Your risk remains the same, but as the breakout grows, the measured move target grows, and that means the reward grows as well. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the fourth of 5 videos on the trader's equation and probability. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the 5th of 5 videos on the trader's equation and probability. Believe it or not, every trader is 90% certain that they will reach their profit target. And I think that's interesting, and most traders do not think about it. But when the market gets very close to your target, your stop is far away, yet you continue to hold your position and rely on your stop. You can only do that if you're 90% certain that your target will be hit before your stop will be hit. I think it's really important to understand the 40 to 60% rule. During 90% of the bars on any chart, traders can buy or sell at any time and make money if they manage their trades correctly. Finally, I want to talk about the probability within a trading range. It's high for the bears near the top. It's high for the bulls near the bottom. Let's say you bought a 50% pullback from this bull breakout, and you're looking to take profits on a test of the high. Your stop is below the bottom of the bull breakout. And let's say you have a limit order to take half off if the market gets back to the high. Let's say the market is racing up as it did, and it hits your limit order, but did not go above your limit order. Usually the market has to go at least a little bit above your limit order before it gets filled. But the instant that it hits your limit order, you're usually not filled. Think about that. The market usually has to go at least one tick above or one pip above the limit order before you get filled, before you can sell for a profit. Yet, what do? The market just hit your limit order, you're not filled. You're going to hold for a few more seconds at least to see if you get that one additional tick or pip that goes above your limit order so that your order will be filled. Yet, your stop is still all the way down here or maybe here. So you're risking far more than 10 ticks or 10 pips to make that final one tick or pip. You can only hold on to your trade if you believe that the probability of making that one tick or pip is at least 90%. Otherwise, you cannot risk down to here or down to here to make one tick or one pip. You need that 90% certainty to have a positive trader's equation. And that means that on almost any trade where you have a limit order to take profits, at least briefly, you are 90% certain about the probability of making a profit. Whenever the probability is very high, the risk reward has to be terrible. There has to be an institution willing to do the opposite of what you're doing. If your reward is only one tick or one pip and your risk is 10 ticks, 10 pips or more, obviously that's a horrible risk-reward ratio. However, a horrible risk-reward ratio goes hand in hand with a very high probability of success. Usually when you have a very small profit target, you have a very high probability of success. The opposite of that is also true. If you have a very tight stop, you have very low risk, you're always having a very low probability of making a profit. So tight stops usually lose. Small rewards usually win, but your risk is big. Let's go back to this bull. It just hit his limit order and it's not yet filled. It needs to go one tick or one pip higher for him to get filled. Yet his stop is here or here. The reward at this point is only one tick or one pip if it's a Forex trade, yet the risk might be 10 ticks, might be 20 or 30 ticks or 20 or 30 pips. You're a rational trader. A rational person can only do that if he's very confident that he'll get his profit before his stop is hit. And that means that you have to be at least 90% certain that you're going to make your reward before your stop is hit. And that means that on almost every trade, at least briefly, you're 90% certain of something. When the market gets to your limit order and does not yet fill it, and you continue to hold your position, yet your stop is far away relative to your reward, you have to be 90% certain that you'll get your reward before your stop is hit. Let's say that your risk is greater than your reward. Let's say you're using a wide stop and you're scalping. Most traders cannot do that because they have to win 70% of the time just to break even. And therefore, most traders cannot profitably scalp day after day, year after year. As a result, most traders should look for swing trades. A swing trade, a reward at least twice as big as your risk. That is the single best way for traders to become consistently profitable. Some traders can comfortably scalp for their entire careers, but that is a very small number. The vast majority of profitable traders cannot scalp profitably, and they cannot do it comfortably. A lot of very experienced traders can scalp, but they hate it. They're stressed out, it's not fun, and they don't do it. They would rather swing trade. These are all reasonable scalps, selling below here for a scalp, buying above here for a scalp. These are all selling, buying, 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 buying. On a chart with about 70 or 80 bars, there are 8 or 9 obvious scalps. There are actually many more if you include limit order scalps, but most traders cannot take all of those trades, and they certainly cannot be happy trading taking all of those trades. If you look at it, it looks like a good day. You sell, you buy, you sell again, you buy, and you end up with a lot of profitable trades. However, a lot of those traders, especially if they're beginners, if they took this sell, they probably would have taken that buy and this buy, and they would have sold here, and they would have bought here, and all of these gold boxes were losers. And that's the problem with scalping. It's easy to look at a chart and find all the winners. If you're trading it real time, you would have taken a lot of these losers as well, and they would have more than wiped out all of your wins. Remember, if you're scalping, you have to be 70% profitable or better to make a living doing that. Again, there are some traders who do that. I know a lot of traders who win 90% of the time. They're very profitable scalpers. That's unrealistic for most traders. Most traders have to swing trade to be consistently profitable. These blue boxes are the winners, and a beginner who took those scalps probably took a lot of the gold boxes. He would have had 8 winners, 8 blue boxes, and he would have had 12 losers, the 12 gold boxes, and he would have ended up losing money by the end of the session. An experienced trader can make money scalping during a strong breakout, and many will scale in lower. You can see the video on scaling in. For example, we have a strong breakout here, a buy climax. Traders will buy the close of a strong bull trend bar. They can buy any of these closes, but let's say a bull bought this close. His initial stop is below the bottom of the major high or low, the bottom of the buy climax, the bottom of the breakout. Remember, every trend bar, every series of trend bars is a breakout and a climax. This is the initial risk. The trader was willing to risk all the way down to below the bottom of the bull breakout. A lot of traders will buy more lower. If they do, they want their second entry to be at least a scalp below the first. That's because many will get out when the market gets back to their first entry. They get out break even on their first entry and then with a scalp profit on their second entry. Other traders will continue to hold for a reward equal to at least 1 times their actual risk. If a trader takes this buy, buys more here, and the market starts to turn up, he might raise his stop from here to here. And his actual risk then would be from his entry price to below the low of this bar. His actual risk might be less than that depending on when he entered. If he entered with a limit order here, the market traded down to here and reversed up, that means his actual risk was to just below the low of that bar. This is his actual risk. If he buys here, and his actual risk is here, he's in a bull trend, he has a 60% chance of making at least a reward equal to his actual risk. Some bulls will buy here, some will add on here, some will just continue to hold long, and they'll get out at 1 times their actual risk. And because the probability is 60% or higher that a bull buying here will make a reward equal to his actual risk, it's a good trader's equation. Buy here, whether or not you add on here. If you buy here and the market starts to go up, your actual risk was right here. You have a 60% chance of making at least that reward if you exit at that point. Even though you're taking profits at only 1 times your actual risk, the trader's equation is positive because you're buying in a strong bull trend. There's a 60% chance that you'll make a reward that is equal to your actual risk. And with a risk-reward ratio of 1, if the probability is 60%, the trader's equation is positive. You often hear me talk about the 40-60 rule. When I talk about the 40-60 rule, I mean that 10% of the bars on any chart are in a strong breakout, and there's more than a 60% probability that the trend will continue. On the other 90% of the bars on the chart, the probability is really not all that clear, and the setups are not as strong as you want them to be. For any trade during 90% of the bars on any chart, there's a 40 to 60% probability of the market moving X units in one direction before it moves X units in the other direction. 90% of the time on any chart, the market's in either a channel or a trading range. Only 10% of the bars are in a strong breakout on any chart. When the market's breaking out strongly, traders should only go in the direction of the trade. Strong breakout, only buy, only buy, only buy, only buy. If the market's not obviously in a strong breakout, then it's either in a channel or a trading range. And that's true for 90% of the bars on every chart. When that's true, the probability for the bulls and the bears is always going to be between 40 and 60%. Buying or selling, the probability is never worse than 40%. Buying or selling, the probability is never better than 60% that you'll make X units before you lose X units. 10 pips, 10 ticks, up or down. 25 ticks, 25 pips, up or down. 40 to 60% chance. Strong, successful breakouts with decent follow-through are rare and they're brief. They don't last all that long. And during those times, the probability that the market will continue in your direction, at least a little bit, is high, more than 60%. 90% of the bars on the chart are not in strong breakouts. And during 90% of the time, inside these blue boxes, the probability is going to be 40 to 60% for the bulls and bears, usually between 40 and 50%. You never have to know the probability exactly, and that's because of the trader's equation. Most traders should be swing trading, and that means they should be going for a reward at least twice as big as their risk, and they only need a 40% probability for that to be a profitable trade. And since 90% of the bars on the chart, whether you buy or sell, you have at least a 40% chance of making a profit. If you go for a reward that is at least twice as big as your risk, you have a profitable strategy. During the green boxes, you have better than a 60% probability the market will continue in that direction. During the blue boxes, your probability is 60% or less, but it's not less than 40%. The green boxes only trade in the direction of the trend. Blue boxes, you can make money buying or selling as long as you go for a reward 2 times your risk. That risk-reward ratio results in a positive trader's equation even if the probability of success is only 40%. That's very important to know. That tells you that 90% of the time, you don't have to worry about the probability. Just assume that it's at least 40% for buying or selling, and as long as you go for a reward at least twice your risk, the math is good. You have a positive trader's equation. Buying or selling anywhere in here, or in here, or in here, you have at least a 40% chance of making a profit if you go for a reward twice as big as your risk. You determine what your risk is by placing your stop, and as long as you go for a reward that's at least twice as great, you're going to have a positive trader's equation, even if you win only 40% of the time. Therefore, 90% of the time when the market is not breaking out strongly, always go for a reward at least 2 times your risk. That compensates for whatever low probability you have, and it results in a positive trader's equation, and it's a profitable strategy. Your probability is never going to be less than 40% buying or selling during 90% of the bars on the chart. When you're in a strong bull breakout, you should not sell. You should only buy. At the times when you're not in a strong breakout up or down, you can buy or sell and make money because you know the probability of buying or selling is going to be at least 40%. Remember, you can buy or sell, and that means both the bulls and the bears can have a positive trader's equation. The probability of most swing trades is only between 40 and 50%. And that's true of a trader swing trading in the opposite direction as well. If you're buying, 40% chance you make money for a swing trade, and the institution taking the opposite side of your trade, if it is swing trading as well, it only has a 40 to 50% chance of making a profit, or making a reward 2 times the risk. Both of you have a good trader's equation. Both the bulls and bears can lose more than 50% of the time and consistently make money, as long as their reward is at least twice their risk. Since you can buy or sell during 90% of the bars on the chart, the key to making money is money management. You have to use a reasonable stop, reasonable risk, and you have to try for a reward that is at least twice as big as your risk. That good risk-reward ratio overcomes the low probability. Remember, your probability is always at least 40%, but often it is only 40%. If you have a reward that is at least twice your risk, if that's your target, that overcomes the low probability and keeps the trader's equation positive. Here we're in a bear channel. We have 4 pushes down. 1, 2, 3, 4. So it's a high 4 buy. You can look at it as consecutive bottoms. So we tried to get a bottom here, but we have a bear breakout. And we tried to bottom again, and then a second attempt at a bottom. And this is a micro double bottom. Down, up, down, and then trying to go up. Chances are the market's going to have 10 bars, 2 legs, sideways to up after a high 4 buy at the bottom of a channel. We have consecutive complex bottoms. We tried to bottom 1, 2, tried to reverse up. We got a bear breakout, tried to bottom again. 1, 2, complex bottom, 2 attempts up. A bear breakout, complex bottom, 2 attempts up. We have a micro double bottom as well. Probably going to get at least 10 bars, 2 legs, sideways to up. TBTL, 10 bars, 2 legs. We sold off in a wedge, 3 pushes down, 1, 2, 3. And we're trying to reverse up at the signal bar high over here. And we have a decent bull signal bar here and a micro double bottom with also a good bull bar. We have a micro double bottom with a good buy signal bar here and another good bull bar here. This is a reasonable buy, looking for at least a small second leg up. It's also a higher low major trend reversal. Bear trend, strong bull breakout to a higher low, and a wedge bull flag, 3 pushes down, 1, 2, and then 3. The bulls got their minimum goal. They have a second leg sideways to up. Here it's mostly sideways. Yet look what's happening now. We have a potential triangle, 3 reversals down, 1, 2, and 3. The bears have a good signal bar and a decent entry bar. The bears also look at this as a double top, lower high. A double top, the second high is a little bit lower. It therefore is a low 2 sell signal below the low of this bear bar, getting filled right here. As is always the case when the market starts to go sideways, there is a decent buy signal and a decent sell signal. In this particular case, the bulls who bought here probably have to exit. They have a double top, lower high, and a good sell signal bar, and they have their second leg up. Because the bears have a reasonable sell signal, a triangle, and a bear trend, and a decent sell signal bar, and the bulls got their second leg up, the bulls exit, and the bears will sell, looking for a swing down. And the bears got their swing down. Here we have a bull trend, a bear break below the bull trend, and we have a lower high and another lower high. The bears have a decent sell setup for a swing down, a lower high major trend reversal, even though we're still in a bull trend. In addition, they have a small double top, and this double top is a lower high. So it's a double top, lower high major trend reversal. That's a common pattern in a tight trading range. When you have a tight trading range and there's a double top and a lower high, sometimes it's a higher high, but usually it's a lower high. It's a reasonable short, 40% chance you'll get a swing down. For the bulls, this is a bull trend, a bear breakout, but this is a bull flag. This is a breakout of the bull flag, and this is a pullback from that breakout, and it's creating another bull flag, small bull trend, and then a double bottom, this low, that low. The market's been sideways for about 50 bars. There's always going to be a reasonable swing setup for the bears and a reasonable swing setup for the bulls. The bears who sold here or here, they will get out above this bull bar. We have a decent bull bar here, and then a second entry here. The bears will give up and the bulls will buy. We have a bull trend, a bear reversal, but it's a bear channel, a bull flag, and then we have a bull breakout, and this whole bear channel is a pullback from this bull breakout. And now we have a high 2 buy and a higher low. The market's still always in long. The bears get out and the bulls buy, looking for a swing up. There's also a small triangle. Whenever there's an II, this bar is inside that bar, this bar is inside that bar, and this bar is inside that bar, so it's an III. It's always a triangle on a smaller time frame chart. You don't have to look. You just assume whenever you see an II or an III that it's a triangle on a smaller time frame chart, and therefore a breakout mode pattern on this chart. It's a nested triangle. We have a reversal down, a second reversal down, maybe a third reversal down, maybe a third reversal down here. So it's a large triangle, a nested triangle, a small triangle, and a bigger triangle. It does not matter if you call this a triangle or a tight trading range. The implication is the same. If the market goes sideways for 20 or more bars in a pullback, the pullback is a trading range. Here we have a pullback lasting 20 or 30 bars. Now it's lasted 50 bars, 60 bars. 50% chance the bull trend will resume up. 50% chance you'll get a reversal down from the higher low major trend reversal. I've taught thousands of traders how to trade using price action. And if everybody knows it, how can it work well? Because everything looks easy until you're actually trading it with real money. And the margin for error is very small, and every little mistake works against you. And therefore, it's very difficult to trade consistently well. You can do it, but it takes practice. And those who understand price action better, those who manage their trades better, have a better chance of making money. Even the best analysis is only going to be right 60 to 70% of the time, and you're competing against the smartest people in the world. You often hear traders talk about trading as a zero-sum game. In other words, every dollar lost by you is made by me, or vice versa. It's not entirely true. You have fees, you have slippage, you have other costs, overhead costs like bid-ask spread, so it's not exactly zero-sum. Also, the world economy has been growing since the beginning of the world economy, and therefore more dollars are going into the economy, and therefore it's not a zero-sum game. The pie keeps getting bigger. But over the short run, a day, a week or so, it is a zero-sum game. Because over the short run, it is a zero-sum game, all you have to do is be better than the average trader to consistently make money. You can study a great trader. Warren Buffett is probably the greatest trader of the past 50 years. And you could watch him every minute of every day for a year and then try doing what he's doing on your own, and you'll still lose money because it takes a lot of experience. You could watch someone play the violin for a year and then try to play the violin, and you'll sound terrible. It just takes a lot of experience. Soccer as well. There's a big difference between knowing how to play soccer and knowing how to play it well enough to make a living, to have people pay you to do it. So it does not matter if everyone knows basic price action. Can they apply it, and can they manage their trades well? That's the difference between making money and not making money. If you ever play poker, every player quickly decides who the weakest player is. That's the easiest person from whom you can take money. They're going to lose all the time. That person is the mark. In general, if you're playing poker and you don't know who the mark is, then you're the mark. You're the person everyone's trying to take money from. In trading, if you don't know price action well enough to understand who's going to be trapped in a trade, you'll soon discover that it's you. You really have to understand price action to trade profitably. It's really important, whenever you take any trade, to believe that the exact opposite of what you believe is going to happen at least 40% of the time. Because that's true. The probability is always 40 to 60% during 90% of the bars on every chart. And therefore, no matter how certain you are that the market's going to do something, there's at least a 40% chance that it's going to be the opposite. The market was in a bear trend here. The bears can argue a nested wedge, 1, 2, 3, a bigger wedge, 1, 2, and then 3. You can call it a double bottom, 1, 2, and a decent bull bar, and it's a second entry buy. A decent bull bar here. It triggered by going above that. Now we have a second entry buy. And a lot of bears will exit here. The channel is tight. They know the reversal is probably minor, and it will result either in a bear flag or a trading range. We're going sideways. The bulls are hoping that this is a bear trend, bull breakout, and a double bottom, higher low, major trend reversal, or a head and shoulders bottom, left shoulder, head, right shoulder. Again, it's reasonable to exit there as well. Another attempt at a double bottom or a higher low major trend reversal and a good bull bar. You can call it a triangle if you want. 3 reversals up, 1, 2, 3, in a horizontal trading range. Good traders, if they get trapped out of a good trade, are always looking to sell again. The market stayed always in short all the way down, and therefore, if a bear exit, he needs to sell again below a bear bar, so he'll sell below that bear bar. If he exit here, he's going to sell below a bear bar, either below that bear bar or that bear bar. And the same here, if the bear exits above that bull bar and the market does not become always in long, it's still always in short, he has to sell again below a bear bar, like below that bear bar or below that bull low. A good trader is not going to let himself be trapped out of a trade for long. If the market is still always in short and he exits and he wants to trade always in, he wants to stay in the market all the time, he has to sell again below a bear bar. And the opposite is true in a bull trend. In a trading range, the probability is high for the bears near the top and high for the bulls near the bottom. The market is clearly going sideways here, and at some point you decide this is the upper half of the range, this is the lower half of the range. In general, you want to buy low, sell high, and scalp. If it's in the top half, it's better to look to sell. If it's in the bottom half, it's better to look to buy. And it's also better to look to take quick profits, scalp, because chances are the market's going to stay in the range. The probability for making money is higher in the upper half if you're a bear looking to sell. And the probability for profits is better for the bulls in the lower half. Buy low, sell high. Bears make money selling in the upper half, bulls make money buying in the lower half. In the top third, the probability can be very high for the bears. For example, if you're looking to make X number of ticks or pips, there's usually a 60% chance that you'll get your target before your stop is hit if the stop is just as far. So 10 ticks or 10 pips, looking to sell in the upper third, 60% chance you'll reach your 10 or pips or 10 ticks profit before a 10 ticks or 10 pip stop is hit. Doesn't matter, 10 ticks, 15 ticks, 27 ticks, 27 pips up, 27 pips down. In the upper third of a trading range, taking the bear side has a 60% chance of making money. On the lower third of the trading range, taking the bull side has a 60% chance of making money. For example, buying in the bottom third, looking for a 10 pip scalp and risking 10 pips, 60% chance you're going to make money. The middle third, it's 50-50 chance that buying or selling, that you'll make X number of pips or X number of ticks before you lose the same amount. So for example, buying or selling anywhere in the blue, in the middle third of a trading range, and you're looking to make 10 ticks or 10 pips buying, risking 10 ticks or 10 pips below, you have a 50-50 chance that the market will reach your target before it hits your stop. I talked about high probability and how every trader is 90% certain of making money, at least briefly during every trade. When the market hits their limit order and they need only one more tick or one more pip to make money, their stop might be 10 ticks or 10 pips away. They can only hold on to that trade if they are 90% certain that they'll make money. And most traders would hold at least after the first test of their target. The 40-60 rule, during 90% of the bars on every chart, the probability is always at least 40% for any buy or any sell, and it's never greater than 60% for any buy or sell. A good trader can make money buying or selling during 90% of the bars on a chart if he manages his trade correctly. When the market's in a trading range, the probability is high near the top for the bears and high near the bottom for the bulls. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the 5th of 5 videos on the trader's equation and probability. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 4 videos on swing trading and scalping. In this video, I want to define what I mean by swing trading and what I mean by scalping. A swing trade in general is any trade where you're going for a reward that is at least twice as big as your risk. I think swing traders have a different personality from scalpers, although scalpers sometimes swing part of their trade and swing traders sometimes scalp. In general, I think it's 2 different mindsets. I think the vast majority of profitable traders are swing traders. It takes a very special and unusual personality to be a successful scalper. Most traders should not be scalping. We have a good bull breakout, 4 consecutive bull bars, 3 good-sized bars closing on their highs. This is a reasonable buy for both a scalper and for a swing trader. If they buy, they could put a stop right below the low of this bar. It's a second entry buy, leg 1, pullback leg 2. The first leg has a reasonable buy here and here as well, but this is a second attempt at trend resumption up, and it's around a 50% pullback. The initial risk is to below the bottom of the signal bar, and the traders buy just above the high of the signal bar. So they get in here, their initial risk is here. It's a fairly high probability trade, and therefore traders have a positive trader's equation if they exit with a reward simply equal to their risk. A scalper buying here, stop here, can then get out here, a reward equal to his risk, and have a positive trader's equation. Some scalpers might hold hoping for more, and some of those scalpers will then get out on a reversal down below the low of this bar, and they'll get out right here. They're concerned, maybe we've got a double top, lower high, and a swing down. A scalper wants high probability of a profit, and that means a quick profit, and they do not want pullbacks, or they only want brief pullbacks. In return, they're willing to accept small reward. Any trader who wants a high probability trade is going to be taking a small profit. That is the trade-off. There always has to be a reason for an institution to take the other side of the trade. If you get high probability, you get small reward and generally relatively big risk. In other words, a bad risk-reward ratio. In general, a scalper needs a probability of 60 to 90% that the market is going to reach his reward before it hits his stop. Also in general, the reward is about the same size as the risk. In other words, a risk-reward ratio of 1, which is not very good. Most traders need to be going for a reward that is at least twice as big as their risk if they're going to be consistently profitable. The scalper gets out here. The swing trader holds on to his trade until the premise is no longer valid. For example, until there's a reasonable reason for bears to take a short. Possible final flag, the biggest bull bar, 20 or more bars into the trend, probably a climactic end of the trend, a bear bar closing on its low. This is a reasonable location to exit longs, thinking that either the market is going to enter a bear trend or it's going to go sideways and evolve into a trading range. The premise of a bull trend is now much lower, so it's reasonable for a swing trader to get out here. If he does, his reward is many times bigger than his initial risk. A scalper will often trade a minor reversal if he thinks the reversal will be far enough down for him to make a profit. It has to be at least the minimum scalp size, and if he thinks the probability is high enough to offset the risk. Remember, a minor reversal means that the trend is likely to continue or at least evolve into a trading range and not become an opposite trend. A minor reversal is small, and a scalper only needs a small profit. The scalper will often trade against a trend if he thinks the minor reversal will be at least big enough for a minimum scalp. For example, here we have a series of buy climaxes here, here, and then 2 bars here, and then here. And this is a very big bar, breaking above the top of the bull channel. A scalper will often sell below the low of that bear bar. It's a decent bear bar closing near its low, looking for at least a test of the bottom of the most recent buy climax bar. He'll take that short as long as the distance between his entry price and that bottom of the buy climax bar is at least as big as a minimum scalp, and if he thinks the probability is high enough to offset the risk. Bulls and bears expect a couple legs down after a parabolic buy climax. It's also up to around a measure move up from this low to this high. We have a bull breakout here. However, they also expect the bull trend to resume after the pullback, either to here or to here, and therefore the reversal is minor. The bear who takes that short typically would put his stop above the bear bar. The top of the bull trend is only a little bit higher. He could put his stop above the top of the bull trend as well. He's looking for the market to test the bottom of the final buy climax bar, the biggest bar in the trend, the breakout above the bull channel. He'll take his profit there. A swing trader will often hold on to his position despite minor reversals, because a minor reversal by definition means that the trend has not changed. The trend is likely to resume. For example, here we have a bull bar, another bull bar, and then we have a pair of bull bars breaking above a trading range, and we have a bull follow-through bar. A lot of bulls will buy that close, expecting that even if we reverse down here, there'll be at least a second leg up. If he buys here and it pulls back, he can buy more here. It'll test back up here. He can get out break even on his first entry and with a profit on his second entry. We have a pullback. It started after one more bar. A bull breakout of a bull channel and a decent reversal bar. It's probably going to pull back for a couple legs. One, pullback, two. Tight channel. It could be the first of a more complex pullback. One, pullback, two. In any case, any bull buying here believes this is a minor reversal and that either the reversal down will lead to a trading range, which it did for about 30 or 40 bars, or a resumption of the bull trend, and therefore he's willing to buy, not exit on the minor reversal, and simply rely on his stop. Again, a minor reversal means that it'll be a pullback, in other words, a bull flag, or at worst, a trading range. In either case, he can avoid a loss by scaling in. Even if he had bought this high close right here, he could rely on his stop and then buy more either above this bull bar or above this bull bar. And then when it gets back up to his original entry price, had he bought the high close, he could get out break even on his first entry and with a profit on his lower entry. Here, late in the session, we have another reversal. However, the bulls are losing momentum. We're getting a lot of doji bars. A horizontal trading range late in a bull trend often becomes the final bull flag. We have the biggest bull bar occurring more than 20 bars into a bull trend. Here we have the biggest bull bar in about 50 bars. It's probably an exhaustive end to the trend. And it's also a nested wedge. Different ways to count the three pushes. 1, 2, 3. 1, 2, 3. Therefore, this has a pretty good chance of being a major reversal, leading either to a trading range or an opposite trend. It's a good location for the bulls to exit. Minor reversal, many bulls will hold long if they buy here. Major reversal, the bulls will exit and bears will start to short. When there's a major reversal, traders expect either a bear trend or a trading range. A minor reversal in a bull trend, traders expect either a bull flag and trend resumption or a pullback and a trading range. Some swing traders will exit when there's a minor reversal if they think the minor reversal might in fact become a major reversal. For example, let's say a bull bought the follow-through bar from this breakout, and then he sees an even bigger bar breaking above the top of a bull channel, and he sees that it's around a measured move up. From this low to the top of what was a bear flag, we broke strongly above, and we went up to about a measured move, and then the market's reversing down. This might become a large trading range, and it could test all the way down to the bottom here. Some swing traders who buy here will exit here, knowing that it's probably going to either be a trading range or a bull flag, but they take that exit if they're willing to buy again when they think the bull trend is resuming up. For example, they might buy above this bull bar, high 1, high 2, or after a bigger test down to around a 50% pullback above a bull bar. This is where the always in bulls buy again. This is not enough to make it always in short, and therefore it's always in long. It's around a 50% pullback. It's testing the breakout point above this bear flag. It's a reasonable place to get long. The bulls who bought again here will exit up here toward the end of the session after a possible major trend reversal. Again, a bull who bought for any reason during this bull trend can rely on his stop, betting that the first reversal down will be minor and there'll be at least a small second leg up. Or he could exit on a reversal that he thinks might be major and then look to buy again on a resumption of the bull trend. I talked about several ways to distinguish whether a trade is a swing trade or a scalp. An important way is how a trader plans to manage the trade when he puts the trade on. If he's planning to manage it like a swing trade, and he holds on through minor reversals, he holds on for 10 bars, 20 bars, 30 bars, even if his profit is less than 2 times his initial risk or his actual risk, it's still a swing trade. If he's managing it like a swing trade, whether or not it's profitable at all, it's still a swing trade. For example, let's say a trader looks at this breakout and concludes it's very strong, and the first reversal down will probably be minor. He goes ahead and he buys the close of this bar. He knows its consecutive buy climaxes here, 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 and here. However, he assumes that any reversal down will be minor and become either a bull flag or a trading range, and therefore he's willing to buy and put a stop below the bottom of the bull trend. There's something special about this particular setup. It's a very strong breakout. Whenever you have a very strong breakout like this, there's a 60% chance that the market will rally for a measured move up from the open of the first bar to the close of the final bar of the breakout. Traders will often put a stop below the bottom of the breakout rather than all the way down below the bottom of the bull trend. This is reasonable. Whenever you use a tighter stop like this, the probability of success is less, but it's still, in this particular case, 60%. A very strong bull breakout, a series of bull bars. The market has a 60% chance of continuing up for a measured move based upon the open of the first bar to the close of the final bar, which would be somewhere up here, even if there is a pretty big pullback in between. If the market goes straight up here in just one bar and he exits, is it a scalp or a swing? Well, the reward is probably many times greater than the size of a minimum scalp, and therefore I would call it a swing. He went for a profit that would have been many times bigger than the actual risk, and I would call that a swing. So for example, if he buys here and it just goes straight up here, his actual risk would have been very tiny, and his reward would have been very big relative to that risk. That would be a swing. Even though he'd be exiting in only one bar, which is what a scalper does, he would be getting a swing trader's profit, and he had the intention to hold for many, many bars with the goal of reaching that measured move target. Look what took place up here. The trader held his trade for about 50 bars. He held through a fairly deep pullback, a 50% pullback, a minor reversal though. And now we have a potential final bull flag right below the target. It's fairly common when the market gets near an important target for the market to turn down before it gets to the target. Because this is a possible major trend reversal, a wedge, 1, 2, 3, or 1, 2, 3, a final flag, and the biggest bull bar more than 20 bars into the trend. In fact, this bull bar is bigger than all the bull bars for maybe 50 or 60 bars. Therefore, very likely to be an exhaustion bar. It's reasonable to get out here. Some swing traders will continue to hold with their stop below the most recent major high or low, with the intention of getting out near their goal. When you're this close to the goal, do you really want to continue to use a stop down here? I think most swing traders would not risk this much to make this little profit. However, it's reasonable to do. Instead, they would exit here, wait for a couple legs down, and then buy again above a bull bar here, looking for a test of this high or the market reaching the target. When the probability is high like this, 60% or more, traders do not need a reward equal to 2 times the risk to make a positive trader's equation. All they need is a reward equal to their risk. The trader who bought here, even though he's exiting with a reward 1 times his initial risk, if he put his stop here, he intended to hold for many bars. He intended to hold through minor reversals. He did here, 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 and he either got out here or he held all the way here. he was planning to manage the trade as a swing trade. He did manage it as a swing trade, and therefore it is a swing trade, even though the market did not reach a reward equal to 2 times his initial risk. His actual risk was below the low of this bar. If he bought here, the market turned down to here and went all the way up there. The most he needed to stay in the trade, in hindsight, was a stop right here. So he actually only risked from his entry price to just below the low of this bar. And this reward, I don't know if it's twice actual risk. Here's his entry price. Here's his actual risk. It's not quite twice his actual risk, but it doesn't matter. Traders would still call this a swing because he held for a lot of bars and he held through several minor reversals. Again, actual risk is just below the low of the deepest pullback after you entered the trade. The bears tried to get a reversal, but it's a higher low, and it's a breakout test of this high. The bears have a bear reversal and a follow-through bar, but bad follow-through here, and now there's a micro double bottom with another bull bar. This is a reasonable buy for a swing trader, betting that the bear reversal will fail and that the bull trend will resume. However, this is a strong enough reversal down with bear follow-through and a reasonable top, maybe a wedge, 1, 2, 3, maybe a final flag, and then an exhaustive buy climax, trapped bulls who bought above that bull bar. The probability of this trade is much less than the probability here. This has a much higher risk of the bull trend no longer being in effect. The market might now be in a trading range. We might get leg 1, pullback, leg 2. It might also be in a bear trend, bear spike, pullback, and channel. The probability here is less than the probability there. You're also buying at the top of a tight trading range, and breakouts tend to fail. So again, the probability is lower buying here. Yet, if you do buy here, you're hoping that the double bottom holds, that the market does not fall below the double bottom. It's reasonable to place a stop below the double bottom. Because it's a lower probability trade, a trader needs to compensate with good risk reward. So a trader buying here with a stop here has to be planning to exit with a reward that is at least twice as big as his risk. He buys above this bear bar or above that bull bar. Let's say he buys above this bear bar. He gets filled right here. His initial stop is here. This is 1 times his risk, and this is 2 times his risk. A reasonable location to take profits, especially since it's near the top of a possible developing trading range. Low probability trade, traders should go for a reward that is at least twice as big as their risk. They need a good risk-reward ratio to offset the low probability. Without that, you are not structuring a profitable trade. In other words, the trader's equation is not positive, and therefore you are not likely to make a profit. I have general guidelines that I use when I define what a swing trade is. For example, in the E-mini, if I'm swing trading, I'm going for a reward that is at least 4 points. If I'm trading in the Forex markets, I'm going for a reward that is at least 40 pips. If I'm trading stocks and it's a $100 stock, my minimum goal for a swing trade is at least 50 cents. When a swing trader takes a trade, he's hoping for a trend. And remember, a trend is a swing that covers at least half the bars on the screen. The minimum goal is 2 legs and 10 bars, but most swing traders are expecting at least 20 bars, and that is about 2 hours on a 5-minute chart. Also, the reward should be at least twice as big as the risk. It often is many times bigger. It's common for traders to take a trade and they're not sure if the profit will be a big scalp or a small swing. Most traders should only be taking trades if they feel like they can take it for a swing trade. These are all reasonable swing entries. We have a 2-bar bull breakout closing on its high after a series of other bull bars. Reasonable to buy here. Buy the close, reasonable to buy here. High 1 buy, high 2 buy, reasonable to buy. A more complex high 2, high 1, pullback, high 2. All are reasonable swing trades, and it's reasonable to use the same stop, either below the bottom of this buy climax or the bottom of the bull trend. The minimum reward for any one of those entries is based upon the distance to the stop. For example, you could buy here, stop down here, betting on a buy the close bull trend. If you buy here, stop here, 1 times risk is right here. It's reasonable to exit here because you're taking a high probability trade. If you're going for a swing instead, 2 times risk is up here. And you can see there was some profit taking here. This is where scalpers would get out. This is where swing traders would at least take partial profits. A scalp means that you're going for a reward that is less than twice your risk. Most scalpers take profits within 1 to 5 bars, and they prefer that the market not pull back, not reverse. For example, a trader might sell below the low of this bear bar and then scalp out. A trader might buy above this bull inside bar, betting on a little bit more up. A trader might buy this close. A trader might buy here. A trader might buy below that doji bar, betting after 5 bars up, there'll be buyers below. Here we have a bull II and a bull trend, so a trader might buy above that small bull bar. And they might buy this close after a bull breakout bar. You could buy below this bear bar, even though it's 3 pushes up, 1, 2, 3, it's about a 15 bar or 10 bar bull microchannel. The odds are the first reversal down will fail and will become a bull flag. Or you can buy above this inside bar. It's a small high 2, high 1, high 2. Or you could also call it a wedge bull flag for trend resumption up. And we have a strong bear breakout and strong bear follow through. Probably you'll get at least a small second leg down. A scalper will sell the high of this bear bar and get filled right here. This looks pretty easy to do, but it's really not. And beginners should not be scalping. And most experienced traders prefer not to scalp because it's hard to do and it doesn't suit their personality. Any scalp is a reasonable swing trade. And all of these are reasonable scalps, and they're also reasonable swing trades. Even selling here is a reasonable swing trade, although it turned into a loser. If you are scalping, it's easier to make money if you can use a swing stop and scale in. For example, if you're scalping, and let's say you bought here, it's better if you're able to use a stop down here or down here, and then buy more lower. For example, the size of a scalp lower, or the size of 2 scalps lower, or on a reversal up, as long as this entry is at least as big as a scalp below your first entry. The traders who do buy here and buy more here will often try to get out break even on their first entry, and then with a scalp on their second entry. Therefore, they want that second entry to be at least the size of a scalp below their first. If you are a scalper and you're using a wide stop and you're scaling in lower, it increases your probability of success, but it also increases your risk. You therefore have to be trading a very small position, at least initially, and you have to have the temperament that allows you to have a trade go against you. For example, if you buy here, are you able to hold long when the market is doing this, relying on your stop here or here? If you're not, if it causes too much stress, you cannot be doing that long term. That's not a career type of trade for you, and therefore you should not be taking that trade, at least not for a scalp. A swing trader would be much more comfortable buying here and putting a stop here or here, trusting that the odds are the market's going to have a second leg up. A scalper, on the other hand, is going for a very small profit, and he's very concerned about a risk that becomes greater than his reward. If you're unable to trade that comfortably, if you have too much stress, you cannot be doing that type of trade. And that is one of the main reasons why most traders should not be scalping as their primary source of income. It's just too hard to do emotionally. It's not fun for most traders. Most traders do not like to do it. It's too stressful. When the market's clearly always in long, and it is all the way up here, a swing trader can buy at any time and for any reason. However, he has to use the correct stop. And the correct stop is always below the bottom of the most recent strong leg up. In other words, the most recent higher low. Here we have a higher low, not yet a major higher low, but after you start to get a strong rally, especially a rally to a new high, this becomes a major higher low. No matter where you bought and for whatever reason you bought, once the market is up here, traders will put their stop here. If it was here or here initially, they'll trail it, they'll move it up to here. And the same here. No matter what reason you use to buy, all through here, once you have a strong breakout, traders will see this as a major high or low, and they'll move their stop here. If you're buying anywhere in here, once the market is here, traders are going to tighten their stop to either here, the bottom of the most recent breakout, or the bottom of the most recent leg up. Swing traders are going for a reward that is at least twice as big as their risk, and they allow pullbacks. For example, if you buy here, the market pulls back further, you're still holding on to your position. Even though this is a pretty good bull bar, and the market fell below it, swing traders will still hold long because their stop is probably down here. They allow pullbacks, and they expect to hold on to the trade for at least 10 bars. Most swings last at least 20 bars, and therefore swing traders are willing to hold for a long time through a lot of pullbacks. If you're holding on to a trade that's going to last 20 or 30 bars, you're going to have pullbacks, and some of them are going to be pretty big, for example, like this. After every strong breakout to a new high, traders tighten their stops. The market goes up here, you raise the stop to here. Whether it was here or here, you raise it to here. Now we have a strong breakout here. The stop is now here or here. That's called trailing your stop. Scalpers can only take a trade if they believe the probability is 60% or greater. And they want that probability to be 60% without scaling in. They're willing to scale in, but when they take the trade initially, they believe they're taking a high probability trade, a trade that has a probability of at least 60%. These are reasonable trades. Buying here, 60% chance the market is going to go up for a reward equal to the risk. Buying here, 60% chance it's going to go up at least as big as the risk. And when the probability is high, you can swing or scalp. The probability is high for a scalp, not high for a swing. Buying here, it's a high probability trade for a scalp, not necessarily a high probability for a swing. And that's the same here. You know it's a high probability that it's going up for a scalp. You hope that it's going to go all the way up here. It's only a 40% probability that you're going to get a swing. Any entry is only a 40% probability of a swing trade. But many entries are a 60% probability of a scalp trade. Here's an example on the 5-minute E-mini chart. If your stop is 8 ticks away from your entry price, then your risk is 8 ticks. If the reward is 16 ticks or more, twice the size of the risk, I call that a swing trade. If the profit is less than 16 ticks, I call it a scalp. Here we have a double bottom in a bear trend. Pretty good buying here, and you have a good buy signal bar. So let's say a trader buys here, betting on either a scalp, betting on a trading range or a bear flag, or possibly even a bull trend, a reversal. If he buys here, his stop is going to be below the buy signal bar, and in this particular case, it's 10 ticks below his entry price. He entered 1 tick above the high of that bull bar, and his stop is 1 tick below. If he exits here, he has 10 ticks profit, and that's 1 times his risk. That is a scalp. It's a high probability trade. I think this is certainly good enough for a scalp, but it's also a reasonable swing trade. If he exits here, 2 times his risk, I would call it a swing trade. And obviously, if he exited below here or below here, that would also be a swing trade. The minimum goal for a swing trader is at least twice his risk. When he buys here, he has a 60% chance of the market going here, and maybe a 40 or 50% chance of it going here, and probably less than a 40% chance of it going all the way up here. If it does, this is 3 or 4 times his risk. That is a great risk-reward ratio. So for example, if he exits here, a wedge, 1, 2, 3, testing near the high, you have a bear bar, you have a second leg up, strong enough breakout here for at least a small second leg up, and now it's reversing down. If he exits below this bear bar, he gets filled here. This is 38 ticks profit, which is far more than twice his risk, and therefore buying here and exiting here is a swing trade, just like exiting here is a swing trade as well. This is a 5-minute chart of the British pound versus the dollar. Most Forex traders don't refer to trades as swings or scalps. They call everything a trade. I use the term swings and scalps. Traders who do refer to trades as scalps are trading on 60-minute charts or smaller. and a scalp is between 10 and 50 pips. All other trades are simply trades. I usually distinguish swings and scalps because I tend to think of them differently. We have a pair of bull bars breaking out. We have a potential high in a trading range, or maybe there was a bear trend here, and maybe this is a bear flag. In either case, we're getting a pretty good breakout, a pair of big bull bars. It's reasonable to buy this close. It's a high probability buy for a scalp, and it's a reasonable buy for a swing trade. Swing trade, with a breakout like this, maybe 50% chance you'll get twice your risk, and maybe 40% chance you'll get more than twice your risk. If a trader exits here, he has 40 pips profit. Is it a scalp or is it a swing? If you're exiting here, I'd probably call it a scalp. You're exiting without any pullback, and you're exiting maybe around twice your risk, maybe less than twice your risk. If a trader exits here, he has 80 pips profit, which is clearly far more than twice his risk if his stop was here or here. And he sat through a pullback, another pullback attempt, and he has 2 legs up. Minimum goal for a swing trade is 10 bars and 2 legs. If you buy here, you have 1 leg, pullback, 2 leg, and you have more than 10 bars, and you have more than 50 pips profit. All of those things are enough for me to call that a swing trade. In this video, I talked about swing trading and scalping. A scalper is going for a quick profit. He's usually going to exit within 1 to 5 bars, and he does not want to allow more than simply a small pullback. A swing trader is going for a reward at least twice as big as the risk, and in general, he's looking for a trade that will last 20 or more bars. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 4 videos on swing trading and scalping. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 4 videos on swing trading and scalping. In this video, I want to focus on the importance of going for a reward that is at least twice as big as your risk when you're swing trading. For example, here's that British pound versus the dollar 5-minute chart. And you have a breakout bar here and a follow-through bar here. It's reasonable to buy that close. If your stop is 1 pip below the bottom of the breakout, you're risking 29 pips. If a reward is 60 pips or more, in other words, twice the risk, the trade is a swing trade. If you're going for a reward that is less than 60 pips, you could call it a scalp. Stop 1 pip below, and you bought that close. This is 1 times your risk. If you exit here, it's a scalp. Here's 2 times your risk. If you exit here, it's still a scalp. You did not allow a pullback. You exited on the first pullback, and you're going for a reward that is less than twice your risk. On the other hand, if you exited up here, possible parabolic wedge, 1, 2, 3, or 1, 2, 3, and you have a bear bar closing on its low after a small buy climax, you would be exiting with 80 pips profit. Your initial risk was 29 pips. 2 times your initial risk is 58 pips, and this is more than 58 pips, more than 2 times your risk. To me, that's a swing trade. Plus, you exited with 2 legs up, 1 pullback, 2. And you held on for more than 10 bars. You held on for about 20 bars. Most swing traders hope to get trades that last 20 or more bars, but their minimum goal is 10 bars and 2 legs. This is a 60-minute chart of the British pound versus the dollar. In general, on a 60-minute chart, if you're going for a trade that's less than 50 pips, I call it a scalp. On a 5 or 15-minute chart, I call a scalp anything that is between 10 and 40 pips. Anything more than that is a swing trade or simply a trade. Again, a swing trade has at least 10 bars and 2 legs. Usually, a trader is going for at least 20 bars. Here we have 3 very big bear trend bars, and you can call it a wedge, 1, 2, 3, at the top of a broad bull channel. You can also call it a wedge, 1, 2, 3, or 1, 2, 3. In any case, strong reversal down, and we're closing below a lot of bars. This is probably the start of a swing trade down. 3 consecutive big bear bars closing near their lows, strong bear breakout, good context. The odds are high that you're going to get at least a measured move down. High odds mean at least 60% chance that you'll get a measured move down. It's reasonable to sell that close. putting a stop above the top of the bear leg or above the top of this 3-bar sell climax, and you take profits down here. This is 90 pips below your entry price, and therefore it's a swing trade, or you could simply call it a trade. Also, it lasted more than 10 bars, and it had at least 2 legs, 1 pullback, 2. Scalpers hate pullbacks. Sometimes they'll hold through what they think will be a minor pullback, but in general, they don't want reversals. They don't want pullbacks. Let's say you buy here, around a 50% pullback of this buy climax, this breakout, 2 legs down, 1 pullback, 2. You can also call it a wedge. There's a bear bar, a doji bar, a big bear, a doji bar, and then another low here. Let's say the trader bought above the high of this bar, hoping for a wedge reversal up, and he put a stop just below. Very small risk, but you can call it a high 2 bull flag, a wedge bull flag. Whenever you're trading with a very small risk, you in general have a low probability of success. I think it's reasonable to take this buy for a scalp. The risk is very small. If you did buy above this bar and got filled here, stop down here, you have dojis here, tight trading range. Maybe you'll allow the pullback, hoping for a little bit more up. Most bulls who did buy above this bar or above this bar will not exit. They'll probably either rely on a stop here or possibly a stop down here. The market got up and tested a prior lower high and reversed down below there. At this point, a lot of bulls will exit either below that bear bar or a second entry short below that bear bar because they'd be concerned about a double top lower high and a reversal down. The bulls who buy here, who did not exit here, now have a second reversal down, so low 1, low 2, and a bear bar. A lot of those bulls will exit here for a scalp. Another example, bear bar, bull bar, bear bar, bull bar. So 2 legs down, 1, 2. If you want, you can call it a high 2 bull flag, high 1, high 2, or 1 push down, 2 pushes down, high 2. You can even call it a wedge. 1 pullback, 2 pullback, 3. Doesn't matter. It's a tight trading range after a strong bull breakout. It's a reasonable buy. You have a good buy signal bar. You can buy above that high for a scalp, put a stop just below. You have a small pullback, but you're still in a tight trading range, and it did not hit your stop. Most bulls would hold long and rely on their stop. Maybe they hold long after this breakout, despite this pullback. A lot would exit below this second reversal down, but many would hold and get out up here. A big bull bar, a buy climax. And if you're looking for a quick profit, you're getting a gift, a big bull bar closing on its high and a new high. We have a strong bull breakout, and then a second leg, and then a third buy climax. So buy climax, buy climax, buy climax, buy climax, with 3 highs, possible parabolic wedge top, and you have a bear bar closing on its low. Some swing traders will take this short, others will wait until there's a strong bear breakout and then short. But it's reasonable to sell below that bear bar, and you get filled right here, and you put a stop above its high, a parabolic wedge top. Strong bear breakout with 2 bars. The second bar is the follow-through bar, confirming the bear breakout. The odds are now high that there'll be a second leg down. Traders will keep their stop above here. This is a major high that led to a strong bear reversal. Chances are, even if we rally like this, a couple legs up with decent bull bars, the market will get at least a small second leg sideways to down before it hits that stop. This pullback went above your entry price. Remember, you sold here, and the pullback went above your entry price, but it did not hit your stop. Most bears would continue to hold short. However, if you did sell here and you held short even though the market went above your entry price, and then you got another strong leg down, bears do not want the market to come back to their entry price a second time. Many bears would then move their stop to break even, or they'd simply put their stop above the top of this strong bear breakout because this is a major lower high. Traders do not want the market to come back to their entry price a second time after there's a second strong leg down. First leg down, second leg down. And you can see this reversal up did not get back to the entry price a second time. After the second leg down, traders either put their stop above the top of the bear leg, above the top of the sell climax, or even break even. Remember, a bear trend needs lower lows and lower highs. Lower highs are more important because bears exit if the market goes above a major lower high. If it goes above a major lower high, then they think the bear trend has ended and the market has either evolved into a trading range or possibly even reversed into a bull trend. Strong reversal up, high 2, bull flag, bull trend, first leg down, pullback, second leg down. So this is a high 2 bull flag, strong reversal up. Swing traders will hold short. A lot of them will hold short, relying on their stop, hoping that this is a broad bear channel that continues down much further. Strong bull breakout, but bad follow through. Strong bull breakout, bad follow through. This might be a broad bear channel. Usually, even though it's 3 pushes down, 1, 2, 3, and therefore a wedge bull flag, bull trend, wedge bull flag, with the bad follow through, we're probably going to get a trading range before an attempt at a bull trend resumption. 2 decent bull bars, bull bar closing on its high. It's reasonable to buy this for a possible swing up. We have a bull trend, a wedge bull flag, a bear channel, bull flag, and the sell-off is not all that strong. We have a pair of bear bars, but 5 or 6 bars up with a lot of bull bars. A bear bar and a follow-through bar, another bull bar. A pair of bear bars, dojis, and a big bull bar. This looks like it'll be a bear leg in a trading range or a bear leg that becomes a bull flag. Now we have a strong bear breakout that looks like it's failing. It went above this bull bar, and then we have a second entry buy. This is a reasonable buy for a wedge bull flag and possibly a swing up. Different ways to draw the wedge, 1, 2, 3, or 1, 2, 3. A little bit more than a 50% pullback. For the bulls who did buy here and who decided to hold for a swing, looking for a second leg up, leg 1, pullback, leg 2, some of them would hold and put a stop below the bottom of the bull trend, and they'd view this strong sell-off as simply a breakout test of the buy signal bar. Also a micro double bottom and a strong buy signal bar. If the bulls did buy here for a swing, this reversal down fell below their entry price. However, if there's a second strong breakout, the bulls do not want it to come back to their entry price a second time. Some bulls would exit on a second reversal down, leg 1, leg 2, betting that maybe we'll be in a trading range instead of a bull trend. Remember, this bear channel might be evolving into a trading range. It's big up, big down, big confusion, and chances are the market's going to go sideways. Trading ranges often have 2-legged moves, 1 pullback 2. It's reasonable for the bulls who bought here to exit below here, thinking that it might be simply 2 legs up in a trading range and the end of the rally. If a trader did not exit here, he probably would exit back at his entry price because we have a strong trend resumption up. He does not want the market to come back to his entry price a second time. This turned out to be a minor lower low, just a little bit below there, but you do not want the market to come back to your entry price a second time after it resumed up. If you do get stopped out, it's perfectly reasonable to buy again. Now we have a double bottom bull flag with a decent buy signal bar. However, most traders should get out when it hits the entry price a second time after the bull trend resumed. Again, if it comes back to your entry price a second time, the odds are you're going to be in a trading range and not a bull trend. And in a trading range, you want to be scalping, not swing trading. Reasonable to get out here on the break below this low and the test of the original entry price. But if you did exit, as I said, it's reasonable to buy again above a good bull bar because now you have a double bottom higher low and possibly you'll get a breakout above the neckline and rally for a measured move up. So double bottom, this low, and neckline here. The market sold off again, 3 legs down, 1, 2, 3. Does not matter that the market went to a new high after that first leg down. That's common when you have a bull trend transitioning either into a bear trend or a trading range. There's a transition period when the market is both in a bull trend, in other words, you can keep going higher, and in an early bear trend. So the bear trend often begins before the bull trend ends. 3 pushes down, 1, 2, 3. We have a micro double bottom. We tried to go up here, we went down, tried to go up again, and we have a bigger double bottom with this low. This is a support area. They bought here again. We're testing that price again. It's reasonable to take this buy. The buy signal bar is a doji bar, so it's not as strong as it could be, but it's still a potential wedge bull flag and a double bottom bull flag. Bear trend, bull breakout, double bottom, higher low, major trend reversal. You can also call it bull trend, bear reversal to a big double bottom, higher low, major trend reversal. You could also call it a big double bottom bull flag. You have a bull trend and then a pullback into a big double bottom, so it's a big high to buy. On a higher time frame chart, it could simply be a few bars down. On this time frame, it's 30 or 40 bars here, 30 bars here. Now we have 3 lows, 1, 2, 3, in a horizontal pattern, a trading range. It's also a triangle, and traders would buy this as a reversal up from the bottom of a triangle. Different computers see patterns differently. If there are many different patterns all with the same entry price, there's a higher probability that you'll have a profitable trade. Strong bull breakout. We have 4 or 5 consecutive bull bars, 2 of them big bull bars closing on their highs. Strong breakout of a bear channel. A bear channel is a bull flag, and we have a strong breakout. The market came back below the entry price. It's a breakout test, a test of the top of the buy signal bar, but it did not hit the stop, so traders are still holding long. Strong enough breakout. This is probably now a major higher low. Traders do not want the market to fall below this low. Also, they do not want the market to come back to their entry price a second time. You can see the bears tried to get it here, and it tried to get down to the entry price here. Both times failed. Many bulls after this rally would move their stop to break even, because if the trend is good, it should not come back to that entry price a second time. The bears tried to get a double top bear flag, tried to get a strong reversal down, and as strong as the reversal down was, it failed to hit the entry price, and you can see the bears giving up on this bar and the bulls becoming confident that we'd go up for at least a measured move. We have a double top and a neckline. Instead of breaking below the neckline and falling for a measured move down, we're breaking above the top. Traders expect at least a measured move up from the neckline to the double top and then up here. Small trend bar. Every trend bar is a breakout. Every trend bar is a climax. And here is a series of trend bars, a sell climax, climax, sell climax, sell climax, small sell climax, sell climax. You have consecutive sell climaxes, but on a higher time frame chart, for example, if this is a 5-minute chart, this is the 240-minute chart, here's that sell-off, here's this sell-off. It's simply a test of the bottom of a trading range. At this price level, the market reversed up here. It came down to the price level again, reversed up. It came down to that general area, reversed up. And this could simply be a sell vacuum test of support, where the bulls bought 3 times before. 1, 2, 3. On the 5-minute chart, this looks like a very strong bear trend. But it's consecutive sell climaxes, which usually result in a trading range or a reversal. And it's also at the bottom of a big trading range on a higher time frame chart. And if you want, you can call it a micro wedge. 3 pushes down, 1, pullback, 2, pullback, 3. And a larger wedge, 1, 2, and then 3. Second entry buy, first entry, second entry. It's a reasonable, aggressive buy for bulls looking for a swing up. If they buy above this bull bar, reasonable to put a stop below the low of this bear bar, betting that the support at the bottom of the 240-minute trading range will hold. Very tight bear channel, first reversal up minor, which usually means you'll enter a trading range, either here or here. Higher probability to buy above this bull bar. We have a reversal up and now a higher low, probably going up for a second leg, and probably we'll get to the top of the most recent big sell climax, this high. Strong enough up here or here, the market's probably always in long. It still could be a lower high in a bear trend, but at this point, probably always in long. It's a complex rally. We have a pullback, we have a pullback, we have a pullback, and a pretty tight channel. Probably it's the first of two larger legs up. So leg one, a complex pullback, and then leg two. Scalpers are going to be pretty quick to take profits. For example, we have two legs up, one pullback, two. A scalper would get out here or here. Three pushes up a wedge, 1, 2, 3, testing near the top of the sell climax. Scalpers would exit below that bear bar or below this bear bar and get filled here. That's because the probability of higher prices has fallen at this point. High probability here or here that we're going at least a little higher. But once we get the reversal down here or here, the probability is that we're probably going to go sideways. We might even reverse, but the probability has dropped, and therefore the premise of a scalp is no longer valid. A pair of strong bear bars, but possibly a higher low and possibly a 50% pullback. New bull trend, 50% pullback. The premise for swing traders looking for a second leg up is still valid, and swing traders would hold long even though we have a pair of consecutive bear bars. It's a breakout test of this high, and it's about a 50% pullback, and both bear bars have tails below, so they're not especially big. This body is smaller than that body, so the reversal down is losing momentum. In this video, I defined a swing trade as a trade where you're trying for a reward that is at least twice as big as your risk. The probability for a swing trade in general is at least 40%, and if you have a reward that is twice your risk as your goal, you have a positive trader's equation. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 4 videos on swing trading and scalping. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 4 videos on swing trading and scalping. Scalping is not for beginners. In fact, most professional profitable traders do not scalp much at all. They focus on swing trading. However, when a trader does scalp, he has to be aware of minimum scalp sizes. There's a realistic minimum scalp size, and you need to be aware of this. Most traders should always be looking for swing trades. Sometimes a swing trade turns into a scalp. Beginners should never look for scalps because it's very difficult to trade them profitably. You need a very high winning percentage, and that's just not realistic for a beginner. When a trader is scalping, it's usually easier to make money when you're trading with the trend. Beginners should never trade against a trend, even if the trend is weak. Bull trend, if you're going to scalp, it's easier to make money looking for buys. Here we have a small little bottom, a high 2, 1, 2. Strong breakout, tried to reverse down. We have a bull bar, resumption up. Now we have a pullback to a double bottom and a bull bar, buy above that. We have a high 2 buy, 1, 2, and it's a double bottom with that low and a higher low, a pullback from this breakout. And now we have a micro double bottom, a second entry buy, a tight trading range. You can look at it as a small triangle, a breakout, and a pullback. 2 legs down, 1 pullback, 2, so a high 2 bull flag, about a 50% pullback. These are all reasonably high probability trades, and they're reasonable scalps. Many very profitable traders who swing trade for the majority of their profit often will take scalps in addition to their swing trading. So, for example, in a bull trend, they'll be looking to buy pullbacks, sometimes scalping part, swinging part. When a beginner starts out, he thinks about only one thing: death. Death of his career, death of his dream as a trader. He is always focused on risk. And therefore he's drawn to scalps because he knows that with a scalp, the stop can be tight, the risk is therefore small. However, he overlooks a very important variable, and that's probability. Unless you can structure a trade with a very high probability, you will lose when you scalp. Beginners are always looking at a trend as overdone, climactic. They're always seeing wedges, 1, 2, 3, 1, 2, 3. They're always looking for tops. They always want to believe that the trend cannot go much further, and because they're only focused on risk, they think, maybe if I sell a reversal, my stop will be tight, my risk will be small, and I can make some money. The problem is 80% of reversals fail, and therefore looking to sell reversals is a low probability trade. If you have low probability and low reward, you're going to lose money. For example, we have a wedge, 1, 2, 3, reversing down. We have a failed breakout above a wedge, reversing down. Here we have a lower high major trend reversal. Here we have a failed breakout above a double top. Here we have a final flag reversal. Here we have a wedge, 1, 2, 3. All of them look logical, except for one thing. It's a small pullback bull trend. The pullbacks are small, which means the reversals down are small, and in general, there's not enough room for a scalp if you're selling with a stop below bars. Some skilled traders might sell with limit orders above bars and scale in, but when you have a small pullback bull trend like this, it's better only to look to buy. On the next higher time frame chart, this entire trend is a strong breakout. The beginner sells below this bear bar, thinking, okay, I'm only risking here, my risk is small. However, small risk always means low probability. And if you have a low probability trade, you need a big reward. If you're scalping, you're going for a small reward. The trade that the beginner is setting up is just destined to fail. Even if he wins 50 or 60% of the time, his reward is going to be no bigger than his risk, and therefore he will lose money. It's a low probability strategy. It's doomed to fail. Every loss will be at least as big as each winner, and you probably will have more losers than winners, especially when you're trading against a very strong bull trend like this, looking to sell, and you'll bleed to death from 1,000 paper cuts. Each loss is small, but after you've had 3, 4, 5, or 6 of them, you end up with a pretty big loss. On the other hand, a strong bull trend like this, you should only look to buy. If there's a clear stairs pattern with good sized pullbacks, expert traders will trade against the trend, selling new highs. Here, that's not the case. We're getting gaps. Gaps mean small pullbacks, small reversals down, and it's very dangerous to trade against a trend that's in a tight channel, small pullbacks, and forming gaps. You should only look to buy. You buy the pullbacks, betting that the reversal attempts down will fail. This high, that low, a gap. This high, these low, a gap. A gap. This is a small pullback bull trend, and the pullbacks are not big enough for bears to make money, especially looking to sell with stops. When an expert trader looks at this, he sees a strong bull trend, and he's only looking to buy. He'll buy for any reason. He'll buy pullbacks. These are all examples of pullback buys. He'll buy below bear bars, betting the reversals down will fail. He'll sell bear closes, betting the reversals will fail. He'll buy at the market. Pullbacks are small. We're getting gaps. Small pullback bull trend, only look to buy. You can see the reversals down did not go below the breakout points. We're forming gaps. When you have a small pullback bull trend and it's getting gaps like this, you cannot make money selling. You might make money on some of the trades, but your losses will be greater than your wins and you will lose money. So even with a small risk, you're going to lose money selling. When there's a stairs pattern, you can make money trading against the trend. In a stairs pattern, a pullback goes above the breakout point. Here we have a reversal up, but did it get above the breakout point? No, we still have a gap, and the pullbacks are very small. This is a pretty good sized bar. It might tempt bulls and to begin to look for buys, but whenever you're getting gaps and the pullbacks are small, lasting only a bar or two, you cannot make money looking to buy. You should only look to sell. Some expert traders will take some scalps, sell scalps in addition to their swing scalps, but they'll only be trading in the direction of the trend. In this case, they'll be selling. Here, this pullback went above this breakout point, and therefore now we're in a stairs pattern. We're stair stepping down, and the pullbacks are overlapping breakout points. When that's the case, expert bull scalpers will look to buy a new low, and they're willing to scale in, betting that the pullback from the breakout will rally back above the new low. Once they see a pullback going above a breakout point, and they see a weak rally like this, a weak sell-off like this, bear bar doji, bear bar bull bar, bear bar doji, this looks like a bear leg in a trading range, some expert traders will place a limit order to buy at that low, looking for a scalp. We went back above the breakout point. They'll do it again on the next leg down. They'll place a limit order to buy at that low. If it goes lower, they'll buy more lower, and they're looking for just a scalp. They buy, they take a scalp profit. They buy, they take a scalp profit. In general, they're going to be looking to exit somewhere in the middle of the prior bear leg, because that's where the bear traders will be selling. Whenever you're in a bear trend that's stair-stepping down, bears will look to sell around a 50% pullback from the last leg down. A scalp means a small profit. We're in a bear trend. We have consecutive bear bars here. A big bar, climactic, might not be much more down, but it's okay to sell the close looking for a scalp. And this would be your minimum scalp, maybe a couple points. You exit 2 points down from that close. When a trader sees this, he correctly assumes the market's going to go at least a little bit lower, and therefore he can sell for a scalp. 2 legs up, 1 pullback, 2, 50% pullback of this breakout. Traders will sell below that bear bar, at least for a scalp, knowing that this is fairly climactic. Maybe we'll enter a trading range. Maybe there's not much more down. We have a strong bull reversal, and the bar after it has a bull body. That is good follow-through buying, and therefore the odds are we'll go up at least a little bit higher. Bulls will buy that close, looking for a scalp. We have a 5th bull bar, but it's the 2nd follow-through bar, and the bears are trying to reverse down. A failed breakout above this high, a double top with the top of that sell climax. Chances are buyers below and at least a little bit more up. So traders will buy with a limit order at the low of that bull bar, and they'll get filled here, and they scalp out here. It looks easy, but the reality is most traders cannot do this. They'll make too many mistakes, and they'll end up losing money. If you can do it flawlessly, if you're an expert trader, sure, you can do this. But if you're starting out, this is not the way to trade. You'll make too many mistakes, and to make money, you need a very high probability of success, and that means you cannot make mistakes. Remember, a scalp, you're going for a small profit. Some traders will use wide stops and scale in. So for example, a bull might buy this low and put a stop down here, betting that either it's going to be the start of a bull trend or the start of a trading range. If it's the start of a trading range, we could get a very deep pullback, but it should stay above this low. He might buy for any reason up here, use a stop down here, and he's willing to scale in lower. If you use a very tight stop, then your risk is very small. Since your reward is also small, you need a very high probability of success, like a 90% probability of winning, and beginners simply cannot trade that well. Another problem with a tight stop is that the probability is not going to be very high. In general, the tighter the stop, the smaller the risk, the lower the probability. And that's a problem when you're scalping, because you need high probability to make money. Tight stops when you're scalping, in general, it's a bad idea. If you are scalping, it's better to use a wider stop and trade small enough so that you can scale in. That increases your probability, and it makes up for the low reward. I want to talk a little bit about what the realistic minimum profit target is when you're scalping. There is a realistic minimum size when you're scalping. If you scalp for a profit that's very, very small, commissions, slippage, mistakes will make it impossible to make money. I have several guidelines that I use to determine what's the smallest scalp I'll try to get in any particular market. For the E-mini and bond futures, I only scalp for at least 4 to 8 ticks. Trading in the Forex market, and I think a trade will probably make 5 or 6 pips, I will not take that trade if that's all I think it will make. I will only take the trade if I think there's a realistic chance of making 10 to 20 pips. For stocks and commodities, the smallest trade that I'll ever take is 10 to 20 ticks. I sometimes end up exiting with less than that, but I do not take a trade unless I plan on taking that much. If after I enter, I think my premise is wrong, I'll get out. And sometimes I'll get out with 2 or 3 ticks profit or 2 or 3 ticks loss. But as soon as I think my premise is wrong, I get out. Another guideline is, if I'm scalping, my minimum trade has to be at least 5 to 10% of an average day's range. For example, if I'm trading a Forex market and the average day's range is 100 pips, I do not want to be scalping for anything less than 10 pips. That's already my minimum for Forex markets as well. When I'm scalping on a 5-minute chart, for example, in the E-mini, the average bar is only 1 or 2 points tall. And I scalp for 1 or 2 points and I hold for 1 to 5 bars. Sometimes I'll hold longer. Sometimes I'll turn a scalp into a swing trade or part of the trade into a swing trade. But my general expectation when I'm scalping on a 5-minute E-mini chart is to get out with a 1 to 2 point profit, and I usually get out within 1 to 5 bars. Rarely, if you're trading the E-mini, you'll get a lot of bars that are 5 points tall or more. When that's the case, I'm not scalping for 1 point, I'm scalping for 5 points. I want to be scalping for about the size of the average bar. If the actual risk is small, if the bars are small and the legs are small, like on this particular day, I think scalping for 1 to 2 points is fine if you are a scalper. Most traders should not scalp. It'll be too hard to make money. It's certainly too hard to make money for a career, and you have to make sure that it's compatible with your personality. Will you enjoy it? If you don't enjoy it, don't do it. When you're looking at a chart and you're not sure what the minimum scalp size is, make sure that it is at least as big as the height of average recent bars and at least 5 to 10% as big as the average daily range. In this particular chart, the average bars are about 20 ticks tall, and the average daily range has been about 100 ticks. Here, a reasonable minimum scalp would therefore be about 10 ticks. In general, I prefer traders to lean toward more swing trading. You have 2 choices here. The recent bars are 20 ticks tall. 10% of the average daily range is 10 ticks. I think it's better to probably try to go for the larger of the 2 minimums, which is 20 ticks if you're looking to scalp this chart. Part of the reason for that is if the bars are 20 ticks tall, your stop is probably going to be at least 20 ticks away, and you want to be going for a reward that is at least as big as your risk. I have some exceptions. For example, in the E-mini, I usually scalp for 4 ticks unless the range is relatively big and the bars are relatively big, then I'll scalp for 2 points. In the NASDAQ, 2 to 4 points is a minimum scalp, and for the bond futures, 4 to 8 ticks is a minimum scalp. And it depends on how big the bars are. If the bars are bigger, you go for the bigger target. If the bars are smaller, you go for the smaller target. This is a 5-minute chart of the euro versus the dollar, and here are a couple scalps, buying the reversal up, and here's a minimum scalp, a bull flag buying the breakout, here's a minimum scalp. If your son or daughter is in college, you know the minimum grade to graduate is a D. Would you be happy if your son proudly told you that his goal in life was to get a D or to make a minimum wage? Of course not. And the same is true with trading. Going for the minimum is rarely ever the best choice. Successful traders who take 10 pip scalps, they do it only when it's appropriate. And many days in the Forex markets, the markets are in fairly tight ranges. And if you're going to trade, the only way to make money is by scalping. Most traders should not trade when that is their only option. It's too hard to do it. Plus, most people do not have a personality that's compatible with scalping. They get stressed out. They feel too unhappy. This is very important. I've never met a trader who is making a living only going for minimum scalps. I know a lot of very profitable scalpers. I've met a lot of profitable scalpers over my 30 years. However, they do that as part of their overall plan, and they go for more than minimum scalps on most of their trades. In other words, they'll go for bigger scalps. So instead of 1 point in the E-mini, they'll go for 2 or 3 points. Instead of 10 pips in the Forex markets, they'll go for 20 or 30 pips, or they'll swing trade. You should never try to make a living only going for minimum scalps because you will not succeed. I mentioned some of the problems with this earlier. There's a spread that you have to overcome. Some Forex brokers charge commissions. There's also slippage. And the mistakes become a real big problem. And everybody makes mistakes. Also, there are problems with the brokers and fills. The result is that you need to win 90% of the trades consistently for years if you're trying to make a living going for minimum scalps. There are traders who can do that, but you should assume that you are not one. It's a very rare trader who can do that and who is happy doing it. You need both. You have to be happy as a trader because you're trying to do this for a career, and your job has to be fun. Again, I know traders who win 90% of the time. That immediately tells you that they're scalpers. If you're winning 90% of the time, you have to be going for a low reward because a high probability of success means a bad risk-reward ratio, and that means that you're scalping. You're going for very little reward. However, that does not mean they're going for minimum profits. For example, in the euro versus the dollar, they may be scalping, but they might be trying for 20 or 30 pips on their scalps. If you restrict yourself to only taking 10 pip scalps, you could theoretically be profitable. Paul Rotter was for many, many years, but it's unrealistic. Most people who try to make a living with simply 10 pip scalps will not be successful. Also, you have to be doing it successfully day after day, year after year, and you have to be happy doing it. I was an eye surgeon for many years, and I was very good at it, and I made a lot of money doing it, but I was not happy, so I stopped doing it. And if you're a scalper, it doesn't matter if you're very good at it. If you're not happy, you're not going to want to do it for the rest of your life. You not only have to be good, but you have to be happy. Very few traders have both of those things in their favor. I've been talking about the profit target, a scalp, and probability, but there's a third variable in the trader's equation, and that is risk. If you're trading a Forex market like the euro versus the dollar, you can usually use a 20 pip stop. But sometimes the bars are big and the swings are big. A 20 pip stop may not be reasonable. You have to win 90% or more of your trades to overcome the risk that you need to trade profitably, and that's just not realistic. It's possible, but very few traders can do it and can do it happily. When the bars are bigger, especially when there are a lot of reversals, a trader needs to use wider stops or win 90% of the time, otherwise he's going to lose. And since winning 90% of the time is very difficult to do, a scalper usually needs wider stops. And usually they have to scale in if they're going to be consistently profitable. If you cannot use the appropriate stop for whatever reason, if you're scared, if your account size is too small, just wait for a trade that would allow you to use the right stop. One of the problems going for minimum reward is when the bars are big, your risk is big, and even if you're winning 70% of the time, at the end of the day, you see your account is either break even or even losing money. And you're asking yourself, gosh, I won 70% of my trades today and I did not make any money. And the problem is risk. If the risk is big and you're going for too small of a profit, that's the result. You're going to end up having a very difficult time making money. This is a 60-minute chart of the E-mini. The average bar on a 60-minute chart might be about 5 points. And therefore, if you're looking to scalp on a 60-minute chart, you should be going for about 5 points, and you should expect to exit within 1 to 5 bars. 5 bars on a 60-minute chart is 5 hours. It's still a scalp. Strong bull breakout and follow through. You can buy the close of the second big bull trend bar or the close of the bar afterwards. Place a limit order to get out with a 5-point profit, a stop below. Your reward is much smaller than your risk, but the probability of the market going up at least a little bit is high. We have a triangle. You can call it a wedge. 3 pushes down. 1, 2, or 2, and then 3. Trying to reverse up here. A triangle is a breakout mode situation, and that means there's only a 50% chance that a breakout will be successful. If you buy above the high of this bull bar, only a 50% chance it's going to go up high enough for you to make a profitable trade, and 50% chance it will not. It will either continue sideways or it will reverse. It looks like a good buy. A wedge, 1, 2, 3, 4, a good looking bull bar, a triangle, you're buying above its high, yet you lost immediately on the very next bar. On your entry bar, you lost. Now we have 2 consecutive bear bars, probably going lower. Scalpers will sell that close and look to scalp out. I call this bar a give up bar, or this bar as well. It went below the low of this buy signal bar, and these 2 bars are caused by bulls giving up. And when you have trapped bulls like that, there's a 60% chance you'll get at least a small second leg down, and therefore selling this close is a high probability trade that you'll get at least a small profit, and therefore it's a high probability scalp. This is a 5-minute chart of the E-mini. Let's say you bought this close and you decided to exit with a 2-tick profit. High probability of making 2 ticks, and it's very high probability that you'll make 2 ticks. But what's the problem with that? One of the problems is commissions. The commissions in general are relatively small, but if the profit target is small as well, then the commissions can be relatively big. Let's say your broker charges you a $4 commission for a round turn, $2 to buy, $2 to sell. And then let's say you go for a 2-tick scalp. 2 ticks in the E-mini is a $25 profit. Here, you buy that close, you exit with 2 ticks, you made $25. But you had to pay a $4 commission, and therefore your net profit was $21. On the other hand, let's say you used a 2-tick stop, and the market went down and hit your stop before it hit your profit target. Instead of winning $25, you lose $25. You still have that $4 commission. So every time you lose $29. Every time you win $21. That reward is much smaller than your risk. How can you make money doing that? You need a really high winning percentage, well over 90%, and that's simply unrealistic. Let's say you took 10 trades and you won 60% of the time. Since you're winning $21 for every win on 2-tick scalps, your net profit would be $126. And you lost only 4 times, but you're losing $29 on each loss, and your total loss is $116 from your 4 losers. If you're right even 60% of the time, there's no margin for error. You're barely making a profit. You have to be right 80 to 90% of the time to make a living, and that's just unrealistic. Going for a 2-tick scalp is just not worth doing. You cannot do it profitably. And that's why I say there's a realistic minimum scalp size. And for the E-mini, the realistic minimum is 1 point, maybe 2 points. Here's a 60-minute chart of the euro versus the dollar. The average bar on the 60-minute chart is about 50 pips. And therefore, a scalp is 50 pips or more. For example, if you buy this failed bear breakout, it's a higher low, and exit with 50 pips, you're exiting right here. And that's a good location. You're at the top of a possible trading range. For the bears, they see a double top at the top of a trading range, maybe a lower high versus this high. They have a strong bear breakout. They see this as a pullback from that strong bear breakout. Does not matter that this is a little bit above that. It's still a 2-legged pullback from this bear breakout. And you have a good bear bar, a low 2 short, low 1, low 2, either in a trading range or possibly in a bear trend, a double top, lower high. It might be the start of a bear trend. Some traders will sell below the low of that bear bar, and they'll get filled right here. If they're a scalper, they'll place a limit order to buy back their shorts 50 pips down, which is right here, a good location near the bottom of a possible trading range. A big bear breakout, probably going to get at least a couple legs down. Traders might sell below the low of that bull bar or below the low of this bear bar, a second entry short, and exit with a 50 pip profit down here. This is a 5-minute chart of the euro versus the dollar. And let's say you're thinking about scalping for 6 pips using 100,000 units. Some brokers charge commissions. All brokers require you to pay a bid-ask spread. Most of the time, the cost is relatively small. However, if the profit target is also small, like 6 pips, then the commission becomes relatively big. Suppose you're risking 6 pips to make 6 pips and you're trading 100,000 units. And let's say your broker has a bid-ask spread of 2 pips each way. Then you need an 8 pip move to make 6 pips. You need your 6 pips profit, and then you have 2 pips bid-ask spread buying and 2 pips bid-ask spread selling. And therefore you need an 8 pip move to make 6 pips. If you win on 6 of your 10 trades, each win is 6 pips times $10 a pip, you made $60. Each loser is 8 pips, not just 6 pips, because you have your 2 pip bid-ask spread buying and again selling. And that means your average loser is going to be about $80. The average winner is $60. And let's say you take 10 trades and you win 60% of the time, so you win 6 trades. Your average win is $6, so you make $360 from the winners, but your average loss is $80 times 4 losers, so you lost $320 from your losers. Even though you won 60% of the time, you lost money. There's no margin for mistakes when you're going for a reward that's too small. You need a success rate of 90% to make a living, and that's unrealistic. Plus, you have to be happy, and that's very hard to do. And therefore, there is a minimum scalp size, and you should never be scalping for less than 10 pips, preferably less than 20 pips. And most traders should not be scalping for a living. They should be swing trading. Sometimes the market is very quiet, and the only way to make money that in a particular day is to scalp, and that's okay. It's important to understand that scalping is not for beginners. In fact, most traders should swing trade and rarely scalp. If a trader does scalp, he should not scalp for a size that's too small. Otherwise, the cost of commission, slippage, and spreads and mistakes become too great, and it becomes impossible to profitably trade unless you win 90% or more of your trades, and that's simply unrealistic. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 4 videos on swing trading and scalping. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the fourth of 4 videos on swing trading and scalping. Sometimes traders will take a trade as a swing, and because of the way the price action is unfolding, they'll convert it to a scalp. One of the highest probability trades that a trader can take is entering during a strong breakout, betting that the breakout will continue. Therefore, the math is okay to scalp in a strong breakout. A very bad thing to do is take a trade as a scalp, and then it starts to go against you, and you decide to convert it into a swing. That is a losing strategy. You're going for a small reward, yet you're willing to accept an increasing loss, so much so that you need an extremely high winning percentage to make the strategy profitable. Every new tick that comes on every chart gives you new information. If you enter a trade for one reason, and then the information makes you think that your premise is no longer good, you have to make a change in what you're doing. For example, we have a strong bear trend. It's a sell to close strong bear breakout at this point, and you have a low one short. We have a pullback in a bear trend where the market sold off for about 10 bars without a bull body. However, 2 consecutive dojis, trading range price action, and consecutive sell climaxes all the way down. There, here, a little bit here, these 2 bars, and then this entire sell-off is a big breakout bar on a higher time frame chart. And it's a big sell climax late in a bear trend, breaking below the bottom of a bear channel. Chances are the market's going to reverse soon. This is a low probability short, and therefore only a swing. You're betting that an oversold market is going to get a lot more oversold. Chances are it will not. Whenever you take a trade that does not have a very high probability of success, you have to be swing trading because you need a big reward to offset the low probability. This is not a good scalp, selling below that bear bar. Here we have another big bear bar. In fact, this is the biggest bear bar in 20 or 30 bars. Whenever you have the biggest bear bar coming in a bear trend after the trend has lasted 20 bars or more, it's more likely an exhaustive end of the trend rather than a measuring gap leading to an accelerated trend down. When a trend ends, it converts either into a trading range or into an opposite trend. This is a high probability bar, indicating that the trend will either end here or very soon. It's a probable exhaustion gap. The gap, once this bar closes, is between the close of this bar and the breakout point, this low. High probability that that gap is going to close soon, and in fact it closed 2 bars later. Had you taken this short as a swing short, and then you see this big bear bar late in a bear trend, you have to be thinking, uh-oh, this might be the end of the trend and not the start of a new leg down. And then you get a bull bar reversing, closing near its high. A swing trader should exit above this bull bar because the premise of a continued bear trend is probably very low probability at this point. Probably the best the bears get is sideways for 5 or 10 bars. Did he make a profit? He might have made a very small profit. He converted his swing trade entering here into a scalp entering here. We're now in a bull swing, but it's the first strong breakout above a bear channel. This rally is probably a minor reversal, and it probably is going to convert into a trading range fairly soon. If you want, you can call this a triangle. We have a pair of small dojis after a big bull bar and after a down bar here. First push down, second push down, and then third push down. On a smaller time frame chart, this is a triangle, and it's occurring fairly late in a rally, and this rally is probably going to be a bull leg in a trading range because it's the first breakout of a very tight bear channel. The reversal up is probably minor, and then once it pulls back, the bulls can get a higher low major trend reversal. Since this is part of a minor reversal, it probably is not going to go up all that much higher. Relatively low bet for a swing up. Since the first leg up after a very tight bear channel is probably a bull leg in a trading range, and then you suddenly get a very big bar, 15 or more bars into the range, you have to be thinking of this as possibly a second leg trap. It's not really a second leg, unless you call this whole thing first leg, pullback, second leg. You can call it a parabolic wedge, 1, 2, 3, but a very big bull bar, late in a bull leg in what is probably going to be a trading range, probably a climactic end to the bull leg. Also, it's testing near the top of the bear leg. That is a logical resistance area and a good place for bulls to take profits and for bears to start to look for shorts. You have a big bear reversal bar closing on its low. Now you have big up, big down, a triangle late in a trend, probable final flag. Most swing traders who bought above here should exit at this point. Big up, big down, probably big confusion in a trading range. Also, you're near the top of a trading range, and this is probably a bull leg in a trading range, which means you're probably going to get a bear leg in a range. Once you see this reversal, traders should exit their swing below that low. They'll have made a profit from here to here. It'll be small. They began taking a swing trade, hoping that this would be the start of a bull trend, even though it probably would have to form a major trend reversal before you could get a bull trend. Low probability swing buy. And most bulls who took that swing trade would get out right here below that bear bar, converting their swing into a scalp. Anytime you take any kind of a trade, swing or scalp, after you enter, if the premise is no longer valid, if the trade is unfolding in a way that's not consistent with what you were expecting, you simply get out, even if it's for a loss. 4 consecutive bear bars closing on or near their lows. Some traders would sell this bar, even though it's a breakout and not a follow-through bar after the breakout. But some traders will take a chance. They'll sell here and put a stop above the top of the bear leg. I usually wait. If I did not sell earlier, I usually wait for a follow-through bar. In other words, another bear bar closing near its low. And here, instead of a bear follow-through bar, we have a bull follow-through bar. That makes a bear trend less likely and a pullback into at least a trading range or possibly a bull trend more likely. That is bad follow-through after a bear breakout below our trading range or a prior low. The bears who sold this close, their stop is above the top of the bear leg or maybe above the top of the sell climax, the 4 consecutive bear bars. Bad follow-through, a bull bar, a doji bar, another bull bar. The bears who took this short are thinking, uh-oh, this might be a trap and a failed breakout, and it could quickly lead to a reversal up. Most bears would probably exit above this bull bar. Others would exit maybe above the top of this doji bar, that doji bar, or this second bull bar. And you can see when it went above the second bull bar, it started to accelerate upward. this pair of bars is a sign that the final bears are giving up. Whenever a trade goes against you, but you think your premise is still valid, you can scale in and simply rely on a logical stop. We have a strong bull breakout after a failed bear breakout. Just like the bears sold this close, the bulls will buy that close, or they'll wait for another bull bar and buy the close of that second bull bar. They have it here. Even though it has a big tail on top, you have trapped bears who are looking for any kind of a sell-off so they can get out with a smaller loss. You'll have bulls who did not buy the reversal up, and they're hoping for any kind of a pullback so that they can buy. Buying up here, you're betting on either a bull trend or a trading range. If it's a trading range, it'll sell off and it'll come back up to the top of the range. This is a high probability trade. Buying this close has a high probability of either making a profit or avoiding a loss if you can scale in lower. You buy that close, you put a stop below the bottom of the bull swing, and then you're disappointed by the follow-through. 1 bear bar, 2 bear bars, 3 bear bars. Maybe it's going to reverse down just like this bear breakout reversed up. More likely, after a failed bear breakout and a strong bull breakout, the best the bears will get is a trading range for 5 or 10 bars. And therefore, the bulls who bought up here can hold through these bear bars, betting that the market will come back up to that high close where they bought before it gets down to their stop below the bottom of the bull swing. These bulls might add on at a scalp lower. For example, if this is a 5-minute Forex chart, they might add on 10 pips lower. If it's an E-mini chart, they might add on 1 or 2 points lower. They always want to add on at least as big as a scalp below because they're trying to get out, break even on their first entry if the market gets back to their first entry, and they want to make a scalper's profit on their second entry. Many bulls will look to enter above a bull bar. We have a doji here, not particularly strong, but they might enter above this bar, no fill, or they might enter above this bar. We have an III and a bull bar closing on its high. If this entry point above the high of this small bull bar is at least as big as a scalp below this close, it's a reasonable entry, betting that we'll come back to that close at a minimum. And you can see what happened. Bulls bought this close. They did not like this. They decided they wanted to get out break even if the market got back to their close. And some of them will add on here as long as the distance between this and that is at least as big as a scalp. And what happened when we get back to that close? It went a little bit above, and that allowed these bulls to exit with a limit order break even. And if they bought more here, then they made a scalp profit when the market went back slightly above their first price. The bulls who bought here, they were using a swing stop. Whether or not they were scalping or swing trading, it's high probability that they would make money or not lose money, so it's okay to scalp. And they got a scalp on their second entry, and they got out break even on their first. As long as the breakout is continuing, you can repeat the process. You can use a swing stop and scale in if the market goes against you. If you sell anywhere in here, your stop is up here. It does not matter if you sell that close or below this bull bar, even selling below this bear bar. The stop for all of those trades is up here. Let's say you happen to sell right down here, the lowest close of the entire sell-off. When you're taking that short, you don't know that it's the final bear bar, but you soon discover that it is. Mathematically, it's still a reasonable thing to do. We have consecutive sell climaxes, bear bar here, then 3 bear bars, a sell climax, and then 2 bear bars, a sell climax. But a fairly big bear bar, possible 1 bar final flag, and a tail, probably going to get a pullback in a trading range soon. The math is still okay to sell that close because the first reversal up from a tight bear channel probably is going to be either a bull leg in a trading range or it'll be a bull channel that becomes a bear flag. In other words, the odds are whatever rally we get will come back down and test this close before it gets up to that swing stop. Therefore, some traders will sell this close and look to sell more higher and put a stop up here. Scale-in traders have to trade small because whatever risk they have, it has to be no greater than the risk on any other trade. And if they enter a second time or even a third time, the total risk from all 3 entries has to be no greater than the risk on any other trade. So they have to trade small. The stop is far away and they're adding to a position. Some traders who sold this close would look to sell more, maybe 2 points higher, and they would get filled right here. They would keep their stop here above the top of the bear swing. It's a swing stop, but they're confident that the first reversal up would be minor, becoming either a bull channel, bear flag, in which case they would expect a sell-off back down to test that close, or it could simply be a bull leg in a trading range. Trading range, you get a leg up, you expect a leg down back to that close. Look what happened here. The trader sold here. He sold more 2 points higher. He placed a limit order to get out at that low close. The market hit his order. Most traders would not be filled. And then we get a bull bar closing on its high. Traders at this point would assume that these sell the close bears are trapped and they're going to buy back their shorts. You can see this big bull trend bar. It's a give up bar. Traders who are aware of what's going on, traders selling this close, disappointed by the bull bar, selling more higher, trying to get out, break even on their first entry, and with a scalp profit on their second. Most of them did not get out with a profit. They exited above here, around break even on their second entry, and with a small loss on their first entry. Other traders would see that and say, well, it's still probably a minor reversal up. This is not enough bars up, not enough bars down for this to be a major trend reversal. It's therefore a minor trend reversal as long as we stay below the top of the most recent major lower high, the top of this bear breakout. And therefore, they'll add on again. For example, they might add on 2 points above their second entry, and they'd get filled here. Or they would sell on a reversal down below a bear bar, and they'd get filled right here. It's a big low 2 short. One leg up, there's the low 1, second leg up, and then this is the low 2. It's also around a 50% pullback and what could end up being a bear channel, a reasonable location for bears to sell. The swing down tested the low close, and they get out break even on their first entry, 2 points profit on their second entry, 4 points profit on their third entry. But again, they only take that trade if they're trading small enough so that the entire risk from all 3 entries is no more than they would have on any other trade. When you're entering during a strong breakout, in the direction of the breakout, you have a high probability of making money. And therefore, it's reasonable to scalp if you can make the decisions fast enough. When there's a strong bear breakout, the probability of the market moving down X number of ticks before it goes up X number of ticks is between 60 and 80%. X can be any size, 2 ticks, 5 ticks, 15 ticks, 27 ticks. Strong bear breakout, good follow through. If you sell this close, there's at least a 60% chance that the market will fall X number of ticks before it goes up X number of ticks. You pick the number. 5 ticks, probably will fall 5 ticks before it goes up 5 ticks. 10 ticks, probably will fall 10 ticks before it goes up 10 ticks. It's a high probability sell. At least a 60% chance of a measured move based upon the height of the breakout, the open of this first bar, the close of that final bar. Let's say you were using a 2-point stop. Strong momentum down, strong breakout, 60% chance the market will fall 2 points before it rallies 2 points. Reward equal to risk, but probability 60% because of the strength of the bear breakout. Therefore, it's a reasonable trader's equation to exit with the reward equal to your risk. You sell that close, and if you want to use a 2-point stop, your stop is right there. You can place a limit order to get out with a 2-point profit, which would be right here. Here's a 60-minute chart of the euro versus the dollar. In a strong bull breakout, the probability of making X pips up before X pips down is between 60 and 80%. It doesn't matter what X pips are. X could be 5 pips. So the probability of making 5 pips before losing 5 pips is at least 60%. The probability of making 29 pips before losing 29 pips, at least 60%. Therefore, the risk equals the reward, but the probability is high, 60% or greater. This trade has a good trader's equation, and it's a good strategy. Here we have a very big bull bar breaking out of a trading range. Bull trend resumption, bull trend, trading range, 2 legs down, 1 pullback 2, and now we're clearly breaking to the upside, and we have a follow-through bar. When you have a strong breakout, close above the high of the past 30 bars, and then you have a strong follow-through bar, there's a 60% chance the market is going to rally for a measured move based upon the size of the breakout. For example, from the open of the first bar to the close of the final bar. The breakout grew here and it grew here. If you entered here, there's a 60% chance it would go for a measured move from this open to that close before it fell below this low. Good strategy to buy the close of that follow-through bar. Let's say you wanted to risk 50 pips and go for a profit target of 50 pips. You buy that close, you place a stop 50 pips below. There's a 60% chance it'll go up 50 pips before it goes down 50 pips. You can place a limit order to take profits 50 pips above, and you can see the high of this bar is slightly above that limit order, and you would have been filled right here. You would exit with a 50 pip profit. I would call that a scalp on the 60-minute chart. You held for only a couple bars, a few bars, and you did not allow any pullbacks. This is obviously a strong bull trend in the E-mini, a 5-minute chart. You can see gaps and negative gaps. This high, this low, this high, these lows, this high, these lows. It's a small pullback bull trend. Chances are it's going to continue a long time. Always in direction is clear. Probability is high enough so you can scalp repeatedly instead of swing trading. For example, a bull scalper can keep buying for any reason and repeatedly take 1 to 2 points profit. He could buy below a bear reversal bar. He could buy a bear close, betting that the bear reversal attempt will fail. He can buy above a bull bar, betting on trend resumption. We have a bull flag, a triangle, a bull breakout, a pullback, high 2 pullback, high 1, high 2. You can buy that. You can buy at the market. You can buy for any reason and keep trailing your stop below the most recent major high or low. Bull breakout here, maybe you put your stop down here. If you buy anywhere in here, you have a new breakout to a new high with a couple of strong bull bars. If this is going to continue as a small pullback bull trend, it should not fall below this low. So if you buy at any point, even if you bought down here, after you've had this leg up, traders can raise their stop to right here. You could buy and take a point or two profit and just buy repeatedly, taking 1 or 2 points profit. And you can see there are at least 10 reasonable buy scalps. In fact, there are probably 20 or 30 good buy scalps during this bull trend. So you can buy, exit, buy, take profit, buy, take profit, buy, take profit. However, as simple as that sounds, it's very hard to do because a lot of times you'll exit and then you'll need to take a break, an emotional break for several bars, and then you will not re-enter. You'll start thinking that maybe it'll pull back and you'll get a deeper pullback, maybe it'll reverse. Most traders cannot keep entering and taking profits, entering and taking profits. You end up missing too many trades. Strong bull breakout, 4 big bull bars closing on their highs. It's much more profitable and much more reliably profitable to buy and hold on as long as the premise of a strong bull trend is valid. For example, you buy above this bull bar and you hold to the end of the day and you have a bear bar closing on its low, betting that the market will have some profit taking into the close. You're going to make far more money buying here and exiting there than buying and exiting repeatedly on the way up. This is a 5-minute chart of the euro versus the dollar. Very strong bear trend. So a trader can sell at any point and scalp if he wants. High probability of making money if you're scalping. And you can do it repeatedly. The direction is clearly down and we're probably going lower. Therefore, high probability of making a reward at least as big as your risk, wherever your risk is. A bear scalper could keep selling, taking 20 pips profit, and then selling again and do that all day long. We have a bear breakout, a follow-through bar, sell the close. A bull bar, so a pullback, sell below the bear bar. We have another pullback, sell below the bear bar. A little inside bar, sell below its low. You can sell the high of this bull bar, betting the reversal up will fail. We have a bigger pullback here. You sell below the bear bar, or you take the second entry short below this bear bar. Many opportunities to scalp here, each one for 20 pips. However, most traders cannot keep entering and taking profits. They'll end up not entering again often enough, and they'll end up missing too many good trades. Here we have a strong bear breakout and a follow-through bar below a tight trading range. A reasonable short, maybe on the close of that bar. There's no good reason to get out anywhere through here. Maybe here, the biggest bear breakout late in a bear trend, probably an exhaustive end of the trend, micro double bottom, a bull bar closing on its high, reasonable location to take profits, final profits, or maybe here when we're starting to enter a triangle. So a trader selling here and just holding through all of this made a lot of pips, probably a lot more than the scalper who tried to sell, take profits, sell, take profits, sell, take profits. Sometimes traders get a surprisingly quick, big profit. Oftentimes when you're swing trading, the stop is very far from the current price, and therefore the risk is very big compared to the remaining reward. When that's the case, you have to be careful about managing your trade. We have a bear swing and a bear flag, yet we get a bull breakout. We have a pullback from that breakout. Probably we're going to get at least a small second leg up. This might end up as a trading range. We might test the top of the range. It's reasonable to buy on a stop above that bear bar, looking for at least a small second leg up. Stop below the bottom of the bear leg if you're taking that buy. And a measured move up from the bottom of the bear trend to the top of this leg up takes you right here. And you can see what happened when the market reached a measured move target. A lot of selling. It's also a breakout above this lower high, the top of the bear swing, and you always have some selling there. You'll have bears exiting with stops. You'll have the bulls who bought here looking at this as a gift, a surprisingly quick, big profit, and they'll take profits at or above a prior high. You'll have other bears who will look at this as a potential trading range, big down, big up, big confusion, trading range likely. They'll place limit orders to sell here. So lots of reasons to sell around that prior high. Whenever a trader is buying for a swing and the market quickly reaches a logical target, it's perfectly fine to exit, even if it's on the same bar. Is that a swing or a scalp? Well, you got a swing size profit, but in a scalp time frame. The very same bar in which you entered, you took profits. One of the terrible things that beginners sometimes do is they take a trade for a scalp, it does not go their way, it starts to go against them, and they decide to convert the scalp into a swing. That is a losing strategy. This is a 5-minute chart of the E-mini. It's really impossible for most traders to scalp repeatedly in a trend. It's okay to look for really great setups and use big volume, and you can theoretically make a living doing that. Most professional traders, even those who scalp most of the time, swing as much as they can because they know that it's very difficult to make money simply scalping alone. You have to swing trade at least part of the time. I have a video in this series on extreme scalping, and I talk more about how to scalp repeatedly. If you have a great setup, don't scalp because it's probably going to end up being a swing trade. Great setups do not happen often, but when they do happen, you have to be aware that you have a great setup in front of you. Look at this. We have a bear trend. We have a bull reversal attempt. It failed. We're trying to reverse up again here. Strong enough breakout to the downside, probably at least a small second leg down. Maybe this is the second leg down, but not a good buy signal bar, so a lot of traders will not buy that. But again, we have another strong reversal up just like we had here. We have another attempt down by the bears and another reversal bar, and this bar is closing on its high. This is a third entry buy. It's a small expanding triangle, too small to call this a major trend reversal. However, it could be a trading range bottom that could lead to a reversal up. This is a high probability trade for at least a scalp. And if you're taking this for a scalp, it's better to be aware that this could be the end of a leg down, and we could easily test the top of the sell climax. And therefore, if you're looking for a scalp, I would not be too quick to take profits. I would consider swinging at least part of the trade. The math, it's okay for scalping. You buy above the high of this bar, you get filled early on during this big bull trend bar, and you could scalp for 2 points, risking 2 points. The probability is high that you'll make your 2 points. The math is acceptable for a scalp. However, if you're thinking about a possible swing trade and you do not exit here, you wait for a logical end to the trend. Is this a logical end to the trend? Probably not. What about this? Well, you got 5 bars up without a bear body, and you got a very tight bull channel. Probably the first reversal down will be minor, and we'll get at least a little bit more up. Strong bull breakout here, at least one more leg up. Maybe this is the one more leg up. We're getting near the top of the bear trend. It could be converting into a trading range, big down, big up trading range. This is a reasonable place for traders to exit. If he bought here and he exited here, he took about 10 points profit, and that's better than 5 2-point scalps. The trader who bought here and took the 2-point scalp misunderstood that this could lead to a pretty good reversal up, a swing up. maybe a swing down for a couple hours, swing up for a couple hours. This is a good setup for a swing up. And in general, it's better not to be too quick to take profits and try to swing at least part of your trade. One of the biggest reasons for beginners losing money is that they confuse swing trades with scalp trades. They mix up swing and scalp entries and exit. For example, if you take a swing trade, manage it as a swing trade. Don't scalp. A small expanding triangle, consecutive sell climaxes here, here, here. A good-looking buy signal bar, bull bar closing on its high, bull follow-through bar, bull bar closing on its high. This is a reasonably good swing setup. If you bought thinking, oh wow, what a great possibility for a swing trade, maybe we'll test here, maybe we'll test here. Don't scalp for 2 points profit. If you entered thinking that it was a reasonable swing trade, don't convert it into a scalp. If you're buying this for a swing trade, manage it like a swing trade and you exit up here when the probability of higher prices becomes much less. Another big problem with beginners is they think they're taking a scalp and then they decide to manage it like a swing trade. That is a losing strategy. If you take a trade planning to scalp, rely on a scalp stop and don't pretend it's now a swing trade. Here we have a small pullback after a buy climax. Traders should expect at least a little bit more up, but we're getting near the top of the bear trend. Big down, big up, big confusion, probably going sideways soon. And look at the number of small doji bars since the market had this first pullback. This looks like a bull leg in a trading range. If you're buying up here, you might be buying pretty close to the top of that range. This is a buy climax late in a bull trend, probably going to be an exhaustion gap, and the market will probably pull back below the breakout point and below the bottom of the buy climax. Buying up here, low probability bet that you're going to get much higher prices. 3 pushes up, 1, 2, 3. Nested wedge, 1, 2, 3. There are many firms out there that specialize in high frequency trading, and they do it using computer algorithms. There are a few traders, very successful, profitable scalpers, who manually do high frequency trading. High frequency trading is a type of scalp. You're looking for a small profit. Usually your risk is not all that big, and you need a high probability of success to do it profitably. Computers can take every signal and manage the trades perfectly. For example, these are all reasonable scalps. Small bear flag, sell the close, sell the close, sell the reversal up, betting it'll be either a bull leg in a trading range or a bear flag, sell the reversal down, same thing here. A strong bull bar in a tight bear channel, first reversal up will probably fail. We have a sell off, a second close, sell it. Here we have a bear bar after a buy climax, disappointing bar. Probably will pull back at least a little bit more. The bulls will probably need at least a micro double bottom before they buy. Here we have a second leg up. We're getting fairly high up in the range. We have a breakout above the top of the sell climax. Bears will sell again. Bulls will take profits. Here we have a bull flag, but it's a doji after a buy climax. Low probability buy. Therefore, traders will sell. You have a high 2 buy, but a bear doji, probably at least a little bit more down. We have a bull breakout, a second leg up in a bear bar. Sell the reversal down. Here we have probably a lower high major trend reversal, a weak rally, small bars, probably going at least a little bit more down. All are reasonable scalps. Many buy scalps as well. You buy the reversal up, you buy closes, you buy below that bull bar, betting that the bear reversal will fail. Here we have a micro double top, up here, down here, up here. Probably going to get at least a second leg up from this strong rally. So traders will buy that low, they'll buy the bear close, they'll buy above this bar, a high 2 buy, high 1 above this bar, high 2 here. Here we got a wedge bull flag, 3 pushes down, 1, 2, and then 3 or 4. You have a bull inside bar, a higher high double bottom. You got a bull breakout of the wedge bull flag. You have a pullback. Here you got a small bull flag. Here you got a micro double bottom and a higher low. All of these are reasonable scalps, and computers can take all of them. And a really good trader can take all or most of them. But very few traders can do that, and many who can do not want to do it because it's not fun for them. It's very difficult for people to do this profitably and for the long term. Therefore, traders should not be looking for manual, high-frequency type of scalps. In this video, I talked about how you can enter a trade as a swing but then as the trade unfolds, you decide it's no longer a valid swing and you could scalp out. When there's a strong breakout, the probability of the market continuing is high, and therefore traders can scalp. In any high probability situation, traders can scalp. Finally, if you manage a scalp like a swing, you're going to lose money. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the fourth of 4 videos on swing trading and scalping. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 3 videos on orders. There are only 4 orders that most traders should be using. Beginners should be entering only with stop orders. Experienced traders can also enter with limit orders. Beginners can exit with limit orders. Bracket orders, after you enter a trade, you should be using a bracket order, a stop order to protect you, and a limit order to take profits. And finally, I'll talk about market orders. Sometimes the market is just moving too fast and you need to get in or get out. The best way to do it is trading at the market. There are other order types as well, but most traders should not bother with them. Most traders should only use these 4 types of orders: stop orders, limit orders, bracket orders, which are a combination of a stop plus a limit order, and market orders. When you open an account with your broker, he'll give you software that will allow you to trade, and these will be choices that are available in that software. They allow you to enter and exit trades. Most traders should almost always be entering with stop orders, because then at least the market is going in your direction. For example, to enter or exit a trade with a sell stop order, you place the order below the low of the current bar. For example, if you're long and you want to exit below this bear bar, you place a stop order just below its low. When this bar traded below that low, the stop order becomes a market order and you're filled at the market. You're not necessarily filled at your price. Sometimes the market will fall several ticks or pips below your price and then fill you, but at least you know as soon as the market falls to your price and touches your price, the stop order becomes a market order and you get filled at the next available opportunity. For example, if there are too many stop orders at the same price for the number of buy orders at that price, the orders that get entered first get filled first. If there are not enough buy orders to offset the sell orders at that price, the market has to go lower to fill the remaining sell orders. As a result, you may think you should get filled right below the low of this bar, but you could get filled quite a bit below the low of that bar. Again, if the market reaches your order, does not have to go through your order, it just has to touch your order becomes a market order and you will get filled. Rarely, if you're trying to enter or exit with a sell stop, the market will hit your stop and then bounce, and you'll get filled at a better price than your stop order. If you're trying to enter or exit a trade with a buy stop order, you place the order above the high of the current bar. So for example, as this bar is forming, you decide that you want to buy above its high if the market goes above its high. Either to exit a short, maybe you sold below here, or to go long, thinking this is a pullback from this breakout. When the bar closes, you place a stop order to buy right above its high. As soon as the market goes above the high of this bar, it becomes a market order and you get filled on the next bar. If there are too many buy orders for the number of sell orders at the high of this bar, you may get filled at a worse price. And sometimes you could get filled at a much worse price. But if you trade a market that has a lot of volume, chances are you're going to get filled at your stop price or not much worse. If you're trading a stock that is priced at $1,000, you may get filled with 10, 20, or 50 cent slippage on every trade. And that is appropriate given the price of the stock. And even if you get a slippage of $1, in other words, if your fill is $1 worse than your entry price, that's no different from getting a 1 penny slippage on a $10 stock. As soon as you enter any trade, always place a protective stop. If you buy here, place a protective stop somewhere below, for example, here or here. If you sell here, let's say you sell to go short, place a protective stop somewhere, maybe above the high of this bar, but always have a protective stop in the market whenever you're in the market. A protective stop is a stop that protects you. It gets you out of a trade that is going against you. In fact, a protective stop is the single most important order that you'll ever use. Whenever you're in a trade, you should always have a protective stop in the market to protect you in case the market goes against you. It protects you mostly against yourself, especially if you're starting out, because if you did not have the stop there, you would be in denial, and often you'll exit after the market goes far against you. For example, let's say you sold to go short here, and you thought you might want to get out if it goes above the high of your entry bar or your signal bar here or here. And when it started to do that, you decided, well, maybe I'll give it more room. And you ended up exiting right here. If you had a protective stop, for example, above the high of this bar, you would have limited your losses. Without the protective stop, as a beginner, you'll usually exit at the worst price, and you'll probably buy back your short here with a huge loss. Beginners hate to admit that they're wrong, and there's an important reason behind that. They don't want to take a loss. They're afraid that if they keep taking losses, their account will disappear. And if they no longer have enough money in their account to place trades, then their dream of becoming a successful trader dies. Taking losses is the equivalent of death if you're starting out. However, you need the protection, because if you're simply relying on hoping that a bad trade reverses and goes your way, you'll quickly lose all of your money. If a bear sells below the low of this bar, he might place his stop, his protective stop, just above the high of the most recent lower high. Let's say this is the most recent lower high. He would place a stop just above that bar, and if the market touches his stop order, it becomes a market order and he gets out. If this is a market that has a lot of volume, he'll get filled at his stop price, or maybe just a little bit worse. If it's a market that has very little volume and the market hits his stop order, he may not get filled until here, much worse. That's called slippage, when the market goes beyond your order price and you get filled at a much worse price. A bull who buys this high or low might place his stop below the bottom of this bull bar or below the bottom of the pullback, which is just a little bit below. If the market touches that stop order, which is this gold line, his order becomes a market order and it gets filled immediately. Exchanges operate on a first in, first out basis. The orders that get placed first get filled first. If there are not enough orders on the opposite side, the market has to go lower, and that means traders who are trying to get out with a stop right here might get filled at a worse price. If the market is a heavily traded market, usually the worst price will not be much different from the intended price where you placed your order. Slippage can be very big if you're trading a thinly traded market. Another very important reason why you should place stop orders whenever you're in the market is because of black swan events. These are unanticipated market events, and they're real, and they come every now and then, and current systems, your broker, the exchanges, are not designed to prevent them because they're unanticipated. The theory behind black swans is that if you've only seen white swans, it's natural to believe that black swans do not exist. But they do exist, and just because you have never seen one does not mean that they do not exist. It might mean that they're uncommon and therefore low probability, but they're real. If you're trading, you have to protect yourself against these low probability extreme events, and that's one of the purposes of protective stops. Nobody knows the unknowable. The software developers, the hardware developers, the developers who create the equipment used by the exchanges, by your broker, by you. Nobody knows what is unknowable, and therefore nobody can design software and hardware to cover every possible thing that can happen, including black swans. All brokers get overwhelmed, all exchanges get overwhelmed and fail every 10 years or so. If you talk to your broker, they'll totally deny it. They'll say, oh no, we got really smart people, we have the world's best equipment, it can never happen. But I've seen it happen many times in my 30 years of trading. For example, in 1987, when I began trading, the market crashed. It lost 25% in one day, and nobody knew what the value of the market was until the end of the day. There were no prices all day long. In 2010, there was the flash crash, and the market lost 9% in 36 minutes. And this is at a time when everyone thought the world's best computers and the world's best software would prevent anything like that. And then if you go back to 1929, Black Friday, that was the start of a correction that lost 90% of the stock market value in 3 years. A protective stop is supposed to protect you, but it doesn't always give you the protection that you hoped. For example, this is Hewlett-Packard. Big gaps in stocks are common, especially after earnings reports, and a protective stop can get filled at a much worse price than you ever expected. Unexpected news events can also lead to huge gaps in the market. And the result is you think your stop is going to protect you, but your fill could be so bad that it's offering no protection at all. Here's Hewlett-Packard. Here's that same chart, but the bars are a little bit more compressed. And let's say you bought above this bull bar. We tried to reverse up repeatedly at the bottom of a trading range. It's a reasonable buy. And so you're long at 22.56. And to be safe, you place your stop order, your protective stop order, right below the bottom of this triangle. One tick below that low maybe. So your stop is at $21.99. Your risk is therefore 57 cents. You bought at $22.56 and you plan to get stopped out at $21.99. But remember, the first trade that touches your price or goes below your price makes your stop order a market order. And if you're long and this is the day before earnings, you have to be prepared for a surprise. And this is what happened. The next day, the market opened down here at 18. This is the first trade at or below your stop order. So your stop order becomes a market order down here, and you get filled around $18. Instead of risking 57 cents, you end up losing $4.56, not just 57 cents. Your stop offered no protection. However, you still need some kind of protection whenever you're taking a trade. If you're in a position going into an earnings event, buying puts provides much better protection than using a stop. The downside of buying puts is you're paying money. Puts cost money. Most of the time they'll end up expiring worthless. However, they avoid catastrophes like this. Most institutions, most professional traders protect themselves by buying puts to offset huge losses that can come from black swan events, like a much worse earnings report than anyone expected. This is a 60-minute chart of the dollar versus the Swiss franc. The market broke to the upside, it broke to the downside, and then reversed up twice. Pretty good sized bull bars. It's reasonable to go long above the high of this micro double bottom. Down, up, you buy on a stop maybe above that bar, and you get long right here. Whenever you're in a trade, you need to place a protective stop to protect you against the market going too far against you. If you buy here, you're filled at 1.0190. You might put a stop below this low, which is at 0136. Your risk is 54 pips from here to your stop. The first trade that takes place at or below your stop turns your stop into a market order. This risk to your stop is your minimum risk. It's not your absolute risk. You might be risking much more than that. Unanticipated news events can happen in any market, including currencies. And the result is your protective stop may not protect you much at all. It's rare, but it can happen. This is that same chart right up here. You bought here, and you put your stop here, and you thought you were risking 54 pips. However, the market opened with a huge gap down. You can see where it opened. It opened down here, and therefore, the first trade that takes place at or below your stop was right here, and that means you get filled right here. You were filled probably around 88.94. You thought that the most you could lose was 54 pips, but in reality, you lost 1,242 pips. Much worse than you thought. Therefore, your stop offered no protection at all. But that is a risk of trading Forex markets. This is very rare. This is the kind of thing you see once every 10 or 20 years, but it does happen, and because of that, you have to be aware of it. You have to trade small enough so that if a catastrophe like this happens, the loss is not unbearable. Forex markets often have small gaps, like on Sunday when they open. Huge gaps like this are very rare, but when you get them, your protective stop gave you no protection at all. You lost far more, 30 times more, 20 or 30 times more than what you thought was your maximum risk. Should you still have a stop in the market? Yes, you should always have a stop in the market. I want to talk a little bit about limit orders. Beginners use limit orders to take profits. Experts can enter with limit orders as well. Unlike a stop order that becomes a market order as soon as your stop price is touched, the market usually has to go past a limit order for you to get filled. Maybe 90% of the time it has to go through the limit order before your order gets filled. 10% of the time, if it touches your limit order, you will get filled. Let's say you buy with a stop above this pullback. We have a bull breakout and a pullback. You buy with a stop above the high of this bar and you get filled right there. And a scalper might want to exit with a minimum scalp, so he places a limit order at that minimum scalp price, this blue line, and as soon as the market goes above that blue line, he will be filled at his limit order price. Rarely he'll get filled at a better price. On the other hand, the scalper might decide that he wants a little bit more than a minimum scalp, and he might place his limit order to sell at the high of the bull trend. So he'll place a limit order to take profits here, to sell out of his long position here, and he would get filled here as soon as the market went above that price. If it touches that price, 90% of the time he will not get filled. It has to go above that price to make sure that you're filled. If it goes above the price, you will get filled. An experienced bear scalper might look at this and say, oh, we went down, we went up, we went down, we went up. This is probably a trading range, and therefore, if we break above the high of this bar, we're probably not going to go up very far. A bear scalper may place a limit order to go short at this high. For him to get filled, 90% of the time, it has to go at least a little bit above that high to get filled. Again, entering with limit orders is something that experienced traders can do. Beginners should only be entering with stops, because the market's racing up, and if you're selling, you have to be very comfortable being short in a market that's quickly going against you. And beginners invariably panic, and they end up exiting with a loss up here instead of with a profit down here. A bear scalper will look at this chart and see a probable trading range. He'll place a limit order at that high to go short. And as soon as the market goes above his order, he'll get filled, betting that the bull breakout will fail and reverse down. A limit order is basically the opposite of a stop order. A bull is getting stopped out above this bar. A limit order trader is placing his limit order to go short at the high of this bar. It usually has to go above the bar to get filled. The limit order bear is selling with a limit order. The stop order bull is buying. For example, if the bull wanted to buy a breakout, hoping for a measured move up, he'll buy with a stop just above the high of this bar. Or a bear who is short down here, he might have his stop above the high of this bar to get stopped out. So he'll buy back his short if the market gets just a little bit above this bar. The bear who sold at this high might be looking for a scalp. He'll place a limit order, the blue line, to get out at a scalp distance from his entry. He sold with a limit order, and he's looking to exit with a limit order. If the market falls below his limit order price, he'll get filled. If it simply falls exactly to his price, but not below, 90% of the time, he will not get filled. It usually has to go below his price to make sure his order is filled. If it does go below his price, he's guaranteed a fill. The scalper, instead of going for a minimum scalp, might hold and hope that the market falls below this low. He might place his limit order to take profit at this low. It has to go below the price to get filled 90% of the time. A bull might say, okay, we went down, up and down and up and down. It's probably a trading range, and therefore the breakout below this low will fail. A bull experienced trader might place a limit order to buy at that low. He will go long at that low, and if the market fell a little bit below his entry price, he would get filled. and it did on this bar, although it's hard to see. The low of this bar is slightly below that gold line at the low over here. I now want to talk a little bit about bracket orders. A bracket order is a combination of a stop order and one or more limit orders. Whenever you're in any trade, you should always have a bracket order operating. It's a combination of two things, a protective stop order and a profit-taking limit order. A bracket order, it brackets the current market, the current price. It's also called an OCO order. Some brokers say OCO stands for order cancels order. Other brokers say one cancels other. And what it means is if you have a bracket order, a stop and a limit order, as soon as one of the two orders is filled, the other one gets canceled automatically, immediately. Most brokers will allow you to attach a bracket order to your entry order, which means you place an entry order, the bracket order then is created but not filled. As soon as your entry order is filled, your software and your broker automatically then place the bracket order. They automatically place both a stop order to protect you and a limit order where you can take profits. The order is created as soon as you place your order to enter the trade. The order does not get placed until your order to enter the trade is filled and you enter the trade. You get to decide how far away the orders are. How far should your stop be? How much are you willing to risk? How far should your profit-taking limit order should be? Some traders split the profit-taking limit order into 2 or 3 smaller orders. They want to scale out, take some profit quickly, and take other profit as the trade goes their way. For example, let's say you are long 3 units. Your stop, therefore, is for 3 units below the market, and your limit order, you might have 3 limit orders, each for 1 unit above. If the first one gets filled, you then have 2 contracts left. Your broker software will automatically change your stop to 2 contracts because now you're only long 2 contracts. When the second limit order gets filled, you're now long only 1 contract. Your software will automatically change the stop to 1 contract. Again, as soon as your entry order is filled, if you set up your software correctly so that you attach a bracket order to every entry order, your software then places the bracket order. If a bear sells on a stop below this bar, he should have an attached bracket order. And as soon as his order is filled, he gets filled as this bar goes below that low. He now has both a protective stop and a profit-taking limit order. For example, he might place a protective stop above the high of this bar. You can see this gold line is his stop just above the high of that bar. And he might want to take a profit down here, maybe 2 times his risk. You can see the distance to his stop is further than the distance to his profit-taking limit order. He can decide where to put the stop and where to put the profit-taking limit order, and they do not have to be at the same price. As soon as he gets stopped into the market, his attached bracket order becomes active, and he now has an active protective stop. If the market goes to this price, he'll get stopped out, and this order will disappear. If instead it goes down to his profit-taking limit order, it has to go through the order to fill it, then he gets out of his position, and this stop will automatically get canceled. In this particular case, let's say he was trying to get out here. Instead of going down, the market went up. He got stopped out with a loss. He sold here. He got stopped out here. This order then disappears. It'll be filled, and this order disappears. As soon as the market reaches his stop automatically gets filled at the market, and he would exit with a loss. However, the stop protected him from a much bigger loss. When one order gets filled, the other one gets canceled. It does not matter which one gets filled. If his stop gets filled, his profit-taking limit order gets canceled. If instead the market goes here first, then the stop gets filled. Here's an example of a bull. Let's say he buys on a stop above the high of this bar. And he set up his software so that whenever he enters a trade, the market automatically creates a bracket order. With a stop below, a certain price below, he determines the price, and a profit-taking limit order above. Let's say his profit-taking limit order was up here. So as soon as he gets filled, he's long, and he had a limit order here, he can then quickly change the order to here if he thinks the market might not get much above this high. As long as the distance from here to there is at least the size of a minimum scalp, then that's an okay thing to do. On this bar, the market hit his limit order. However, it probably did not get filled. So his limit order to take profits is still alive, and his stop is still alive as well because he's still in his long position. As soon as the market went above his limit order, then he gets filled, and this order, the stop order, automatically gets canceled. He no longer has a position when he gets filled here. He exited his trade, so he no longer needs a stop order. If this order was not canceled, it would still be active. He'd be out of his position here. When the market came down and hit his stop, he would then find himself short. Bracket orders, as soon as one gets filled, the other order gets canceled automatically. There are many other types of orders. The only one that most traders ever need is a market order. Again, most traders should only be entering with stop orders, and they can exit either with a stop or limit order, the bracket order. A stop order can protect them against a big loss. A limit order can be used to exit with their profit. Sometimes the market is moving very fast and you have to make a very quick decision, either to exit a trade that you're already in or to enter a trade. And sometimes it's just better just to get in or get out immediately and not wait for your stop to be hit, or not wait for a pullback that would allow you to enter at a better price with a limit order. And that is why all brokers have an option to create market orders. If you select market, for example, buy market, you'll get filled immediately at the market. If you pick sell market, you'll get filled immediately at the market. If you're long and you hit sell market, you'll immediately exit. If you're short and you hit buy market, you'll immediately exit. Buy orders, buy market orders, they're filled at the offer. In other words, slightly above. And sell market orders are filled at the bid, slightly below. The bid-ask spread. Brokers always make you buy at the worst price and sell at the worst price. Let's say over here, you're thinking, maybe I should buy, maybe I should not buy. Maybe I'd like to see the market start to move up quickly before I buy. And as it's starting to go up, you decide, I got to get long. You can just buy at the market. Just hit the button on your software, buy the market. Your software should automatically create a bracket order. For example, you might want to sell on a stop below this low. And let's say you're planning on taking a scalp profit. The market reaches your scalp, but you think it might go higher, and then you're disappointed by this big sell-off, and you change your profit-taking order to be right at this high, and you would get filled there. As soon as your limit order is filled, your stop gets canceled. We have a trend going up here, and the market falls below a bull bar. You might decide that it's not likely to go down very far, and maybe you buy at the low of this bull bar, betting that we'll get another higher low like this. For example, you buy here, your bracket order would be a stop down here to get you out if the market fell below this low, or maybe below that low. And maybe you're hoping for a test of this high, so you have a limit order at that high. However, after you enter at the low of this bar, you get a second bear bar closing on its low. You then decide that your premise is wrong, that we're probably not going up. This might be a wedge top, 1, 2, 3, and a reversal down, and we have a follow through. At the close of this bar, a bar closing on its low, you decide, I just want to get out. I don't want it to hit my stop, I'll lose more. As soon as this bar closes, you hit sell market, and you get filled as soon as the next bar opens, and you reduced your loss instead of waiting for your stop to be hit. We have a strong reversal down, and we have a second bar closing on its low. A lot of traders will see this as a sell the close market, a strong bear trend, where you can make money by selling closes. If you think it's a sell the close market, as soon as this bar closes, you hit the button on your software, sell the market. and you get filled immediately after you hit the order, and you get filled early on during this bar with a market order. Your software should immediately create a bracket order with a stop and a profit-taking limit order, and you might want to move the stop order so that it's just above this high, and you might want to change your limit order maybe to a measured move down, maybe based upon the height of this close to that high, maybe a little bit more, and you might drag it down here. In this particular case, you might be thinking the reversal down is strong enough for a swing trade, and I'll place my limit order down here. Your software will automatically cancel the order that is not filled as soon as one order is filled. If the market comes up here and hits your stop, this gets filled. If it comes down here to hit your profit target, your profit-taking limit order, you get filled, you're no longer short, your stop automatically gets canceled. There are many other types of orders, and many brokers offer lots of other choices for you. When I started trading 30 years ago, stop limit orders and marketable limit orders were pretty popular, and they were used, I think, mostly to protect traders against floor traders and unethical brokers and firms who were basically stealing money from traders. But now orders are computerized, and you don't have to worry about the floor traders stealing from you, and therefore stop limit orders and marketable limit orders are no longer useful. Your broker may brag that he has a variety of special types of orders. They're a waste of your time. They rarely ever offer any benefit, and when they do, the benefit is very small. You stand to make much more money just focusing on managing your trades well than using these other types of orders. You should stick to the 4 types that I talked about in this video. If you're a Forex trader, you have to be aware of some peculiarities of the Forex market. First of all, the charts are not based upon actual trades. They're usually based upon the bid or the ask or the midpoint or something else. And there may never have been a trade that takes place at a particular price on the chart. So for example, if this were a Forex chart, it looks like the market traded to this high and turned down. It might not have. If this is a chart that's only showing ask prices, the market may not have ever reached that price. It's not showing trades, it's showing asks. Likewise, if it's only showing bids, it may never have reached this price. And the problem with that is stop and limit orders that you think should get filled by looking at the chart are not filled, and it's because the chart is not showing actual trades, it's only showing bid prices and ask prices. I discuss this in detail in the videos on Forex Basics in the trading course. It's very important to understand that brokers are not held. And not held is a legal term, and what it means is that anything that goes wrong is your fault. You cannot hold them responsible. For example, if you think that your order should have been filled at a particular price, but it was not filled, call your broker. However, 99% of the time, if you think you should have been filled or you should have had a different fill, it's because you made a mistake and you simply did not realize it. The 1% of the time when it actually is the broker's fault or the exchange's fault, it's still your fault. It's very rare for them to change a trade and do what is right. I've had it happen maybe a couple times in 30 years. Whenever you open an account, you sign a contract with your broker, and one of the clauses in that contract says not held. And it means that the broker is not responsible for any problems filling orders or not filling orders, or for bad fills. And if you're unhappy with a fill or with the absence of a fill, it's always your fault, even if it's not your fault. That's just part of trading. In this video, I talked about stop orders. Most traders should only be entering with stop orders and nothing else. Also, you need protective stops to protect yourself against disasters. However, they don't always protect yourself against disasters. There are some disasters that can cost you a lot of money, even if you have a protective stop in the market. Experienced traders can enter with limit orders. All traders should be using limit orders to take profits. Bracket orders, you should set up your software so that as soon as you're in the market, the software immediately creates a bracket order, a protective stop in case the market goes against you, and a profit-taking limit order so that if the market goes your way, you can exit with a profit. Market orders are handy sometimes, but you usually will not use them. They're handy to get out of a bad trade that's going quickly against you, instead of allowing the market to hit a stop and creating a bigger loss. They're also handy to enter a trade that's going very quickly in the direction that you thought it would enter, and you do not want to wait for a pullback. All other order types, I think, you should avoid. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 3 videos on orders. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 3 videos on orders. I keep making the point that stop orders are better for most traders when you enter trades. Skilled traders will also use market and limit orders to enter trades. If a trading range is pretty tight, it's a limit order market, and most traders should not trade when the range is tight. They should instead look to trade when the market has reasonably good swings or trends. Most traders should enter every trade using a stop order, because for a stop order to get filled, the market has to be going in your direction, and that slightly increases the chances that you'll make money. For example, we have a swing up here and then a pullback and a bull reversal bar. To buy using a stop, you place your stop order just above the high of this bar. If it's a Forex market, you place the order 1 pip above. If it's a stock or a futures contract, you place the order to buy 1 tick above the high of that bar. You're buying on a stop. This bar is the signal bar. If this bar goes above the high of that bar, which it did, it becomes the entry bar. As soon as the market goes 1 tick above the high of the signal bar, your stop order is touched, and that makes it a market order, and you get filled, usually at the stop order price, sometimes a little bit worse. Rarely better. Sometimes it'll hit the stop and it instantly goes down. That's very rare. Usually you're going to get filled at the stop order price. Maybe 5% of the time, 10% of the time, you get filled a little bit worse. I talked earlier about bracket orders, and you should always have a bracket order whenever you enter a trade. As soon as your order to enter gets filled, your broker's software should allow you to program both a protective stop and a profit-taking limit order, which I do not show here. At a minimum, though, whenever you enter any trade, you should immediately place a protective stop somewhere that makes sense. For example, below the bottom of a signal bar or below the bottom of a bull trend. Most traders should always be going for a reward that's equal to at least twice their risk. If their initial risk is here, a reasonable target is 2 times the initial risk. So traders will exit with a limit order at that price, and you can see what happened when the market reached 2 times the risk. You buy here, your initial risk is here, 1 times risk, 2 times risk. You can see there was selling. Most of that selling is from bulls taking profits. Some of it is from bears who expect the bulls to take profits, and they're shorting for a scalp. In the video on risk, I talk about initial risk versus actual risk, and I'm using initial risk here. You're initially risking here. If you get filled here above this bar, the market might have pulled back here and went up. Your actual risk was only to just below the low of that bar, and it's less. However, it's always reasonable to try to go for a reward equal to 2 times your initial risk. Again, beginners should only be entering with stops. They want to be swept into the trade by the market going their way. That makes it easier emotionally. Even if the market's only going your way 1 tick or 1 pip, psychologically it's easier to manage the trade if the market is going your way. Anytime you're entering with a stop, you're entering on the breakout of the prior bar, betting on a profitable breakout. For example, if you're buying with a stop here, you're buying a breakout above the high of that bar. If you're buying above this bar, you're getting filled once the market breaks above the high of that bar. If you're selling with a stop, for example, below the low of this bar, you get filled when the market breaks below the low of the bar. You're entering in the direction of a breakout. A limit order trader is doing the opposite. I'll talk about that later. Stop orders, they're good during trends. The market's going up. If you buy above a bar, the market has to go up for you to be filled. That's the direction the market is heading, and there's a higher probability that you'll make a profit. When the market starts to go sideways, stop orders are bad. Selling below this bar, buying above this bar, buying above that bar, selling below that bar. In a very tight range like this, it's a limit order market. Beginners should only be trading with stop orders, and that's the exact wrong way to trade a market in a tight trading range. And therefore, beginners should not trade when the market looks like this. This is a limit order market. Traders buy below bars looking for scalps. They sell above bars looking for scalps. They buy below prior lows looking for scalps. And that is beyond what a beginner should be doing. Again, entering with stops above this bar, above that bar, selling below that bar, buying above this bar. Stop orders are going to lose too often. When the range is tight like this, you should not be trading at all, and you certainly should not be trading with stop orders. Experienced traders enter at the market, and they'll also enter with limit orders. And both of those are, I think, beyond what a beginner should be doing. He'll make too many mistakes and he'll lose money. If the context is good for a swing up and a bull sees a bull bar closing on its high, a good sized body, and then a second one, bulls will start buying closes here or here. As soon as the bar closes, they hit buy the close, and they get filled at that price. They might get filled on this bar just as it closes if they enter right before the close. If they enter at the close, they'll get filled on the open of the next bar. That's a high probability bet that the market is going at least a little bit higher. After a beginner has some experience with stop orders, he can start experimenting with some market orders. Buy the close markets, strong bull trends, buying closes, or in a strong bear trend, selling closes. Experienced traders will also enter at the market. If they feel like the market is racing up with a lot of momentum and is likely to go higher, instead of waiting for a pullback, the trader might simply hit the button to buy the market. For example, if the market's going up and he hits buy the market, it might get filled here a little bit above the instant when he hit the market order, betting that the market would go up at least a little bit higher after this much momentum. Experienced traders will also enter with limit orders, betting that reversals will fail, for example. Very strong bull trend, very tight bull trend, a lot of bull bars closing on their highs, a weak sell signal bar. Do you think there'll be more bears selling with stops below that bar, or more bulls buying with limit orders at the low of that bar? An experienced bull will place an order to buy at the low of that bar. He'll get filled here. He'll put a stop maybe below the bottom of this breakout, probably below the bottom of this bull trend. The market's going against him. It's falling and has a strong bear bar, but he's confident in his position. He'll hold long. He might even add on lower. That is a type of trade that is very difficult for a beginner to do. If he buys at the low of this bar and he sees this big bear bar, at one point this was also a big bear bar. It ended up closing on its high, but at one point it was a second consecutive big bear bar, and a beginner would feel too much stress to manage the trade correctly. The bars are starting to get small. We have big up, big down, big up, big down. We're probably going sideways. Expert traders will start selling above bars. After 5 bars down, 4 of them bear bars, bulls will bet the first reversal up will form a lower high and there'll be a second leg down. Bears will bet that there'll be sellers above the high of this bull bar and a second leg sideways to down. They'll therefore sell with a limit order at the high of the prior bar and possibly add on higher looking for a scalp. They're betting that the breakout above the high of this bull bar will fail. There'll be sellers above and the market will trade down far enough for a scalp. In a tight trading range, limit order bears will sell above bars. Limit order bulls will buy below, betting that breakouts will fail. They'll also buy at the prior low. Again, this is more than what a beginner should be doing. A bull might place an order to buy at the prior low, this low or that low. He'll get filled here. Even though it's a bear bar closing on its low, the bull will bet that the trading range will continue and that any breakout down or up will fail, and therefore buying a bear breakout will lead to a profitable scalp. Every time you see a tail on the top of a bar or on the bottom of the bar, it's a failed breakout. If the market has a lot of bars with tails and a lot of overlapping bars, it has a lot of bars that are failing to break out above or below the prior bar. And therefore, instead of entering with stops betting on successful breakouts, you have a better chance to make money if you enter with limit orders betting the breakouts will fail. Again, this is something that only experienced traders should do. A market that has lots of reversals is bad for stop orders. If it's bad for stop orders, a limit order is basically the opposite side of a stop order. It's good for limit orders. Big tails on the tops of bars, the breakouts are failing, more sellers than buyers as the market's going up. Therefore, traders will sell breakouts betting that they'll fail. They'll either sell the high of the prior bar, for example here, sell the high of this bar, betting the breakout will fail, or they'll sell at the high of a prior high. For example, they'll place a limit order at this high, betting that the breakout above it will fail. Again, limit orders are bets that breakouts fail. Stop orders are orders betting that breakouts succeed. They're basically opposite of one another. Big tails below bars, the breakouts are starting to fail. Bulls see that, and they'll place limit orders to buy at prior lows and at the low of the prior bar. For example, they might buy at the low of this bar or at the low of that bar, or if the market falls below this low, they'll buy as well. They're betting breakouts will fail. Again, stop order traders are selling at that low, betting on a successful breakout. When the market's in a trading range and it has a lot of tails and a lot of reversals, that is a bad bet. More likely, there'll be buyers at that low, not sellers. And therefore, buying that low has a better chance of making money than selling on a stop just below that low. This is a limit order market, a trading range. Bad for stop orders, good for limit orders, because they are doing opposite things. The stop order trader is betting on a successful breakout. The limit order trader is taking the opposite side of that trade. He's betting that the breakout will fail and reverse. Whenever you look at a chart and you're not really clear of the direction, if there are a lot of dojis, a lot of tails, a lot of overlapping bars, a lot of little reversals, the probability is bad for stop order traders. Also, if the bars are big, then the risk is big. The stop is going to be far away. Your protective stop is going to be far away. For example, buying above the high of this bar, we have a lot of reversals. The probability is we'll get another reversal. The probability for a stop entry bull is small. The bar is big, so his risk is big. Therefore, you have a bad risk-reward ratio and a low probability. If you're going to take the trade, it makes more sense to do the opposite, to sell at the high of that bar instead of buying just above the high of that bar. Stop and limit orders are basically the opposite side of the same trade. Very big bull reversal bar, but lots of reversals. Big up, big down, big up again, probably trading range rather than bull trend. And therefore, buying at the high of anything is usually a losing strategy. It's a low probability bet. Experienced traders instead will place a limit order to sell that high, betting that instead of a bull trend, the market will go sideways and he'll make money selling above bars, betting that bull breakouts will fail and reverse far enough to make a scalp. Therefore, probably more sellers at this bar's high and above its high than there are buyers. It's a limit order market. Since 95% of all trades are traded by institutions, you should assume that for every trade, one institution is buying and another one is selling. You also have to assume that both are doing something that is rational. How can it be rational for one institution to buy and another institution to sell? Well, 90% of the bars on every chart are either in a channel or a trading range, and if you manage your trade correctly, scale in, you should be able to make money buying or selling at any given moment. One institution is buying above this bar, betting that the market's going to go higher, but that institution may also be willing to scale in lower. For example, right here, again entering on a stop, betting that this was a rational buy, therefore the market should get back to that price. He can get out break even in his first buy and with a profit on a second buy. Another institution will do the opposite. He'll sell this high, betting that the market will turn down and he'll be able to make a profit. Another institution will sell this high, betting that at worst it's a trading range. It could be a bear trend. And if it's a trading range, and rallies, it'll come back down to that price, and if he sells more higher, he can make a profit. You can see the market got down to that price, and the market went up. Part of the reason it went up is bears sold here, they sold more higher, and they're buying back their shorts at their original entry price. Some bulls will buy below this bar, betting that we have consecutive bull bars. The reversal down will probably not get very far. Here you have a wedge, 3 pushes down, 1, 2, and 3. And you have dojis, tails on the bottom. Traders are buying lows. Some bulls will buy at the low of that bar, betting that it's a bad bear flag. It's a bear trend, but it's also probably a trading range at or around the bottom of the bull trend. And we keep getting reversals, bear bar, bull bar, sell off, rally, sell off, probably a rally. Therefore, bulls will buy at the low of that bar, betting that the bear breakout will fail and that we'll get a reversal up. Bears, they'll sell with a stop, betting on a bear breakout. Some will even sell down here, hoping that it's a bear channel that just continues down all day. They're confident that with a channel this tight, worst case is any rally will be minor and lead to a trading range rather than a bull trend. If they sell here and scale in higher, they can avoid a loss and usually make a profit. Remember, 10% of the bars on a chart are in a strong breakout, and you should only trade in the direction of the breakout. 90% of the time, there's always an equally valid trader's equation for the bulls and the bears, if they manage their trades correctly. Again, during a strong breakout like this, it's better only to sell, because the first leg down will probably be followed by a second leg down, and the first reversal up will probably be minor, either a bear flag or a bull leg in a trading range. In either case, the market should trade back down. What's better, a stop order or a limit order? Well, they're equally effective. At any given instant, the probability that the market is going up or down is just about the same. If you look at any chart, a limit order or a market order wins about as often as a stop order. Half the time, stop orders are better, half the time, limit orders are better. The more the market's going sideways, the more often a limit order will make money. The more the market is trending, the more a stop order will make money. Here, a trader wins selling with a limit order at the high of that bar. And over here, we have a failed breakout above this high, a little bit of a parabolic wedge, 3 pushes up, 1, 2, 3, 2 small legs up, 1, 2. It's a reasonable short for a stop order trader, betting that the reversal down will be profitable. Beginners should only enter with stop orders. Rarely, with some experience, they can begin to enter with market orders or limit orders, but only in the direction of strong trends. Experienced traders, they use limit orders just as often as stop orders. Some traders have a preference for stop orders. Other traders prefer trading range scalps and they prefer limit orders. But in general, expert traders use both. A trading range is a limit order market. A trending market is a better market for stop orders. A trading range is a limit order market, especially if the range is tight, and it's better to buy low, it's better to sell high, it's better to take quick profits, betting that the leg is not going to last very long. You buy low, you sell high, you scalp. Can you buy here? We have a wedge bull flag, we have a breakout and a pullback, and here we have another bull breakout and a pullback. Can you buy above here? Sure, but if you're buying near the top of a trading range, the probability is you're going to get a reversal down. To make money, usually you need to have a stop below, and it's better to scale in lower. Buying at the top of a trading range, your stop is down here, so the risk is big, and the probability is not very high unless you're willing to scale in. Buying up here, your stop is below the bottom of the most recent major high or low. We have a good reversal up here and a slightly new high, and therefore this is a fairly significant higher low, a major higher low. If you're buying up here, then your stop is just below that low. Buying high means the risk is big, the stop is far below. And buying at the top of a trading range means that the probability of making money is low, unless you're willing to scale in lower and use wide stops. Big risk and low probability means bulls buying with stops at the top will lose money unless they manage their trade correctly. Instead, bears selling with limit orders, betting that bull flags at the top of the trading range will fail, have a much better chance of making money. Experienced traders would rather be selling above bull flags at the top of a trading range, in other words, entering with limit orders at the high of the prior bar or at this high, at the high of this bar or at this high, betting that the breakouts will fail and lead to another leg down in the trading range and test near the bottom of the range. Trading range, a limit order market. It's better to enter with limit orders, selling near the top, buying near the bottom. But again, you only do that once you're an experienced trader. If a bear sells with a stop near the bottom of a range there, here, or here, his stop is far away. That means his risk is big. An experienced trader can make money selling low in a trading range, but only if he's using the appropriate stop and scaling in and exiting appropriately. The stop for a bear selling here, it might be at the top of this final leg down. It might be at the top of the trading range. In any case, selling here, the stop is wide. The risk is big. Selling below this small bear flag, stop up here. Big risk. Strong sell-off. We have a small bear flag. Selling at the low of that sell signal bar. The risk is very big. Since most trading range breakout attempts fail, selling at the bottom of the range is betting on a successful bear breakout of the range. It's probably going to fail. That means the probability of making money selling near the bottom is low. You have big risk selling at the bottom of a range. The stop is far away, and the probability is low. And therefore, selling with stops at the bottom of the range, it's difficult to make money unless you use the appropriate stop and scale in higher, and that's something most traders cannot do. However, bulls know that. They know the risk for the bears is big. They know the probability for selling at the bottom is bad, and therefore bulls will buy with limit orders below bear flags, betting that the bear breakout will fail, reverse up, and go up high enough for the bulls to make money. They'll buy at the low of that bar, get filled here, and make a profit on the rally. They'll place a limit order to buy at the low of this sell signal bar or at that low, betting that the bear breakout will fail and they can make money on a buy scalp. They'll buy at the low of this bar, betting the bear breakout will fail. They'll buy at the low of the leg down, betting on a reversal instead of a breakout. Buying with limit orders will make money. Selling with stop orders at the bottom of a range will lose money. If the range is tight, most traders should not trade. Whenever a trend is strong like this, it does not matter what type of order that you use. All that matters is that you trade in the direction of the trend. Here it's a strong bear trend, so you should only sell. And you can sell with stop orders below bars, you can sell with limit orders above or below bars, you can sell with market orders, you can sell at any time. When the market's in a strong trend, only two things matter. You can only trade in the direction of the trend, here sell, and the other thing is you have to get into the trend. You have to sell. And you can do it with any kind of an order, stop order, market order, or limit order. When a channel down is very tight, the pullbacks are small, they only last a bar or two, some traders will sell at the market. Also, they're starting to get strong bear closes, traders will sell the close. As soon as the bar closes, they hit sell the market, or right before it closes, they hit sell the market. Sometimes as soon as it closes, they place a limit order to sell at the close of the bar, hoping to get filled on the next bar. However, sometimes the next bar does not go above the close of the prior bar and your limit order does not get filled. It's usually better just to sell the market when you think it's a sell the close bear trend. Anytime the market is trying to reverse, bears will sell with limit orders at the high of the prior bar, betting that the reversal will fail and become a bear flag and the bear trend will resume. The bull's trying to get a reversal. Well, most reversals fail, and the first reversal is usually minor. Bears will sell the close of a strong bull bar, betting that the reversal up will fail and the bear trend will resume. Bears will also enter with stops below every reversal attempt, thinking that the reversal attempt will be a bear flag and that the market will continue down. They'll place a stop order to sell just below the low of the prior bar. When traders start out, they should only enter with stop orders. In fact, most traders should enter with stop orders throughout their trading careers. Skilled traders often use market orders and limit orders as well. When the market's in a very tight trading range, it's a limit order market, and most traders should not trade at all. When the market's in a strong trend, traders should enter with any kind of an order, a stop order, a market order, or a limit order in the direction of the trend. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 3 videos on orders. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 3 videos on orders. When you're deciding what to do with your orders, the price action should determine what order you should place and where you should place it. I want to talk a little bit about limit orders, trading with the trend, and trading against the trend. Also, traders can sometimes enter earlier on a smaller time frame chart, reducing their risk. When the market has big swings, consecutive trend bars, not much in terms of tails, not much in terms of reversals, traders can enter with stops or limit orders. Strong bear trend, you can enter with stops below bars, you can sell at the market, you can sell with limit orders above bars, betting reversals will fail. Strong bull trend, you can buy with stops above bars, you can buy with stops above bars here, you can buy with limit orders below bars, betting that reversals will fail. However, when there are lots of reversals every few bars, the market goes the opposite way. Every bull bar followed by a bad follow-through bar, a series of bear bars with bad follow-through. And the market is mostly horizontal, and many bars have prominent tails. You can see almost all bars have fairly prominent tails. This is a bad environment for stop entries. Most traders should not trade when the market is starting to look like this. However, experienced traders will enter with limit orders, selling above bars, buying below bars, and scaling in lower and scalping. This is a bad environment for stop orders. A stop order is a bet that a trend will continue. When the market looks like this, stop orders are going to lose money because the trends keep reversing. It's more of a limit order market, betting that breakouts will fail, selling above bars, betting on a reversal down, buying below bars, betting on a reversal up. When the market is very tight in a range like this, most traders should not trade. They should simply wait. Experienced traders will trade with limit orders and they'll scalp. Sometimes when you look at a chart, you're not sure if it is early in a trading range or if it's in a weak trend. When you're in doubt about what to do, you have 3 choices. One is you can wait for a second or third signal with a good signal bar. Another is you can wait for a strong breakout, and then you have high probability, but your stop is further away. And third, you can simply wait for a clear signal. For example, do you buy here betting on a double bottom? Do you buy here, a second entry buy? This is an example of a second entry buy. 3 bear bars, a bear trend, low probability buy. But now we have a second reversal, a second attempt at bottom. You can call it a final flag reversal, a lower low. We have lots of doji bars, bars with prominent tails, and the market's going sideways. It's probably an early trading range. Here you're buying a second entry at the bottom of the range. This is a higher probability buy. Tight trading range, if you're looking to sell, here's a first entry short. The market fell below this bear bar right here. It fell below this bear bar here, so that's a second entry. And here's a third attempt. Whenever you have 3 reversals in a horizontal trading range, you can call it a triangle if you want. You can also call it a third entry short. The third entry has a higher probability of success. We're getting a breakout. The first reversal down, when this bar fell below that bar, not a high probability short because we have 5 consecutive bull bars. We have a lot of trading range price action here. Most breakouts above trading ranges fail. It's higher probability to take a second entry short. The first entry was this bar falling below that bar. Traders would then place a stop order to go short below this bar, which would be a second entry short. The market's in a fairly tight bear channel. Traders will sell below pullback bars. For example, we have a pause bar here, an attempt to reverse. This is a strong enough breakout. We'll probably get at least a little bit more down. Traders would therefore try to sell below the low of this bar. These two bars have the same low. The trader would get filled on this bar, betting that there would be at least enough trend resumption down for a profitable trade. Even though after the breakout there's a bull bar, bad follow through, the bar afterwards had a bear bar. Sometimes the follow through occurs on the second bar, not the bar after the bear trend bar. When the channel is tight like this, the odds of a reversal up going very far are small. Most likely any reversal up is going to be a bear flag, or possibly a bull leg in what would become a trading range. If we went up 5 or 10 bars, we probably would come back down and test this area. So a trader selling here could sell more on a rally, expecting the market to come back down here. A tight bear channel is unlikely to become a bull trend. The best the bulls usually can get is only a trading range. If you sell here, you can sell more higher. Trading range, you expect it to come back down. Very tight bear channel, strong breakout, probably at least a small second leg down. This is the second leg down. Would you buy above this bull bar? Well, I don't know. You got 2 consecutive bear bars. Now you have a micro double bottom and a lower low, basically a double bottom, this low and that low, and this is a micro double bottom. A micro double bottom is a type of second entry buy, and therefore it's reasonable to buy here, betting on at least a minor reversal, possibly a major reversal. Probably not enough bars for a major reversal, probably good enough for a profitable minor reversal up and a profitable buy. Traders can use limit orders when they're trading in the direction of the trend, betting on reversals failing, and they can also use limit orders betting on a reversal in a trend. We have a bear trend here, a bull trend here. Trends are always trying to reverse. When the market's in a reasonably strong trend during a breakout, there's a breakout here, traders will bet that reversal attempts will fail. For example, they'll buy with a limit order at the low of this bar, betting that there'll be at least a small second leg up. When the market is starting to look like a trading range, traders will bet that breakout attempts will fail. For example, they might sell above the high of this bar, betting that the first reversal up from a tight bear channel is likely a bull leg in a trading range. So they'll sell at that high, betting that the reversal up will fail. Likewise down here, we're starting to get a lot of doji bars, trading range types of bars. Traders would look to buy below the low, the prior low, betting that the reversal will fail and that the market will stop being in a bear trend and start entering a trading range. We have 5 bear bars after a wedge top. A second leg down is likely. Wedge top, 1, 2, 3. 5 bars down. 2 of them are dojis, but 3 are pretty good bear bars closing on their lows. The market will likely have a second leg down. This is a bear trend. Traders will bet the reversal up will fail. They'll place a limit order to sell above the high of this bar or above the high of this bear bar. They'll get filled here. And then they'll look to take a profit somewhere down here. We have a reversal up, a second reversal up, and a third reversal up. This is a wedge bottom. After a fairly weak trend, not much in terms of consecutive bear bars. We have a bear bar, doji, 3 bull bars. Bear bar with tail, dojis, bull bars. This is a weak sell-off, probably a bear leg in what will become a trading range. Traders will look for reasons to buy a reversal up. We have a wedge bottom, and we have a strong bull breakout bar and a bull follow-through bar. Strong enough so that the market will probably have at least a small second leg up. Bears will see this as a double top. Bulls will correctly decide that it's more likely there'll be buyers below this bull bar. We have a bull breakout bar, a big bull bar. We have a follow-through bull body, even though it's small. We have a wedge bottom. We have a lot of trading range price action. Bulls will place a limit order to buy at the low of this bar. They'll get filled here. They'll put their stop down here, betting on at least a small second leg up. They're using a limit order to trade in the direction of a bull trend. just like the bears who sold here were using a limit order to trade in the direction of a bear trend. Traders will also use limit orders to bet that a trend will fail. They'll be trading counter trend. Traders see a reversal down, and then a big doji bar at the top of a wedge channel. Some traders will bet that the breakout above the channel will fail, and they'll place a limit order to sell at the high of this bar or at the high of this bar. If they sold at the high of this bar, their order would not be filled. But if they placed a limit order to sell at the high of this bar, they'd be filled right here, betting on at least a couple legs down from the wedge. This is betting against a trend. This is using a limit order, betting that a trend is about to reverse. We have a bear sell-off, but we're getting bad follow-through, dojis, prominent tails, sideways bars. The bulls who bought at this low had a bounce, maybe enough for a scalp. The bulls who bought at this low, again, probably made enough for a scalp. Therefore, bulls are assuming the market might be entering a trading range, and they'll look to buy prior lows, and sometimes they'll even look to buy below a bear flag. Here we have a double top bear flag, and we have a good bull bar here, a better bull bar here. Some bulls will place a limit order to buy at the low of this bar, just in case the market does not fall below this low. They'll place a limit order, they'll get filled here. It does not matter that it fell a little further. Some bulls would even buy more at this low, betting that we're entering a trading range, and will probably get a bounce that's at least big enough for a profitable scalp. Again, bear trend, but bulls buying either at the prior low or below a low 2 bear flag. We have a double top, therefore it's a low 2, low 1, low 2. They'll place a limit order to buy at that low for a scalp up, betting that the bear trend will evolve into a trading range, and they'll be able to make a profitable scalp. We have a strong rally, but it's about a 50% correction. And we have a pullback, 3 consecutive bear bars. The bulls are trying to resume, but bad follow through. Another bull bar, bad follow through. Some bears will sell with a limit order at the top of this bear bar, betting that there's not enough momentum up for the market to go much higher, and therefore this might be the start of a trading range rather than the start of a bull trend. They'll sell with a limit order at the top of this bear bar, betting that maybe it's a low too short. We have one leg up, reversal, second leg up, trying to get a third leg up. They'll bet against a successful bull breakout and instead a trading range. We have an early bull trend. We have a breakout, a bull flag, a weak breakout of the bull flag, bear bar, bear bar. Traders will place a limit order to go short at the high of this bear bar, and they'll get filled here, betting that the bull trend will fail. They're using a limit order to bet against a bull trend and instead bet on a trading range. The market is starting to rally. We have a series of consecutive bull bars, but we have a lot of bear bars here, and this high is a double top with this high. This high is also a double top with this high. It looks like the market's evolving into a trading range. Here's a high 1 buy, but a bear bar, and the market did not go up very far. Now we have a high 2 buy, but a bear doji. Probably not going to be a very profitable buy. Some bears will sell at the high of this bar, betting against a successful bull breakout, and instead betting the bull breakout will fail and that this will become a trading range. They're betting against a successful breakout and continuation of this bull trend. They're trading counter trend with a limit order, selling at the top of a rally. When the market looks like it might be entering a trading range, very tight bear channel, first reversal up, probably minor, a bull leg in a trading range, traders will sell at prior highs. Here's a prior high. Traders will place a limit order to sell. They'll get filled here. They'll put a stop above this bear trend high. And the same thing here. We have a major high. It led to a new low. Bears will sell with a limit order at the high of this bar, and they'll get filled here. And even here, they'll sell with a limit order at the high of this bar. We have another high here. The market's going above it. They'll sell here. Different choices, all close together, but all are adequate choices. Stop above the top of the bear trend, betting that this rally is not strong enough to be the start of a bull trend. Instead, it's probably 2 legs up in a trading range, 1 pullback 2, and that if it's a leg up in a trading range, it'll be followed by a leg down. And the bears, therefore, are betting against a successful trend, betting in favor of a trading range, selling at and above prior highs. We have a bull flag, 4 consecutive bull bars, but a bear bar, at a prior high and around a 50% pullback. That's not a very good looking bull flag. Bears will place a limit order to sell at the high of this buy signal bar, a bear bar, and a possible double top. The same true here. We're getting a bull breakout, but again, a bear bar. This bar has a prominent tail on top as it's breaking above this prior lower high. It's a lower high compared to the top of the bear trend. Traders expect this is a bad buy signal bar, a bad bull flag. They'll place a limit order to sell at the high of this bar, and they'll get filled right there. And the same is true at the bottom of what they think is a trading range. A double top bear flag, but bad follow through, a lot of prominent tails, a lot of trading range price action. The entire sell-off looks like a bear leg in a trading range. Traders will begin to buy at the low bars, betting that bear breakouts will fail. They place a limit order to buy at the low of this bar, and they get filled right here. Here we're getting a bull reversal, fairly low down in a possible big trading range. Bulls will bet that this double top bear flag will fail. This breakout is strong enough for a second leg up. They'll place a limit order to buy at the low of this bar. The bears see a double top bear flag and a bear trend. The bulls see a wedge bottom, 1, 2, 3, and a strong reversal up. Probably will get a second leg up. Bulls will place a limit order to buy at the low of this bar, and their order will get filled right here, and their stop will be here. A lot of trading range price action. Does not look like a strong rally. It lacks consecutive big bull trend bars. Does not look like a strong sell-off. It lacks consecutive big bear bars. 2 big bear bars here, but a doji here. Bear bar here, but a doji here. A couple bear bars here, but a tail. Traders will look to buy at a prior low, looking for a scalp up. And trading range price action, they'll sell at a prior high, betting on a reversal down. So they buy this low. They place a limit order as the market is falling. They place a limit order to buy this low. As the market's falling again, over here, they'll place a limit order to buy this low, each time expecting the breakout to not fall very far and to bounce enough for them to get a scalp. A lot of times, they'll buy this low, they'll get filled here, and they'll try to buy more down here, as long as their second entry is at least as big as a scalp. If they buy here, and they buy more here, if it's the size of a scalp, and the market reverses back up to their first entry price, they get out break even on their first entry, and with a scalp profit on their lower entry. We have a reversal down, a second reversal down. A lot of traders will assume the bull bars are not big enough and powerful enough to lead to a bull trend. We have a tail here. We have 3 bear bars here. They'll bet that the breakout attempt above the top of this bull channel is likely to fail and lead to a wedge. They'll place a limit order to sell at that top of the channel, looking for at least a scalp down, maybe a couple legs down. Here we have what looks like a trading range. We have a series of bull bars here, but fairly prominent tails below and a little bit above. Some traders will place a limit order to sell at a measured move up. Certainly the bulls who bought, if they held, this is a good location to take profits, near the top of the range, above this bar, betting that the market will fail in its breakout attempt. And then you also have a measured move up. We have a breakout, a pullback, and a gap. A little bit of a negative gap. We fell below that low, but still a potential measured move up. Some traders will place a limit order to sell at that high, either to take profits on their longs or to sell at least for a scalp. Wedge bottom, 3 pushes down, 1, 2, and now 3. A lot of trading range price action. This is probably a bear leg in what will become a trading range. Traders will therefore place a limit order at the bottom of this channel, and they'd get filled right here, betting on a couple legs up. That's also a leg 1, leg 2 measured move. Leg 1, pullback. Leg 2, this is the size of this first leg. Traders expect to see some buying at that price. That's an additional reason to buy. Fairly weak bull channel here and here. Traders will bet that the breakouts will fail to go far enough up for a scalp, and therefore they'll sell at the high of the prior bar, especially if the prior bar is a bear bar. We have 2 legs up, possibly a wedge, and now we have a big doji and a bull bar at the top of the channel. A lot of bears will sell with a limit order at the high of this bar or the high of that bar, betting that the bull breakout above the top of the channel will fail. Different ways to draw a wedge here. First push up, second push up, third push, or first push, second push, third push, fourth push. Traders will look to sell above bear bars, betting that they're bad buy signal bars at the top of a trading range or at the top of a weak rally. Also, they'll sell at prior highs. A good-looking bull bar, possible double bottom, we down here, but a lot of trading range price action, weak rally, bad follow through here, bad follow through here, bull bar, bad follow through here, big tails here. Traders will look to sell above bars, betting that they'll be able to make a profitable scalp and that this rally is not a bull trend. It's a bull leg in what will become a trading range. We have a bear channel, bad follow through, bear bars, bad follow through, bear bar, bad follow through. It looks like a bear leg in what will become a trading range. Traders will therefore look to buy with limit orders, bear breakout attempts below the bottom of the channel. Bear channel, bulls will place the limit order to buy there. We have a bad looking bear flag, a big tail here. We're trying to break out here. This looks like a bear leg in a trading range. Probably buyers at this low or not far below. We have a bull bar here. It's a bear flag, but a bull bar. Traders will buy either at the low of this bar or at this prior low. And the same is true here. We have a bull bar and a doji bar, not strong sell signal bars. Bulls will buy either at that low or at the prior low. And the same true here. We're getting a lot of dojis. A new low here is possibly a wedge. 3 pushes down, 1, 2, 3. Bulls will buy the new low, betting on a wedge and at least a small reversal. I want to talk a little bit about entering on a smaller time frame. If the context is good, you can often enter earlier, which means your risk is smaller. This is a 5-minute chart, and we have a very strong bull breakout. When you see a bull bar, a second big bull bar, traders need to get long. However, if they're buying here or here on the close, their stop is way down here. And it can be scary to be buying the close or buying at the market, and you don't have enough time to think. What I typically do is I try to buy at the market as the market is rallying strongly like this, betting that the momentum up is so strong, we should get at least enough follow-through buying for a profitable trade. Let's say you buy that close, your stop is below the low of this bar. This line is just a little bit below the low of the bull breakout. 60% chance you're going to get a measured move up from your stop to the entry bar before the market falls down here. So 60% chance it's going to go up here before it goes down here. It's scary to take the buy, but the math is good. An alternative is to wait for a pullback and buy over here. Some traders simply just are unable emotionally to take the buy the market or buy the close. An alternative is to take a look at a smaller time frame chart. This is a 5-minute chart. You can look at a 1-minute chart. And this is the same chart, but a 1-minute chart. Instead of buying that close, you might look at this and say, well, it's a pretty strong breakout. Maybe I'll buy the close on the 1-minute chart. Or we have a bear bar, a small pullback. Maybe I'll buy on a stop above the high of that bear bar, betting on some follow-through buying. As soon as I see 3, 4, or 5 consecutive bull bars, especially with 2 or 3 of them closing on or near their highs, and with the bodies getting pretty big, the odds are we're going to go at least a little bit higher. And therefore, I can buy for any reason. I can bet that the reversal down will fail. I can buy with a limit order at the low of this bar, or I can bet the breakout will fail and buy above the high of this bar, or buy above the high of this bar, or buy above the high of this bar. The risk probably is to the bottom of this bull breakout. Realistically, most traders would put their stop down here. However, the risk is less than it is over here on the 5-minute chart. Again, you can enter early. We have a bear trend, strong bear breakout. Big bear bar. A lot of traders are very uncomfortable selling the close or selling the close of the bear follow-through bar. It happens very quickly, not enough time to think about how to sell. You can sell the close of the breakout bar. We have a bear bar for a follow-through bar. You can sell the close there. You could bet the reversal up will fail and place a limit order to sell the high of this bar and get filled here. If you don't feel comfortable selling the close or selling above a bull bar or waiting for a pullback, you can take a look at a 1-minute chart, and sometimes you'll get an earlier entry. This is difficult to do if you're a beginner, but experienced traders can do this. Here's the same chart, but a 1-minute chart. This is exactly this chart, but this is the 5-minute chart. This is the 1-minute chart. Two big bear bars closing on their lows. Some traders will sell at the market here, which would be right here on the 5-minute chart. As soon as you get two very big bars or 3 or 4 reasonably big bear bars, traders will look to sell any time frame. On the 1-minute chart, you get in a little bit earlier than you would on the 5-minute chart. You can place a limit order at the high of the prior bar, betting that the reversal up will fail. Or you can place a stop order below this pullback, betting that this is a bear flag and will go lower. You place a stop order below that bar, you get filled here. The price action determines what kind of order you should use. Beginners and most traders should only enter with stops. They can exit with limit orders to take profits, and they always should have a protective stop. Experienced traders will use limit orders either to trade in the direction of a trend, betting reversals will fail, or they'll use counter-trend orders, limit orders, betting that the trend is actually a leg in a trading range and it will soon reverse. Sometimes when you have a big breakout, it's scary and difficult to enter at the market or on the time frame that you're looking at. An alternative is to switch to a smaller time frame chart and look for an entry on that smaller time frame chart. I'm Al Brooks. This is the third of 3 videos on orders. Thank you for watching the Brooks Trading Course.